Okay, hello everyone. Good morning. My name is Mao, and I'm from Cornell Johnson Graduate School of Management. So on behalf of my co-organizer, Toron Chodia, Paulo Pasquarello, Gideon Sar, I would like to welcome you to the NBER Financial Market Structure Conference. First of all, I want to thank the Journal of Financial Markets and its publisher, Elsevier, for their generous financial support for this conference series. And thank you all to attend the inaugural version of the conference. So before I get started, I would like to introduce you Jim Patova, President of NBER, and Paulo Pasquarello, the Managing Editor of Journal of Financial Markets. So Jim, the floor is yours.
Good morning, everyone, and thank you for spending your Saturday in the summer here doing market structure research and talking about this. I just wanted to welcome everyone and to thank, in particular, Elsevier and Paulo for coming up with this plan to support this meeting, because those of you who've been longtime participants in this gathering will recall that it began as a National Science Foundation funded meeting on big data and LLMs and AIs, and as many of us have been watching, the National Science Foundation is no longer quite the presence in research funding in economics and finance that it once was. And this has led to much wringing of hands in many courts. But in this particular context, in some sense, what I would love to see happen more frequently has taken place, which is that with the substantial efforts of Paulo, who I'll welcome as soon as I finish here, we've managed to find a new supporter for this meeting, and that is to turn to publisher Elsevier. And in particular, the way the Journal of Financial Markets was constructed, there's an opportunity to support some research in the profession. And what the combination of Mao, the other organizers, and Paulo has come up with a way of doing is to essentially build a connection between the journal, the publisher, and this meeting. So we're very, very grateful to that collaboration for coming together because it frankly is the kind of private nonprofit partnership that we are probably going to have to think about a bit more as we go forward in a broader research tapestry of what we do. So, once again, it looks like a fantastic meeting. I'm very excited to be able to join you this morning and welcome Paulo to come and say some more remarks. So, thank you.
All right. So, welcome everybody. I guess we keep repeating welcomes for people. So thank you for being here. As Jim mentioned, this is a Saturday in the middle of the summer. There is Canadian fires throwing smoke all over us, and it's in the middle of the World Cup. And I know that some of you are on pins and needles for the game tomorrow. Clara, I'm looking at you, of course. And so I appreciate that you actually decided to devote some of your time to this, I believe, fantastic event. The first of what we hope is going to be many. As Jim mentioned, my name is Paulo Pasquarello. I'm a professor at the University of Michigan, but I'm speaking to you today as the managing editor of the Journal of Financial Markets, which very generously, together with the publisher Elsevier, has offered us the financial support. Like Jim mentioned, times are grim sometimes. It's becoming more difficult to find support for events like this, and so hopefully the publisher and the journal will be able to keep this going for the time being. I would also like to thank especially my co-organizers, because nothing could happen in this event without their indefatigable effort at selecting among hundreds of high-quality submissions. So I want to thank Tarun Chodia from Emory University, Gideon Sar from Cornell University, and Mao Ye from Cornell University for pulling this great effort to make sure that this happens. I also want to thank Jim himself for supporting the initiative, and the various invisible, but not so invisible, NBER people that make this happen, like organizing the dinner, the lunch, the breakfast. And you may have also all dealt with Rob Shannon. Rob is the person who manages physically the submissions of the papers, etc. So I want to thank all of them for supporting the event. Now, before I pass the baton to Gideon for the traditional roll call, they've asked me to read a statement, which, as you probably know, is about the Code of Conference Conduct, which prohibits harassment, discrimination, and other forms of unprofessional behavior. By all us being here, we have collectively accepted to abide by conference where you can gather information on who to contact in case of potential infractions or questions as far as this code is concerned. So thank you very much again for being here, and Gideon, the baton is yours.
This is joint work with Bobby Bartlett at Stanford Law School. He's on a beach in Italy right now, so you get me. I think the prediction market area is really interesting, and I'm going to start with a little example to sort of motivate where we're coming from. And on February 9 this year, Kalshi settled the event, will Jeff Bezos attend the Super Bowl? In the preceding week, there were 888,000 contracts that traded on this pressing issue. And over the entire period that it was offered, there was $1 billion bet on this thing. The only challenge is that later the Wall Street Journal identified that there was a source of informed trading. Jeff Bezos' stepson told his fraternity at the University of Miami that no, his family wasn't going. And the fraternity brothers immediately began trading no on this. The yes price fell from 70 cents to 30 cents as they traded on the information. Now, no matter how we want to define it, this is essentially informed trading. And one of the things that we, of course, know as microstructure people, as we think about markets providing liquidity and price discovery, informed trading is the tricky part, right? We've got market makers on the other side. And so this paper, we're going to be very interested in trying to understand the adverse selection. How big is it and what it does? And some of you may not have realized how big these markets are becoming. So this is just in the last year, okay? So the blue one is Cauchy, the orange one is Polymarket, and the little blue, turquoise one is Polymarket US. We really weren't supposed to be on Polymarket up until very recently. You can see that Cauchy has taken over in terms of volume. And the June 2026, a lot of that is actually picking up betting on the soccer games. But overall, these markets are exploding. And so there's a lot of reasons for being interested in how they operate. What we're going to be looking at here is a series of issues. One is how large is adverse selection and where does it concentrate? We're going to actually divide the Cauchy universe into pieces, and we're going to be looking at single name markets and broad-based markets because there's tons of markets. And we really aren't going to be caring about where, Taylor Swift's going on her honeymoon necessarily. But, here's a couple of markets trading right now if you want to go run out and put money on them. Well, PepsiCo mentioned Starbucks in its earnings call. That's an example of a single name event market. Will the Fed funds rate be above 4% at the end of Q3 2026? That's an example of a broad-based market that's currently trading. So we're interested in just the size. We're also interested in whether spreads can compensate market makers for informed trading. And if not, what sustains liquidity provision? We want to also talk about, can market makers see the toxic order flow coming in real time? Right? Because as the market makers have got to figure out what to do, can they see what's happening at all? Does the canonical microstructure model that we usually use apply to binary settlement markets? As you may expect, when we work on any market, we have to make adjustments to the nature of the market. Here, you have to make quite a few, and it's kind of fun. And if I have time, I really want to talk a little bit about what does this imply for the regulation of informed trading, which at the moment is in this abyss. So that's a quick overview. Let me see if I can move in quickly. So let me give you a preview of results. We're going to adapt Kyle's Lambda and Glaston Harris to binary markets. And what we're going to find using those as metrics of price impact and therefore kind of the metric of informed trading. Single name markets exhibit sharply greater informed price impact than broad-based markets. And these are the two poles of the Cauchy universe. We actually did the entire Cauchy universe, calculated it for all of it, and we're really happy that these are the two at the poles. So this is what we're going to be focusing on. Spreads cannot be what sustains liquidity, particularly in the single name markets. And we're going to show that spreads can't do it. And they're only modestly wider. They can absorb at most 6% of informed flow, but what's going to sustain it is a behavioral cross-subsidy. Traders systematically overbet yes in markets that mostly settle no. And this optimism tax, which is a name coined by the literature out there now, is largest exactly where adverse selection is worst. So what's really intriguing to us, saw that growth? This thing is scaling, right? The bias is scaling with the growth. So the optimism tax is growing and growing and growing, and it's sustaining the markets. We are adapting VPIN to these markets, and we show that order flow toxicity is measurable in real time before, given the adjustments we have to make, and it predicts market maker losses, but only in the single name markets, not in the broad-based markets. And finally, we're going to argue that the canonical model that we think of, the Glaston Milgram, right, the losses to the informed are offset by the gains to the uninformed, isn't really accurate here. Market makers earn twice as much per contract on single name markets, despite facing the most informed trading. So the economics here are actually more like an insurer's than they are like a dealer's. And so it's kind of a new equilibrium relative to what we're used to. So it's been really fun to kind of play with this. Some of you may not understand how these markets work. I'm giving you a really quick overview here. Cauchy is a CFTC-regulated designated contract market. They trade binary event contracts. Each market settles at either $0 or $1. Contracts takers and there are makers. Both sides of each trade are fully collateralized, and this is really important. If you bid yes, if you buy yes, you have to post the trade price. And everything's between $0 and $1, right? So if the trade price is 60 cents, you have to post 60 cents, and the other side has to post the 40 cents. So these contracts are fully collateralized at all times. When you think about who's in here, you have to change our definitions a little bit. You know, we used to think of liquidity traders as, rebalancing portfolios for exogenous reasons. Nobody has to rebalance a contract on Jeff Bezos, right? So here we're going to argue informed traders have a belief about the outcome but no specific knowledge, right? And then, there's like informed and quasi-informed, remember Badgett, we won't go into all of that. Informed traders can be insiders, or they can be those whose knowledge gives them a betting edge over the uninformed. So we're gonna have the informed and uninformed, but we're gonna be a little looser with the definition. And the key thing here is trades are generally held to resolution. Market makers don't come in and, after immediately making a no, immediately making yes. And the reason is there's lots of reasons. One, netting is available, but only to a small fraction of traders. So most of them can't net anyway. So if you're on the yes side, and then you go on the no side, you have to post two collateral, right? So that doesn't get you anywhere. So we have also talked at length with the Kalshi people who've been very nice. Their CEO gave a talk in March, and he said that only about 5% of the orders flow involves the big guys. I think Susquehanna may be one of their players. But the other 95% are coming from 2,000 plus small market maker types who just want to be on the other side. We also check this using polymarket data, which does allow you to see, sort of how actual identities. And there, 92% of all contracts we held to resolution. So that's something that we're going to be relying on here. Remember our Bezos thing? This is what it looked like. So the blue line is the hourly price. It opened around 65. It briefly spiked at 95. Then there was the fraternity party, and then all hell breaks loose. And despite all that, the market makers made $29,000 because everybody in the beginning was taking yes and they were taking no. Then when it turned around, everybody was taking no and they were taking yes, but they still were able to make money. Now, that doesn't always happen. So there's a contract. Did Netflix say Warner Brothers in their earnings announcement? In this case, the makers get run over. So what's happening here, in this green area, that's the earnings call. And about 15 seconds in, 30 seconds in, the CEO of Netflix says, yes, Warner Bros., right? But the contract is written on Warner Bros. Yes, yes, it's true. You've got to watch the details. And so gradually, as people listened, they didn't hear Warner Bros., and then people, wait a minute, maybe this isn't right. And you see the price plummets. The market makers get run over, right? And they lose $75,000 just in the last 40 minutes of the call, and they end up just getting wiped out. So these markets are tricky little critters. There's a big literature. It starts in gambling and horse racing. There's a literature on what used to be the Iowa prediction markets. And as you can see from the dates, there is now a growing literature on prediction markets. And there's a lot of really nice work here, but we don't have time. We're going to be drawing on the usual suspects in microstructure, but we're also going to be talking about Monovan's paper in 2002, who argued that a single stock securities would have more informed trading than broader-based equity securities like ETFs. And that was the motivation for arguing a single stock being broader-based. And the Garland-O-Peterson and Powdersham paper talks about when you cannot hedge, which is going to be the case here, then you have to get a premium somewhere. And that's kind of the insurance idea. Sample period is when Kalshi starts up until March 2026. There are lots of trades. We're going to focus just on this sample of the single and the broad-based ones. These markets are weird if you want to play with them. Something like 85% of all the contracts are what are called parlay contracts. So a parlay contract, none of which will the Buffalo Bills beat the New England Patriots? Will the Buffalo Bills beat the New England Patriots? And Josh Allen tosses 2 touchdowns. They go on and on and on. I mean, so that's how you end up with so many contracts. Each trade in Kalshi is tagged to identify the aggressor, so you know the taker and the maker. So you don't need a classification algorithm. Kalshi also gives you hourly candlestick quote data. So we have at least, a snapshot of quotes in this market. And as I mentioned, we used the Polymarket data just to make sure we were right about the fact that people hold these things, but that's all we do with it. The only thing I wanted to show you in this picture is the very top. The single name sample we have basically is much smaller than the broad base, but we still have 41 million trades over four what do we get here? 4 billion, I guess. Yeah, a whole lot of contracts. So broad base is much bigger than a single name, and we'll come back to this in a minute. We're going to estimate adverse selection using Kyle's lambda in 2 forms, both raw and log odds. You need log odds in a sense because you have a 0, 1 issue here, and that's going to create econometric problems. So we're going to do Kyle's lambda in 2 ways, and we're going to do the Glaston-Harris in 2 ways. Right? Glaston-Harris is actually nested with, the Kyle is nested within Glaston-Harris, so they're not immediately independent, but they do let us know whether it's permanent or transitory. And what we find here is that the impacts are all permanent, not transitory. And we're also going to look at effective spreads. Here, if you're looking at the adverse selection measures and then you're running it on this regression, which has single name and lots of controls, which we mentioned here, you'll see that it's very clear. 1 second here. That the higher is the adverse selection, right? The higher is the adverse selection measure. Permanent. So what you're seeing is adverse selection is higher in the single name contracts, which is the main point of this paper, except when you see the effective spread. But that's reflecting staleness. So we only have candlesticks right at the beginning of the hour. So if you just restrict, to trades happening within certain time frames, what you'll see is it's only when you get more than 15 minutes out do you run into the flip of the sign. Otherwise, it's still the case that spreads are higher for the single name. But notice they're not that big. At the bottom, broad-based contract spreads are 2.21, and single name contracts are 3.73. 10 minutes. Okay, so what's going on here? Well, let's go back to that earlier picture. Here, what you see is the bias, right? Takers buy yes 60% of the time, but they settle yes only 31% of the time, right? They're wrong. They're just wrong, and they're wrong on both of them. It's not quite as big when you look at the broad base. But the bottom line is there's a huge bias here. And it's a bias because they're not right. So if you kind of look from that, we can calibrate it. So take the probability of settling yes from the yes prices, right, and plot it out. Okay, the blue one is the broad-based one. What the blue one actually shows you is interesting. It deviates a little bit, but not a lot. But the way it deviates is actually the way gambling markets deviate. That long shots, the guys down here, they tend to be overvalued. That is, people are more optimistic about long shots. And they undervalue, or they're less optimistic about favors. But if you look at the orange line, which is our single, name contracts, they're optimistic about the whole thing, right? I mean, this doesn't look like the gambling market. These guys are just, they're just, I don't know what they're up to, but they're all wrong. We can figure out profitability. And here's what's really intriguing to me. You make a lot more money as a market maker trading in these single name markets. So you can see down the mean market maker P&L is $305 per market as opposed to 69 for the broad base. They make money too, but you definitely win. Market makers win 63% see that when they win, they make 16 cents per contract. When they lose 23 cents per contract. So the only thing that helps them is that the frequency magnitude thing. I'm going to skip this. No, I'm not actually. Could you live just on the spread? The answer is no, right? Suppose the contract is priced at P equal 50. If there were 20% informed traders, then the required spread would have to be at least 11 cents, but we don't find that, right? The average effective spread is approximately 3 cents, which can offset at most 6% informed traders. And it gets worse as the price gets higher. It doesn't take long for there to be no feasible spread. So I want to go here, because I'm going to get yelled at soon. But what's driving this is this frequency magnitude composition, right? So the bottom line is they lose more on the single name, but they make more. They win more than they lose, right? That's the key. And it happens for both, but it's particularly true in single name. This subsidy is widening over time, which we found really intriguing. So, if you thought as the market matured, people would get smart, or they would actually just lose all their money and go away, that would make the market smarter. Well, that hasn't happened yet, right? They're dumb and dumber is where things are going. Why not sell yes all day, right? I mean, I just showed you that these guys are all idiots. So why don't we just, be on the other side? If you want yes, I'm no. Well, it turns out you would make a lot of money. It looks like free money. But the profit is fat-tailed. The worst markets are 100% yes settling. And so what happens is your standard deviation blows up. When you're in these worst markets, the mean is only $661. The standard deviation is 35,000, right? You get massacred. So, you can't manage that tail risk. There's no leverage, there's no hedging, there's no exit. So you can't arbitrage this thing away. And so the bias is harvested by making markets on both sides. One way to think about it is that the one side provides the revenue and the other side provides the hedge. So, can you predict toxicity? So here, we took VPIN, and we tried to figure out if we could apply it. To make this work, you have to exclude prices that are below 30 cents and above 70 cents, because as the market's near settlement, the prices collapse without trades, right? But if you look in the middle, you can calculate these VPINs quite well. I'm not going to go through how we do it, but it's the usual way. We use fixed $500 buckets, not the way we do it in some of the other markets, and using interior prices. And what you get is really kind of fun. It works for the single name markets, not for the broad-based markets. But the broad-based markets, if you're betting on whether the Fed funds rate is going to be up or down, you're looking at a lot of things in the market that are telling you information. So the flows are not as informative. But when you look here at the single name markets, it is very informative. The higher the toxicity, we use a prediction. This is cross-sectional. These are market maker outcomes. We actually can predict what's going to happen to the market maker with respect to their profits in the next bucket. And what we can show is that, in fact, the VPIN metric is predictive for the single name markets. And we control for volatility, all those things that other people don't like to explain. I only have a few minutes left. So let me talk a little bit about the regulatory issues, right? So what have we found so far? These are crazy markets in many ways, right? On the other hand, no one has to trade in them. So it raises kind of interesting questions. And the standard market quality case for policing insider trading doesn't bind here. So like when we're looking at our normal microstructure setting, we say, well, wait a minute, we know if adverse selection gets big enough, the market maker's just not going to make the market. They're going to walk away, right? But here, what do we find? The adverse selection gets huge. They're not going anywhere. They're making lots of money. So we're not seeing liquidity collapse as a reason to enforce any sort of regulatory. But fairness remains an issue, right? These markets, in a lot of ways, are not very fair. And so that creates a really interesting happens, what is, this is the advantage of working with the law prof. It turns out what was a settled question is no longer settled. So if you think about how we define, insider trading in equity markets, it's you owe a duty to someone. And if you owe a duty to someone, then you can't trade, right? And that's underneath all securities law, and it's also at the CFTC. Jeff Bezos is trading on his own Super Bowl plans, or his stepson's trading, breaches no duty to anyone because you can't misappropriate information from yourself. So the fraternity brothers can trade freely under a duty rule. They don't own a duty. But they wouldn't be able to trade under something called the parity of information rule, which says it should only be, you should only be able to trade on publicly available information, right? You think about how Australia opened, you had to do your earnings announcements in the mornings and other message stuff. In the U.S., we rejected that rule because it got in the way of price discovery. So we went with the duty rule and not the parity of information rule until now, right? So what's interesting is that the exchanges have diverged, right? Polymarket is a duty rule. And so far they haven't really found any duties, right? Kalshi has actually gone after several people for illicit trading and canceled it. One guy was running in the primary for the California governor's race and was betting on himself and others on Kalshi. They didn't think that was fair. The issues here, we don't know what the right answer is, but I think our paper makes clear some of the trade-offs you're going to run into here are the same. A parity rule chills correct side flow, which is exactly what we show is the flow of directional estimates that are actually pulling those single name contracts into true values. The duty standard preserves price discovery, but it leaves the fairness conflict. So somewhere in there, they're going to have to sort this out. Now, I'd like to conclude by talking about what I think is fun in looking at these markets. As we think about the equilibrium here, it looks somewhat like what we're used to, but not the same, right? Kind of like a zebra. It's sort of severe adverse selection, exactly where theory predicts it should be. But there's no Gloucester-Milgrom equilibrium that sustains the makers. There's no round trip, no hedging motivated liquidity traders, no feasible spread in many of these markets that can price which side the settlement will take or will land on. What replaces that is this cross subsidy. The maker is an insurer, not a dealer. They're going to make money off of what they gain, right, on the position that they took. No one chooses this equilibrium, right? It's not like it was designed this way. Yet it's been stable, right, as it's grossed up. This thing is staying pinned. So I think it's an invitation to theory. When does this ratio that allows this to occur stay above 1? How fast does it adjust to shocks? Who bears the welfare costs? I think there are a lot of interesting issues. Thank you.
We're going to adjust it. Thank you.
So that's the only thing that's good. Okay, check 1 2 1 2.
What's picking something else?
I think the camera mic is actually a little. Whoop, there we go. Check 1 2. Yeah, it's cool. It's picking up.
Once that turns back on, you should be able to see it.
It's all right. Is that going to go away?
John, the podium is finally yours.
Thank you. And I can hear the mic is on. Wonderful. I'm Joel Hasbrook, the discussant, assisted by AI in a manner that I hope will be transparent to you all. Kalshi's a prediction market. It lists contracts that pay off $0 or $1 on some yes-no condition. It's also a securities market. Liquidity is valuable. Supplying it can be profitable. In this case, sometimes very profitable. But it entails exposure to adverse selection. And by parallel with our TradFi markets, order flow we expect to be informative and priced. And we've developed many tools for analyzing these kinds of situations, and this paper applies them to a new market. So, let's start with a screenshot. This is recent from earlier this week. The contract here is, will the Republican presidential nominee in 2028 be J.D. Vance? There's a yes and a no. Yes is priced at 41% or 41 cents. No at 60 cents. You, the astute among you, will realize that this adds up to more than $1. So yes, this market has a spread, but subject to appropriate scaling, we may loosely interpret these as implied probabilities, which is a valuable thing for us to be able to observe socially. Now, Maureen displayed or discussed one of her pictures, which I think is great, and the idea is this: to measure market efficiency in these markets, we look at a sample where we have prices and implied probabilities, and then we subsequently look and see, well, are these payoffs consistent with these implied probabilities? And here's the graph. On the horizontal line is the implied probability, and on the vertical line, appropriately grouped and scaled, is the average payoff. And there's a pretty strong positive relationship here, as we'd expect. And in fact, for broad-based markets, where we presume the information asymmetries are low, it comes pretty close to the 45-degree line. But not for these so-called single-name markets. And the idea here is, in certain kinds of markets, single names, single events, information is concentrated, possession of that information might be concentrated, and the potential for insider trading is high. In the broad-based markets, it's a much more diffuse kind of thing, and the potential for insider trading is low. Marine cites Ananth Madhavan's work in the 2000s, but actually well before that, quite possibly in this very room, Subra Avanadar Subramaniam presented his work on asymmetric information in trading baskets, stock index futures. And the idea, the distinction there is very similar. When you get a portfolio, when you find some way of broadening the mechanism, you diversify the private information and you improve liquidity. So these lines tell us two things. In the blue line here, look where it deviates from the 45-degree line. At low probabilities for yes, there is a shortfall. So here, low probabilities, these are the long shots, all right? That's where there seems to be people seem to be paying too much for these bets. But look at the far end of the probability for the broad-based, again the blue line. These are the favorites, and people underpay, or the favorites are underpriced. And this is an established phenomenon in betting markets. The long shots are overpriced, the favorites are underpriced, and one of the big contributions here is that Marine and Bobby are extending this, or have found a set of markets for which this overpricing, or rather the underpricing, is much more pervasive. And these are the single-priced, the concentrated markets. I think this is very persuasive evidence. Is it a behavioral bias? Well, I'd like to give a shout out for a paper by a colleague, Goodman and Indira Puri, Overvaluing Simple Bets. And Indira and Adam looked at an early binary options market. This was Nadex, which existed before Kalshi. They specialized in retail options, and what they found was that these options, people were paying too much for them. They were dominated by the bullish spreads in listed call options. So Puri and Goodman interpreted this as a simplicity premium. It's not that people are being fooled or misjudging the probabilities. It's just that they're willing to pay a little bit more for something that is much easier to understand, a binary option. And this, I think, remains sort of in a possible follow-up thing that might be investigated here. Now, who is selling these overpriced contracts? The market makers. So one hypothesis is maybe this is just, we've seen this before in dealer markets. Dealers charging excess spreads And maybe there are barriers to entry here. So we ask AI, what is the market structure? It's a limit order book. Really, can we see a screenshot? Yes. And we can look at the API documentation. Maureen didn't show you a screen like this. She could have, but the available data sets do not yet provide the level of granularity we need to thoroughly analyze this aspect of the market. But here, and you've seen these screenshots from, everybody in this room has seen them, from equity limit order books in, listed stocks. And so here is the limit order book for J.D. Vance. Best bid is 40, lowest ask is 41. The limit order book is deep, all right? So here are the endpoints of the price range, all right? And I remind the current price is around 40 cents. Even as we get very close to zero or very close to 99%, the book is very deep. By TradFi standards, this is kind of unusual. Usually as you get outside of the current trading price, the book gets virtually empty. Not here. So, what else might be going on? One way that market makers get a lot of excess revenue is by having a high tick size. It prevents price, thank you, Paula. It prevents price competition. So AI, what is the tick size in this market? It's 1 penny. Spoiler alert, I'll come back to that. But if true, this would be pretty large in our current frame of reference. Relative to a price of 40 cents, 1 penny is 250 basis points. To translate it into more familiar microstructure terms, I mean, this would be like a 25-cent spread on a $10 stock. Can you imagine this? Are Bill Christie or Paul Schultz in this room? Well, yes, we can imagine it very well. It would not surprise me if they delivered their work, now about 20 years old, in this very room. So this is not beyond the realm of comprehension, but it was regarded, shall we charitably say, as anti-competitive. But wait a minute, AI. When we were looking at some of those screenshots, I know Hasbrook flashed by quickly, but I thought some of those prices had, they were like 2.3 cents or something like that. What's going on? And AI, you've done this. Sorry, let me clarify. Kalshi does reserve the right to change the tick size dynamically on its own initiative. Oh, that's interesting. So, AI is in fact much more emphatic about the point. If you are trading on Kalshi, it advises, don't look at any of the static online documentation about tick size. These things are changing all the time. Make an API call, make sure you have the current value. Check. And the answer is, Kalshi usually uses the finer tick size, that is of 1/10 of a penny, near the 0-1 endpoints. If I could turn the calendar back, also it's quite possible in this very room, Larry Harris presented his views on tick size, which basically said if you want to facilitate efficient trading, you scale the tick size with volatility. What does the variance of a Bernoulli distribution look like? Well, It's parabolic. And look at the endpoints. The volatility, the variance is low, approaches zero, and this suggests that at the lower end of things, or either as we get close to 0, 1, yeah, that's where we are going to want a finer tick size, and that's what Kalshi is doing. It kind of makes sense. Whereas we also know that markets have maker-taker fees. Kalshi also imposes them. They are high. They are high. It's true, the maker fees are lower than the taker fees, but they are still fees. They are not rebates. So the barriers to supplying liquidity are, they can be substantial. Also, the fee algorithm, and this is interesting and bears follow-up, it scales like a Bernoulli variance. So if we're in the middle of the probability distribution, the fees are going to be relatively high. The fees get lower as we get towards 0 and 1. I have a couple of conjectures. One is that it's going to discourage production of information because when we're in the, when uncertainty is high, which probably isn't a good thing, or from the viewpoint, thank you, of the market maker, this is going to tax the market users more when their hedging and speculative needs are highest. So in a way, it's kind of shrewd. Oh, what did I do here? Okay, are there other barriers to market entry in this wonderful game of market making? Ask AI. Well, let's say, just the usual. They do. The institutional traders do have access to faster APIs. There are certain kinds of liquidity subsidies, which Maureen and Bobby note. They say the impact is minor. I have no reason to doubt this. But I do not, are any of the Kalshi designated market makers Kalshi affiliates? Well, in TradFi markets, this is not a no-no, but it's something that we kind of view with a little bit of suspicion. AI says yes, it's plausible, not confirmed. Also, AI says the general terms between Kalshi and its market makers are not uniform and they're not publicly disclosed. Also plausible, but I emphasize I haven't been able to confirm this. Another big contribution of Maureen and Bobby is that their view is that in these markets, market making is very different. In the classic sequential trade models, there is, the market maker can widen the spread, but they go on. The canonical prediction does not stop there. It holds that the wider spread compensates the market makers, and the balance is struck when the dealer completes the round trip and ends flat. Kalshi market makers, they claim, do not do this. They hold their positions until settlement, and as a result, they say their market making resembles underwriting more than intermediation. Now, I point out in the classical sequential trade models, Gloston Milgram to be sure, but also Easley O'Hara Paperman, Easley O'Hara again and again and again. Sorry, Maureen, I remember, I read them. Thank you. There is no presumption in these models that a round trip is either feasible or necessary. Right? It's all driven by conditional expectations. So our HODL market makers, HODL, hold on for dear life. That is, you don't, dear life being eventual settlement. I would have liked to have seen here, and I think in a couple of years we probably will see it if these markets survive, position data on market makers. They're difficult to get, but I think if these markets survive, we will be able to answer this definitively. So are market makers truly uninformed? Darn it, but Maureen has written another paper on this with Gideon and Rob Bloomfield. We find that informed traders do use limit orders, and liquidity provision shifts toward the informed traders. So jump trading is an AI, according to AI, is a market maker on Kalshi. And I saw a few of you, when just the mention of jump trading, and you check to make sure your wallet's still there. So, and a related rhetorical question, do market makers have market power? The discussion here would deserve, the appendix would observe a session of its own here. It is fascinating, the diversity of the contracts and the uses to which they might be put. It is indeed a brave new world there. But in summary, what I think the paper convincingly establishes is the exposure of market makers to informed traders, a pervasive overpricing in the yes bets that these market makers are selling, and there's, I'll grant, some suggestion that the market makers have turnover that by TradFi standards is low. But this paper is, it's going to be shedding forth many seeds, and I'm expecting a lot of follow-on work here from the authors, but also from the rest of us in exploring these new markets. Thank you.
Thank you, Joel. I would suggest that Maureen takes a few questions from the audience and then addresses whatever she wants to address. Okay, discussion in the audience. So, Gideon first.
I was wondering, you mentioned that there's no netting in this market, and A, do you know why? And B, do you think that if there were netting, that would actually bring it closer to the Gauss-Milburn model, and whether you can test it, because you said that there's some contract with netting.
So here's the issue. I mean, we have spent lots of time talking to the Kalshi people. They're very nice. So far, we haven't gotten anything out of this, but you know, they're very nice. All the questions Joel had are the same questions we have, right? I mean, and that's why we went to the Polymark data, which has wallet risks, right? We don't have those in Kalshi, but Polymark doesn't have what we have, so there's a trade-off. What my understanding is that you have to be an FCM in order to be able to net, all right? So if you were an FCM and you were a market maker, you might be able to net. But according to Kalshi, at least 95% of market makers are not FCMs, right? So the netting part, and when we went over to Polymark, we found everybody seems to be doing it. So, we were clear, I think, in the paper that, we're making this assumption, it seems reasonable, but we'd all have better data, and that's what we're asking the Kalshi people for. One of the interesting questions is who are these market makers, which is what Joel raised and others. They do have this little subsidiary, but the interesting thing to me also is that some remarkable number of total contracts, like 60%, never have a single trade. Right? And of course, it's these parlay markets, right? There's never a single trade in any of these things. And so, again, get trades into things that aren't trading, right? But since they're not trading, this isn't going to be very important for our study. So I would love to know more about the netting, but for now, given the data we have, this is where we're at. And we became convinced, particularly after we looked at Polymarket, that it wasn't an unreasonable assumption.
So Clara really wants to know what the scale of the model. In terms of the prediction, you leave out the extremes, right? The
Yes,
20%.
and we leave out sports.
Oh, you leave out. But
We leave out sports, we leave out weather. No, don't even start with weather. We really just wanted these things that, single name, right? And again, we don't even do what you just saw here on the presidential stuff. We don't do it, because there are multiple names there. The problem with those is that they can add up to more than 100%, and that's called the overage in Vegas, right? We don't want to go there. So I don't know about Spain.
no, but in terms of ability to forecast,
Yeah.
given that you're leaving out the extremes, can you really forecast using this, or how far ahead?
Some of these do really well, and in the appendix, we actually do show that, that graph, the picture that Joel liked, with the orange and the blue, we did the same thing for all the other contracts. And what's interesting is it's a single name who's unusual. The others look more like the blue. They really are much closer to being accurate prediction models. So, you sit back and you go, why do we have these things? Well, they're actually not that bad at giving information. Sorry? Oh, hey, Chris? Yep. Right. Yeah. It's so interesting, right? Because it was, the reason this thing exploded when it did, right, was that calcium seed to CFTC. And because prior to that, these things were all regulated by state gambling laws. And that was like the end of the game, because they're pretty tough. But they started saying, no, we're not gamblers, we're swaps. And then the judge who settled the thing said, well, all the regulators involved some sort of gamble, so I buy it. And that opened the floodgates, right? But it opened the floodgates by getting rid of all the gambling regulations, not replacing it with all the other regulations. And so now is kind of a really cool time to be thinking about what, if anything, do you want to do? I mean, these are presumably consenting adults. If they want to throw their money away betting on U.S. soccer, go ahead. So I mean that's an interesting debate, which I pose to people.
found more surprisingly from Joel's discussion, what is the explanation for this deep limit book that we see in this?
You know, those are really good points. I don't really know why there's a deep limit book, except that there are just lots of people who want to be in these markets. And I mean, if you notice the example he gave, there were tons of people who were like 99.8% saying no way, right? I mean, these are cheap markets, right? You know, so I think they're alternatives to the lottery and to other things. Unfortunately for crypto, a lot of the Reddit crowd who used to keep those crypto prices up are now over here playing prediction markets and crypto is back in the winter, right? So these are all really good questions, and you know, I can't say that I necessarily know the answer to them. But the Iowa prediction markets, which, you know, I referenced some papers, they did actually a really good job of predicting presidential elections. And so, you know, there is a role, I guess. And John?
So, the next frontier are perpetuals, either contracts for perpetuals or possibly sort of wrapping a perpetual in an ETP. Have you considered what the implications are for phones and so on structure?
No.
Okay. That would be a really
interesting paper, and we you know, this paper at one point was 100 pages long because we had a section on the behavioral thing. You know, was this caused by behavioral thing? And then we had to read all these behavioral papers and, you know, what could cause it? And this paper is begin with like a dissertation and sort of jettisoned that. And we honestly finished this version of the paper 2 weeks ago, and I apologize to all because we did send it to them on July 2nd. So we haven't thought about it, but, you know, I mean, everybody is getting into this market. I think NASDAQ is getting into this with a prediction contract on NASDAQ 100. And, you know, by $1 at a time, you too can get into this. So, interesting market.
CME is getting into binary contracts as well.
Yeah.
So, right, it's a formal contract that people are very good.
Isn't that interesting? Yeah, I'll look into that. Thanks, Jonathan. That's really interesting.
All right, let me take one final question before the coffee break, please.
You guys, let's get started. So our next presenter will be Alan Hu from UBC.
Thank you very much. First of all, I'd like to thank the organizers for having our program, our paper on the program. Very excited to be here presenting our recent work in elastic demand at the extensive and intensive margins. This is joint work with Cindy He at Georgia Tech and Zigang Li from University of Toronto. He's an amazing PhD student staying over there. He actually has 2 papers on the program today, and he will be on the market later this year. The motivation for this work is very straightforward. The recent development of demand system asset pricing highlight the importance of studying asset market quantities such as investor demand and flows. They can be very important for us to understand prices and market dynamics. It's a fast-growing literature that has delivered a lot of interesting and important findings. For example, financial markets are actually quite inelastic, especially when we compare the estimated elasticity to what classic series would imply. Second, there exists substantial heterogeneity in investor demand and its estimated elasticity. Well, what are the potential explanations or micro foundations for these findings? And that's this paper is about. Of course, one can always go to preferences, beliefs, but we will focus on information in this paper. The reason? Because a lot of work in demand system asset pricing assumes homogeneous and complete information. As a result, we view focusing on information, adding more richness to the informational dimension could be a particularly promising path. Okay, in this paper, we're going to add information heterogeneity. We're going to add learning from prices to demand system and an inelastic market framework. And we hope to provide an information-based microstructure foundation to help us better understand market macrostructures such as elasticity or investor heterogeneity. Okay. The ideas of this paper will be twofold. First, it will be a very simple empirical exercise that decomposes investor demand onto its extensive and extensive margins. It is very intuitive. Extensive margins is just trading at the entry and exit, initiating or liquidating a position. Intensive trading is just rebalancing, scaling an existing position up or down. Empirically, we show that these 2 margins, they have different drivers, they have different impacts, they have different estimated elasticities, with extensive elasticity to be with extensive demand to be more inelastic. And such a decomposition allows us to introduce rich but disciplined heterogeneity to investor demand. Second, we're going to do learning from prices with extensive flows. To account for the empirical findings I just talked about, we extend Grossman-Stiglitz model with the existence of extensive flows. And this will show that learning from prices contributes to inelastic market and actually allow for the possibility of positive elasticity. Correspondingly, we have 2 contributions. First, we propose a new informational micro foundation for low and even positive elasticity. And second, we're able to unpack the previously unexplored heterogeneity in investor demand and elasticity. For example, making the distinction between extensive and intensive demand is half as important as AUM, investor size, and as important as investor type. For example, it is a hedge fund or it's a mutual fund in explaining investor demand heterogeneity. Quantitatively, that's 10 to 20% additional variation explained. The paper will have 3 components: a set of motivating empirical evidence, a stylized model that accounts for those findings, and finally a structural estimation put the model into work. First, empirical evidence. We find that extensive flow is economically large. On average, it accounts for 40% of institutional and 80% of retail flows in aggregate. And empirically, those 2 flows are different. They have different drivers. Extensive flows are driven by attention and past returns, while intensive flows are driven by fundamental news. And they relate to contemporaneous and future returns in different ways. And our interpretation is all these differences can be driven by differential informational content. At a stock level, if you aggregate those flows and calculate the flow decomposition of extensive versus intensive, you'll find this explains returns volatility and price informativeness. So flow composition can be a very important dimension of asset heterogeneity as well. With this empirical facts in mind, we built a two-asset growth span cyclics model with the existence of extensive flows. There are two key elements in our model. The first is, of course, extensive flows. Because in our model, investors switch among stock, entry and exits, leading to flow or trading at the extensive margin. However, those flows are not observable in real time to market participants. So we call that unobservable extensive flows. Essentially, those flows serve as endogenous demand shocks in our system. The second is learning from prices. But beyond the standard learning from prices in growth span cyclics, investors in our model need to extract information from prices under this unobservable demand shocks. So they're going to disentangle two forces that potentially drive prices. First is news on fundamentals. That's the information they want to infer, they want to learn. The second is those unobservable extensive flows. As a result, they need to form their own beliefs about those extensive flows. Okay. What does the model buy us? How does this connect back to market macro structure, demand elasticity? If we think about the standard current normal benchmark, demand elasticity can be easily derived as risk tolerance times signal precision. Right? We can derive the investor demand over there, and we calculate the partial derivative. It's very simple. In our model, we'll still have the similar structure, risk tolerance, signal position, but two additional items that leads to lower and even positive demand elasticity. The first item is learning from prices. In our system, price will have two opposite effects on demand. The first is standard downward sloping demand curve. Price goes up, cost goes up, all else equal, expected return goes down, the investor want less of that asset, downward sloping. However, because of learning from prices, price also serves as signals. So price goes up as a signal, it is a positive signal about asset fundamentals, so investors want more of that asset because they're positive beliefs about the fundamentals. So those two effects work in opposite direction, leading to a less elastic demand. Second, we have this additional effects from flow expectations, and which I will elaborate later, allows for possibility of positive elasticity, which contributes to inelastic market. Then we're going to embed this stylized model, expand it to multiple asset, and that's a multiple asset demand system with heterogeneous information. We use GIV to separately identify elasticity for extensive and intensive demand. And we find that extensive demand is indeed more inelastic, with estimated elasticity to be 0.34, with intensive elasticity to be 0.43. Making the distinction between extensive and intensive demand explain 10% additional variations in the demand from the baseline of 20%. We're also able to do a counterfactual analysis based on our estimated model, and we find that if you increase the composition of extensive demand, price volatility and firm-specific price informativeness will go up on average, while market-wide price informativeness will go down. However, I have to acknowledge that our counterfactual analyses are subject to a lot of limitations, and as pointed out by recent work by our discussant Valentin, so we're actively working on to make this counterfactual better, and so we're working on improving it. Okay, now let me get into details. First, I will show you a set of motivating empirical evidence. The data we use in the paper is very straightforward. It's quarterly institutional holdings from 13F. That is our mean sample. All the results, empirical analysis show you today based on this sample. We have a separate sample that is Odin retail data, that is transaction by transaction, and we'll also compile a monthly holding out of those transactions. That is mainly for external validity and validation. And then we label each position, each flows as extensive or intensive, depending if it's new position initiated, or liquidation, or scaling existing positions up or down. Of course, if we only have the data of snapshots at the end of a quarter from 13F, we miss a lot of information and activity between the quarters. So there might be potential measurement errors. I would like to argue that this measurement error is likely to attenuate the results, and we did some robustness tests. First, that's why we use the why we need the Odin data. First, we use transaction by transaction data from Odin, and we show that our results are robust there. Also, we use data with higher frequency, for example, some monthly mutual fund holdings, and our results still hold there. Okay, now the first result. Extensive flows are economically large. Here I'm showing you the time series of aggregate dollar flow composition for blue line, intensive demand for intensive flow, red line, extensive demand. This is for institutional investors. About 40% of institutional flows are actually at the extensive margin. And second, extensive flows are likely driven by investors actively switching among stocks instead of mechanical factors such as index inclusion, exclusion, switching stocks, index inclusion, exclusion, mandate change, or liquidity shocks. Here I'm showing you flow composition by 5 active share groups. On the top, it is most passive. The bottom is most active. You can see for the most passive group, think about ETF, extensive flow is about 20%. But for most active ones, such as hedge fund, it is larger, like 50%. So it's driven by investors switching among stocks, which motivates our modeling choices. Third, we relate extensive intensive flows to returns. For first, contemporaneous returns. You see extensive flows strongly positively related to returns, while intensive flows strongly negatively related to returns. However, if we look at returns over the next period, next quarter, that pattern flips, with extensive flows strongly negatively related to returns in the next quarter, and a weak, insignificant positive relationship between intensive flows and returns over the future. Our interpretation is there's non-fundamental price pressure from extensive flows that will eventually revert in the next quarter, and this is consistent with inelastic and uninformed extensive flows, with extensive flow to be uninformed, momentum kind of trading, and intensive flows to be relatively more informed and contrarian. And finally, I want to show you some suggestive evidence about what may drive extensive and intensive flows. Here I'm running a panel regression on the investor by stock by quarter panel. So this will be essentially a holdings data. I have 2 sets of fixed effects. Investor by quarter fixed effects account for all investor level time varying shocks, such as liquidity needs, fund flows, and also have investor by stock fixed effects account for time invariant investor by stock habitats or preferences. Having those 2 sets of fixed effect make my estimate effectively a within portfolio design. Think about this as a quadrant mean within estimator. I'm comparing for the same time for the same investor within her portfolio. Will she trade 2 stocks differently if those 2 stocks have different characteristics? For example, if one stock has higher social media attention, has larger size of social media sentiment, that will actually significantly increase the probability for an investor to trade that stock at the extensive margin, more entry and exit. But those effects are largely muted for intensive trading. If we look at past price movement, that's the absolute value of return, it'll also significantly increase the probability of entry and exit trading at the extensive margin, but decrease the probability of rebalancing. If we look at fundamental news, such as earnings surprise, the pattern actually flips. That will increase the probability of rebalancing trading at the intensive margin, not extensive margin. With all this, so to wrap up, extensive flows mainly driven by attention, past price movement, relative uninformed, and intensive flows react to news on fundamentals. The relative informed, this motivates our stylized model. Our stylized model is actually a simple twist of Grossman-Stiglitz, 2 risky assets, 2 investor types, 3 time periods. We have 2 types of investors: intensive investors, extensive investors. And intensive investors are standard. They hold both assets simultaneously. And extensive investors, they can only hold 1 asset at a time, and they switch between 2 assets. We call that holding capacity constraints, maybe due to limited attention or other type of frictions. On top of this, extensive investors, they have access to signals on fundamentals, while extensive investors, they don't. They're going to learn from prices to infer those signals. As I mentioned, there are 2 key elements. Unobservable extensive flows serve as endogenous demand shocks, and learning from prices, where investors need to disentangle 2 forces, news on fundamentals and unobservable extensive flows with their own subjective beliefs about those flows. Let me give you the details through the model timeline. Day 1, nothing fancy, nothing new, just an initialization. We have two assets, A and B. Intensive investors hold both assets. Extensive investors choose to hold one of them, A or B. In equilibrium, we're going to impose an indifference condition, making extensive investors indifferent between holding A and B. That yields two equal Sharpe ratios. We solve the standard current normal optimal demand and no signal yet, so both types will have the same prior. We impose market clearing, we solve the equilibrium. It's very standard. All interesting dynamics happen day 2. Intensive investors will be able to observe two signals, eta A and eta B, about the fundamentals. Think about earnings. And extensive investors, they're going to learn from price. They look at price PA and PB, and then they're going to infer the fundamentals. Because they can switch, some of the investors will move from A to B, some of them will move from B to A. But those movements or those flows, MB and MA, are not observable in real time to market participants, so investors are going to form their beliefs about those flows, M tilde, A and B. Then we solve the demand for intensive investors against standard current normal. Extensive investors, standard form, but with two additional terms. The first is learning from prices adjustment, and the second is flow expectations. We impose market clearing condition again. We have a linear price function where price loads on fundamentals and start standard noise trader demand, and also mean flow expectations with a negative coefficient I would like to emphasize. How to interpret such a negative coefficient? When mean flow expectations very high for the market, that means on average, the investor believes a lot of new investors come into this asset. So they are going to interpret price increase or attribute that more to newcomers instead of positive update or positive news on fundamentals. As a result, there will be a negative effect on the demand, a negative effect on prices. The main take of the model is about the demand elasticity. We derive demand elasticity for intensive investors and extensive investors. It is standard current normal risk tolerance time precision for intensive ones. For extensive ones, there are two more channels to make extensive demand less elastic. First is this learning from prices term. Mathematically, common gain is greater than 0. So part of the price increase is interpreted as good news on fundamentals, not just a cost increase. There are two opposite forces that makes the demand curve less elastic. And second, we have this effect from flow expectations that makes positive elasticity possible under this condition. How to interpret this? It says the partial derivatives of flow expectation with respect to price should be negative and should be below a certain threshold. Economically, that means investors may be overly attributing the price increase to good fundamentals instead of newcomers, instead of investor entry. In that case, there might be positive elasticity. We have other model predictions with some empirical evidence, such as extensive flows may amplify news, may amplify price fluctuations, may affect price informativeness. Okay. Now let me put the model in a structural estimation. It is an otherwise standard demand system with characteristics, expected payoffs, and risks, loads on those stock characteristics observables. There's one thing we relax from the stylized model to make this estimation model better fit the data, is we capture whether an investor trade a stock at the extensive or intensive margin through this selection function. In our stylized model, investor types are fixed. You're either intensive or you're extensive. But in our estimation model, investor I can trade a stock at the extensive or intensive. They can switch types across different time periods captured by this selection function. And then we derive investors' optimal demand and its corresponding estimation equation. The first term is demand elasticity, and we're able to identify the intensive demand elasticity and the extensive demand elasticity. And following the literature, we interpret those elasticity as a relative elasticity. The second term is this flow expectation, and we captured or we estimate the sensitivity of demand to expected flows. And the third term is standard characteristics effects on demand, and also have fixed effects to account for liquidity needs and fund flows. we have three ways to empirically model the flow expectations. The first is a statistical benchmark where we use Lasso and public informations to generate statistical predictions and as flow expectation. And the second is extrapolative expectations that loads on past flow realizations. And then finally, we have social media attention proxy, which we view as a shifter of investors' flow expectation. If you see a lot of discussion happening on Twitter about a stock, investors may be more optimistic about there are a lot of new investors coming to that stocks. For identification, we follow a standard in the literature using granular instrumental variables and identifying assumptions. Instrument constructions are all quite standard. Now let me show you the estimated result. First is estimated elasticity. As benchmark, we have Cohen and Yogel's JPE paper, original estimate 0.38, and we also replicate their demand, logit demand system on our data using our instrument, and we have a pretty close number, 0.4. These two estimates pulling extensive and intensive demand together. For our own estimate, we're going to separate them. Here we can see those orange ones, those are demand elasticity for extensive margin, are smaller than blue ones, intensive ones, which is consistent with our model prediction where extensive demand is less elastic. How about the heterogeneity? We can first look at activeness. Here I'm showing you the elasticity wedge or the elasticity for extensive and intensive demand for different investors with different level of activeness. Left-hand side, that is the most passive one. Right-hand side, that is the most active one. For example, if you look at the most passive one through the most active one, the first pattern jump out of the data is those orange bars, they're kind of flat. Those are elasticity for extensive demand. So the first takeaway is extensive demand, consistent with our model prediction, is always inelastic. But if you look at intensive demand, along with the activeness, if the activeness goes up, elasticity for intensive demand also goes up, those blue bars. So our interpretation is extensive versus intensive first is an important separate dimension of heterogeneity beyond passive versus active. And also, elasticity is a very informative and useful data moment to tell us which trade or which type of investors might be more informed. For example, if you look at this data or this result, active intensive trader seems to be the informed arbitrageurs that we have in mind. We can also generalize those heterogeneity analysis. Here, I'm doing a sharply open decomposition to say, hey, which dimensions explains the most of the variations in estimated elasticity? You find time fixed effect, activeness, investor size such as AUM, investor type are all important. But on top of this, if you make the distinction between extensive and intensive margins, and that will explain additional 10% of the variations. We have a counterfactual analysis, as I mentioned before. That subjects a lot of limitation. We're actively improving this, but if you take the face value, increasing the share of extensive demand will increase return volatility and have state contingent effects on stock-specific informativeness and will lead to a decline in the market-wide informativeness. Okay, now let me wrap up. This paper has three components: a set of empirical results that decompose investor demand onto its extensive and intensive margins. By doing so, we introduce rich but disciplined heterogeneity to investor demand. Second, to account for these findings, we have a Grossman-Stiglitz model featuring learning from prices with extensive flows that allows for lower and even positive elasticity. And third, we structurally estimate the model with a demand system with heterogeneous information that increase the explanatory power of demand system. Overall, we view demand elasticity as a pretty useful data moment to study market micro and macro structure, such as which investors are more informed, how do investors form beliefs about trading flows. Overall, we think a lot of exciting work to be done at the intersection of information economics and the demand system as a pricing. Thank you very much for your attention. And I very look forward to volunteer discussion.
So our discussion will be Valentin Haddad from UCLA.
Thank you. Thanks for the organizers for having me. I'm not a frequent member of this group, and it's very interesting to be part of this today. If you come from microstructure, like most of you, many things in this paper should look familiar. So we're talking about trading flows. We have something like a Grossman-Stiglitz model floating in the background, but also some of it is probably more remote in the sense that we're not really focusing on very high frequency trading or just relatively high frequency trading. We're focusing on kind of returns, volatility at rather low frequency, at quarterly frequency. And the focus on the paper is also to look at a very broad section of, I would say, investment styles more so than trading styles, like different holders of assets and so on. And so on this background, I want to tell you, welcome to Market Microstructure. So I think the name of the group has changed. Now we are two families, and hopefully we can come all together. So what I said I would do is I would tell you a little bit what I think is microstructure, and then I'll go in the paper. So what we think about microstructure is something we kind of started to think with Tyler Muir as a kind of an umbrella for a bunch of research that happened more on the kind of macrofinance side of the world. And the idea was to say, well, the broad organization of financial markets, so who are investors in markets, how markets are organized, or institutional features and so on, affects the level and dynamics of prices. Okay? And again, the long-term level of prices. Some examples of that people have worked on, me included, is, in 2008 we worried a lot about intermediaries getting in trouble, creating a crisis, and so on. So there are different investors than the regular investors. Some investors that are typically boring for, I would say, some of microstructure are kind of inelastic or passive investors. Are the investors that virtually never trade. Well, if you step back and look at the overall market, they hold a lot of assets, so you start to have to worry about them. Another kind of shift that you can think about is central banks. So central banks have been very active players in asset markets, and that just changes the equilibrium in markets. Finally, there's also something coming from the side of corporations. So Mao and his co-authors has some interesting work on how corporations do a lot of repurchases. It's going to change where the supply of stock is in the economy and who holds those stock. And relative to microstructure, there's a lot of commonality. I think one big difference is we focus more on movement in prices at much lower frequency, so either kind of permanent change or long-term change, and we focus a little bit more on the level of holdings rather than changes in holdings. So maybe we focus more on holding than trading. Of course, all of this is a little bit blurred, and it's blurred not only in terms of what does it mean to go from low to high frequency, but also in terms of methods. So there's a lot of methods in that literature, and they have a lot of similarities and complementarities, I think, with the more standard methods in microstructure, and I think a lot of this needs to be explored and should be explored, and I think this paper is part of the work that starts to explore those connections in more depth. So let me go now to the actual paper. So this paper, the kind of central idea that everything revolves around is this idea to say, well, there are two different types of trading within the same investor or the same institution. There's the intensive margin and the extensive margin, like in everything. So intensive margin means you already own an asset and you can scale up or down your position. Extensive margin just means initiating or closing a position altogether. And what Alan showed us is that those two types of trading exhibit very, very sharply different properties. So extensive trading seems to kind of follow past price increase, follow social media excitement, like you buy when there's excitement, you sell when there's no excitement, and it predicts negative returns. It seems to kind of trade in the wrong direction. And at the opposite, incentive flow, so this kind of adjustment people make to their portfolios, they appear much more related to fundamentals, and they seem to predict positive returns. So they seem kind of trading in the profitable direction. If you translate that and add a little more structure to the data, you start to see that extensive demand is more inelastic than intensive demand, meaning it's kind of better at arbitraging movements in prices, and sometimes it can even be upward sloping, so it's really going in the wrong direction. Okay. And then a lot of the talk was kind of taking idea from a model to the data, and the basic idea in the model was say, well, there's different types of learning when you trade at the intensive and the extensive margin, and there's some notion of misunderstanding of flows. In Alan's talk, it was keep coming back to the idea of like, there's this flow perception term coming. So I'll try to take you through some variation of these ideas. Okay. So what I want to do in this discussion is first kind of tell you about the basic setting and this difference between intensive and extensive trading, and roughly you said I'm kind of convinced that these are very different, and show you again why. Then I want to think about kind of the theory behind what's going on, and I'll do a slightly different, I'll sketch, I would say, a slightly different model than Alan, but that has a lot of the same features. And finally, I'll try to think a little bit more about why in the first place we want to look at intensive versus extensive trading. So these are two big groups, in a way. Why did we choose those groups? Why are they interesting? And what do we learn about them? Okay. So in the data, intensive and extensive trading does look different. So this is a plot that Alan showed us briefly, or maybe did not show up today actually, which is to say, well, look at trading. And here, just to be clear, trading means trading at the quarterly frequency. So you're looking at 39 filings of institutions. So every quarter they give you their positions. It's not really a trade, but that's what we can do at low frequency. And that covers a whole lot of the universe. So the first point is, how much you trade relative to your total position when you first enter a trade. The last point, all the way to the right, is when you exit your trade. And the blue bars in the middle is, the first couple of quarters afterwards and the last couple of quarters before the end. And you can see that roughly you do a big trade. Typically when you enter a position, it's almost as big as your maximum over the life of the position. When you exit, you also exit in a big chunk, and in the middle you do small adjustments. Actually, this plot is not quite enough to tell you do small adjustment, because you might do either zero or big adjustment, but there's more statistics in the paper that show you these are actual small adjustments in the middle. So it looks like you do kind of two different styles of things. The entry and the exit are big chunks, and in the middle you do very small movements. So what they're going to do in the paper, they're going to split out those two things. They're going to split out those two things for each investor, but you have to think that different investors do different amount of those things. You probably cannot read any of that, but this is just kind of splitting by investor types, intensive, extensive, and say which part of their trading is of the different types. And you can see, not surprisingly, that retail investors do a lot of extensive margin. They enter position, exit. They don't really adjust their positions. At the opposite end, you have stuff like insurance company, mutual funds. On the right is by active shares, so you have to think of passive investors. They're kind of the opposite. Passive funds are the opposite. They own kind of every stock, and they just kind of rebalance a little bit here and there. Okay? So when we're going to look at the data, we're going to kind of mix together different people doing different style of trading, and within the same person doing different style of trading. Okay. So we're going to go to kind of like put more structure on the data, more interpretation of the data. And here, the authors use this language of demand curves. So it's not always how we sketch that model. I really want to call this a language more so than a model, in the sense that most models actually have this structure. And it's just a way to start measuring things in the data before we put more information about the details. So the way to think about this is to think, well, when there's a change in quantity demanded or quantity held by investors, it can be for two reasons. One reason is the price has changed, fixing everything else constant in a way, and investors are adjusting their position. So that's going to be this first term. This curly EI is the elasticity of investor I. That's what we're going to call the demand elasticity. But of course, many other things can prompt trading. We're going to put that into the rest, epsilon I. It's not noise, like this is actually very meaningful. It's just the shift in your demand curve. Okay, so the demand shock, what it is again, anything that would shift your demand if the price would not have moved. So fundamental news, if you heard the company is better and the price has not changed, well, you're going to buy more. Changes in belief could be rational, irrational. It can also come from changes in your ability to hold assets. If you're a big, I don't know, intermediary and you get into a lot of trouble, you're going to sell assets. And it could be, in our models, could be noise trading. That's something that truly is noise. The demand elasticity is really how you respond to the price, holding everything as constant. So the way to think about this is, you kind of hear there's a better deal than before, to some extent. How much do you come in? And so in the simplest model is how you respond to change in expected return. So 1 over gamma sigma square, kind of our usual formula. If you're a noise trader, that's the opposite. You don't respond to the price, you're just a noise trader. But many forces can change that. So I've worked a bunch on like mapping our standard models of trading to this language. So what you can see is if you have models of learning from prices, you're all familiar with this effect. Well, when the price goes up, it's not just asset is expensive, also probably there's somebody else in the economy has news about the asset. So it's going to make you less reactive when you trade. Liquidity also kind of works like that. If you worry about your price impact of trading, you're gonna trade less aggressively. This is Kyle's lambda. Okay. And so the idea is going to be say, well, let's try to go and measure those objects. So in particular, try to separate this elasticity from the demand shock, and then we'll try to put a little bit more structure and try to understand better where those numbers come from. So the way, in the data in total, or in the world even, there's a fixed supply of shares. So markets have to clear. So when somebody buys, somebody has to sell. So the sum of change in demand across investors has to be 0. What I mean is, if you just put things in, any change in price has to come from those demand shocks that I started with, and then we move along the curve. Okay. In the paper and in the presentation a bit, there's a little bit of kind of like, I would say, hazardous language about kind of what is impact, what is causal, and so on. From the point of view of each trader in this language, your position is affected by the price and by your demand shock. But if you zoom out from the point of view of the equilibrium, the price is affected by the total shock in the demand curve. But the realized demand and the realized price, it's hard to say demand affects the price or price affects demand. Like this is all just an equilibrium. And you know what should be obvious to all of you is when I said elasticity is not the correlation of the price and the quantity exactly for this reason. You might buy more because you're moving along your demand curve, or you might buy more because your demand curve shifts. Okay. So what do? They're going to try to do a decomposition like that with different demands, but here different demands is not going to be so much different investors, but different types of trading. So that's what I would call a kind of schizophrenic decomposition. So you look at one investor, and inside of their mind, they have two different, inside of their head, they have two different minds. They have the extensive trader and the intensive trader. So we're going to split those two together, and we're going to pretend in a way that each of them has its own demand curve. And we're going to look, do they look different? Of course, it's nice, it's convenient in terms of measurement and so on to do that, but the two minds have to connect sometimes. So the simplest way to say that is to say, well, you cannot do intensive trading if you haven't entered a position. And once you exit the position, you cannot do it anymore. So those two things are connected. The paper doesn't really go into connecting them, but at some point you will need to connect them back together. Okay. Now, a lot of the motivating fact, and I'll tell you what's on this graph. I realize you cannot read this. That Alan showed us, what kind of, at least visually, you can see we're telling us intensive and extensive traders go in the opposite direction. So for the top graph is the relation between how much extensive buying is going on and returns contemporaneously, and it's positive versus it's negative for intensive trader. That's the bottom graph is predicting future return. So if there's more extensive buying that predicts lower return, more intensive selling that predicts higher return. The fact that those things go in the opposite direction is not that informative in a way, because I just told you there's market clearing. So if we had the whole sample in the whole data, extensive plus intensive trading has to add up to 0. So whatever pattern you see in those red lines, you should see exactly 1-to-1 the opposite pattern in the blue line. So we're not really learning from those, the red guys are price followers and the blue guys are trading against trading against prices, sorry. We're just learning they are different in a way that those differences through market clearing push them in different direction. We're not learning the absolute level of their demand from this, we're just learning that they're different. Which is information is its own sake. But once you see some significant result on one side, it has to be just the opposite on the other side. Okay. So that's what we learn. So we learn that the elasticity of trading is likely stronger for intensive trading, meaning they look like they're going more aggressively, they're doing more trades that are profitable, that are going against price movements. And we learn, and that's some of the extra result that I didn't show you again, that it looks like there's more non-fundamental demand shock for extensive trading. They move more with attention, they move more with kind of like trend following. They do things that, casually would say looks kind of irrational. And it's confirmed by the structural decomposition. So if you want to really call those things elasticity and so on, you need instruments, you need shocks to the price that are not related to demand shocks, and they use one method, that's granular IV, to do that, and they kind of get at elasticities and so on, and they find these kind of patterns. Okay. That's nice. So again, at the end, at that level, we just conclude, we look at the data, with some instruments, and we say elasticity is stronger for intensive trading than non-elastic trading, and the demand shocks seem more non-fundamental and bigger for extensive trading. If you want to interpret things further, now we need to start to put more model, more assumptions, more economic fundamentals. And so what they do in the paper is a theory where you have intensive trading is kind of informed trading, so you know about fundamental and not much, and extensive trading is less informed or uninformed, and there's this new kind of flow thing. So the idea is that this uninformed, the extensive traders misperceive their own flow, and that creates kind of endogenous noise trading, and so on. I would call that a complex, maybe a convoluted theory. But I think, but I don't really blame the authors. Actually, I'm going to blame the literature, because the literature got a little bit too attached, at least for my taste, when I look at the data, to kind of what I would call an elegant trick, but not so meaningful. When we write Grossman-Stiglitz Taylor models, we love this need separation. We have all those traders, they're like really rational and so on, they're perfectly rational, they do some kind of learning. And on the other side, we have those noise traders. There are good reasons to do that from the point of view of theory. From the point of view of data, it's a little bit strange. And so roughly all this misperceived flow, all these things, is a way to kind of stick in a little bit of noise trading inside of those extensive traders. And so my view of the world, at least, is that each investor is simultaneously the rational trader and the noise trader of the model. Even if we're all very smart, we all make a bunch of mistakes, we all have emotions and so on. And so when we look at the data, we should be willing to entertain views of the world where the noise is also directly in the agent. So I would encourage the author to not do, what we love to do as economists, some convoluted pretending to do microfoundation, but just say what we truly believe. Okay. So if you do that, the model becomes simpler, actually. You have an intensive trader intensive traders that have dispersed information about fundamentals, and you have extensive traders that are less informed about fundamentals, and they make mistakes. They have this noise term. And everyone learns from prices, like in a regular Grossman-Stiglitz model. If you write this, you get all of the facts as the theory in the paper. Because intensive traders are more informed, they trade more aggressively, they know better when the price is a good deal versus not a good deal. Because extensive traders are the ones that have the noise in their demand, they're the ones that make the mistakes and so on, and you get the whole equilibrium. You can do more, of course, and that's what they do, is those mistakes, you can correlate them with various outside information. So you can say, oh look, those mistakes, they look correlated with social media attention, they look correlated with past return, so you can start to discipline theories of those mistakes. So for example, in the paper, they spend quite a lot of time arguing that those investors have something like extrapolative expectation, which is interesting. That's nice, but this would be easy if it was like, oh, these are two groups of traders all together. But we have to remember those two agents in our model. They're the same. They're kind of the same person. So one more graph that you cannot read. This is a decomposition of where the variation between intensive and extensive trading comes from. Roughly, it's half and half between different investors do different of those things. So that one is kind of easy to understand. But another half is within the same investor variation. So different distinct investors, that means less sophisticated investors trade in a more blunt fashion. That's what we're saying in a way. They trade in more blunt fashion, they're less sophisticated, so then we shouldn't be surprised they make mistake. If you go that direction, you start saying, well, why did we cut intensive versus extensive? We should try to go directly at cuts of data that is way sophisticated and way is not, and look at this differently. Of course, the other side is interesting. And a lot of the results, and the paper shows that, holds within investors. It's not just comparison of different investors. It's truly that there are those two different minds. Mechanically in regressions, you can put investor quarter fixed effect, and you see the same investors start to trade in different ways when they're doing extensive versus intensive. So it is more fascinating, but it's also more puzzling, because you have to know, well, where does that come from? So I try to think about that. It's trying to go one step deeper into the foundation. Say, instead of saying these are two investors, say why are those two minds differently? And I'm a simple guy. So I see lumpy decisions, I start to think fixed cost. And the fixed costs, they're not that hard to think. They're not really fixed transaction. Don't think about this as transaction costs. Like, there's not that much transaction cost in this market compared to the size of those positions. It's more, once you take a position, you have to pay attention, you have to store the context about that company in your brain, and so on. And then I start to think, well, can this lumpiness, the fact that you jump in one go, explain some of the apparent irrationality and mispricing? And so I started to think about a nice paper, the job market paper of Daniel Graves from last year. That's this notion of hidden belief. That was, well, if you own zero position, his idea was if you own zero position in asset, maybe that you don't like the asset exactly that much that you have zero, that you really hate it, but you're not shorting. And so we can try somehow to get information, say, well, the zero, your actual position does not exactly reflect one-to-one your belief. And so in a way, you're making a mistake. From the point of view of us as observer, in a way. You're not making a mistake, you're just constrained. And so I started to think, well, can I do the same with this lumpy extensive trade? So here's my attempt at hand-waving through a model. So you could say, well, imagine you can only trade like that. So you can enter a position, you choose an amount, and all you can do is later you exit this position. So I'm shutting down any extensive trade, intensive trade. I'm saying you enter and you lose. And your beliefs are going to follow a random walk. So sometimes there is good deal, bad deal, it moves on. Well, in that case, you can show that because once you enter, you can exit, but you cannot do more, it's going to be natural to overbuy at entry. Overbuy not as a mistake, it would be perfectly rational. It would just be to say, I'm going to buy more than what my spot belief warrants. Because I want to be ready for, if my beliefs become more optimistic, I will have a bigger position. Okay? So that would make in the data that it looks like you're buying more than what you truly think. So you're going to look irrational in your trading. And in equilibrium, this might even affect the price because as you buy more than you should have, it's going to push the price up, and that's going to create, negative returns looking forward. In particular, if this market is inelastic. I want to be clear, it's a little bit of a loose equilibrium argument. It's my last slide. I'm out of time. I'm just a discussant. But I think there's something to those ideas in a way that even without much irrationality, lumpy trade can create some appearance of mistakes. Okay, so let me wrap up. This is a very interesting paper. At first I was kind of skeptical of like, well, why would I even separate intensive extensive trading? But clearly there is some economic information in there. To me, I got pretty convinced of that. And I kind of like how the paper kind of tried to get to a structural representation of this difference. I'm still left a little bit with this kind of deeper economic question of like, well, we have those two minds, but what's behind them? And I'm also left kind of excited about the broader literature in a way. That is, it's really illustrating that there's a lot of potential cross-fertilization between ideas we have from microstructure and idea that we have more from macrostructure. Thank you.
Great, so now let's open for questions. Edie and then Pat.
So I think I agree with Valentin that microstructure versus macrostructure is basically labeling. We're dealing with the same issues. And the issue of horizon is pretty artificial. One of the issues that we've seen in market microstructure is that this pattern of contemporaneous negative return and then positive return in the future is not necessarily associated with informed trading. That's the classic pattern of a liquidity provider. Okay, so that's the old inventory model. And Grossman and Miller, 88, basically said, no, it's not just a spread, it should be the macrostructure, right? We've shown it for monthly returns, we can definitely think it applies to quarterly. And so, I'm thinking that if you take that and you basically structurally estimate it and attribute all of it to information, something can be messed up there. And maybe you can have ways of trying to separate those two things. First, like orthogonalize the intensive changes on maybe earning surprises, right? You take the fitted value for the information, the residuals for the liquidity provision, and then use if you don't want to change the model that it includes liquidity provision, then that's a way to try to separate that information. And the active versus passive is not going to help you here because we know that active can be for fundamental reasons, active can be for liquidity provision, alpha generation. This is one of the points that Dave Modeste made in this room many years ago when we invited him to talk about how hedge funds make money, right?
Yeah, points well taken. We'll be very excited to do more decomposition that can shed light clearly on the underlying economic mechanisms. But just on top of that, for empirical analysis, we'll kind of control for like earnings news. But of course, we can do the decomposition instead of just a control. This is a very nice idea. We'd like to add to the empirical analysis. Thank you. Please.
My question is, how do you think about, when I'm thinking about these intensive versus extensive margin trades, like it could be portfolio manager is selling out of his position, it looks like intensive margin selling for a while, and then finally when he sells his last 10 shares or last 1,000 shares, that looks like extensive margin. So do you control for that? Do you look at that?
Yeah, so first we're doing a quarterly sort of frequency analysis that will sort of resolve the part of the challenge you have in mind. Also, there's one graph actually, Valentin kind of included in the discussion. I didn't have time to show. If you look at what we call a holding cycle, I define, that is from nothing to something until the end, you plot the trading distribution within the holding cycle. You consistently see that when they made the first buy in the first quarter and then made the last sell in the last quarter, those will be the largest two trades. This holds for retail transaction by transaction and holds for execution quarter by quarter. So it's kind of not, they are gradually liquidating the position, and only the tiny last one is extensive trading. But when they close a position, they close it pretty aggressively. Similarly, open a position, opening pretty aggressive.
I think present the model. I just kept thinking about I'll speak loud.
Oh.
Yeah. So I just kept thinking about the role of like benchmark managers. So like the managers who are tracking indexes, for them, there's sort of like a two-way trade that maps to the I have to track the index, so I have to do a bunch of intensive trades to actually reduce my tracking error. But when the index gets micro-executed, I have to do a bunch of extensive trades. And so, like, how should I really think about mapping these benchmark managers into the model? Because you're optimizing them, object is slightly different from what you're thinking about here. And then the follow-up is more empirical or econometrics. We know a bunch of these folks in the 13Fs are sort of doing closet index trades. Not everybody, but some of them. And so you have this sort of independence residual refinement you need for the GID. And so if there's any evidence that a bunch of these managers are doing closet trades, then we have this sort of tracking the index reconstitution, those shocks are going to be correlated across those managers. So sort of like a two-pronged approach.
I see. I will take the second question first. It's an empirical one. So when constructing those GIVs, the identifying assumption essentially everybody's residual demand shocks are correlated with each other. It's a structural assumptions, but it's ultimately not testable because it's assumption. But we can show some suggestive evidence, say, oh, these are indeed have low correlations. That's what we did. And according directly to your questions, we can add all this. If you're worried about this part of factors such as index trading can be a concern for those identifying assumptions, we can always include those when constructing the residual demand shocks. We can exclude or remove those common shocks you have in mind and isolate the part that we think can be more exogenous. That's the second question. First question I think is very interesting, as I think it's kind of related to what Valentin's had in mind is a discussion like our models are kind of those disconnections, go-to minds, but maybe it's kind of for many investors, they are doing part of the trading is index, following index, right? So that will lead to trading at the extensive margin index, inclusion, exclusion, but also like rebalancing, just following index. For the active part of their trading, there might be a lot of extensive trading featuring by our works, that might be a lot of mistakes. So we're thinking about exactly following the direction of Valentin's comments might be a way to unit for this, but maybe we should separate them because they're trading for different purposes.
Can I add one point? Yeah, so very good point. So for index founders, we have that if you like follow the index and you just passively rebalancing, so your estimate elasticity would be more closer to zero. But we include all those indexers and we found the intensive elasticity is actually more negative. So it's supporting evidence, but actually we can try to separate them and try to explore more. Thank you for.
So from the charts, the only category I think for which extensive margin dominates is retail, right? So everybody else seems to be intensive margin dominating. So Strawman, I just put this out there so you can shoot it down. the similar story is that retail investors chase returns, so they see glamour stocks, they can move in droves into chips, into rockets, whatever that is. And then, of course, institutional investors, including broker-dealers, they will be going the other side. So they would be, by definition, trading intensively because they, in aggregate, hold everything pretty much. And the retail investor would be trading labeled as extensively because they go in and out of positions in a behavioral fashion. And then they would push the price away from the real value, so they would be losing money, whereas the institutional investor would be making money. Is that fair, or is that too simplified?
There are ways that what you said is partly consistent with what we have in mind. That retail trading is definitely dominated by extensive ones. But if you think about institutions, you do the decomposition. They are small but still active. Some hedge funds where their extensive trading also dominates. So it's not just retail versus institutional, but it's like rich heterogeneity even within institutional. But there is a subtle data limitation I actually want to bring up, which actually support your argument is, if you look at 13F data, it's pulling all the holdings for one investor from different funds. Like for Vanguard, you only observe one Vanguard, there's one investor in our sample. That might that might attenuate our result in the sense within Vanguard, individual funds may do a lot of extensive trading, holding and diversified portfolio, but if you pull all their funds together into one investor called label as Vanguard, you see, oh, it's a very diversified portfolio, holding a lot of, doing a lot of intensive trading. So that may actually attenuate the extensive finding.
Can I just add 20 seconds? I mean, for certain investors, such as hedge funds, I think you can see their names if you go to the raw data.
Yes.
I think some of the fund families, like Fidelity, is known for more active compared to a Vanguard. So I think there are ways that you can distinguish the more active guys.
Yes, that's what we do. We measure the active shares and group them into five groups and compare. Yes.
Again.
I'm curious about how you calculate extensive and intensive margin for retail investors exactly. You know, when Haosheng was talking about, retail are more expensive, how is that calculated? I just want to clarify.
Of course. So for retail, we use Odin data. That's transaction by transaction.
But that is not. You're only using the overlapping part with 13F, or I mean.
No, it's a totally separate sample. It's different investors, different time span, totally different sample.
That was 30 years ago.
Yes, so yeah, that's why we don't use retail as our main sample. It's just for external validity and it's a validation.
Okay.
Yeah, so we're not.
It would be nice if we have that, to be consistent with your 13F.
Oh, that would be amazing. We'd love to have a more updated. Actually, we use Chinese retail trading.
Exactly.
Yes, that was in the original version of the paper, but we find similar result. Honestly, 3 million Chinese retail investors, very similar thing. Yeah, a lot more extensive trading, honestly speaking, but for obvious reasons.
Yeah, but I want to add on, since that's probably one impact of your paper. It's very hard to calculate the retail trading in recent years.
I just have a question. You mentioned hedge funds, right? You must have very patient hedge funds because you're only looking across a quarter. And can you identify the hedge funds in your sample?
We have the names of the hedge funds. We're able to measure things like size or lifespan, but it will be very interesting to add more information.
I would take them out.
Yes.
I mean,
yeah.
a hedge fund that comes quarterly, and you're seeing a picture that may be looking like this, right? So the question is, take them out and then see what your results look like.
Absolutely. Interesting. On top of this, our estimation is actually quarter by quarter, perception by perception, investor by investor. That's why we can do the estimation for each hedge fund, for each investor, and then compare them. And I think we'll highlight the empirical patterns you have in mind, and that might be something we want to include in the paper. Yes.
Yeah, just a quick question. And my question is motivated by something that was said before. Especially institutionals, they seem to care a lot about tracking error. So think of two institutional investors. One has a position that in the benchmark is supposed to be 4%. So stock, IBM is supposed to be at 4%, and this institutional investor goes from 4 to 1%. You will label them as intensive. But practically speaking, that investor is making a bet to significantly move away from the stock. So for all purposes, that could be considered external. The opposite would be the case of an institutional investor who has a benchmark of 1% and he moves from 1% to 0. Then to you becomes an external margin, but the position was already marginal to begin with. And perhaps for liquidity reasons, for portfolio rebalancing, they just moved from 1% to 0. Is there any way that you can get data on their benchmarks? So to try a different definition of what would be intensive versus extensive.
Absolutely, that's a very nice idea. So I'm going to refer to the graph Valentin including the discussion. For that graph, like you have a huge bar at the beginning, at the end, you have a little adjustment within the middle, like two high orange bars at the beginning and end. Those are normalized actually. We normalize using the number of shares ever hold within that holding cycle. So that's within investor, within stock, within that holding cycle. So if for this holding cycle, maximum I have 100 shares of Amazon, our empirical result says you made that trade on average 80% of shares when buying. Selling, you sell 70, you lost trade. So that's sort of the normalization we can control for, or use as a benchmark. That's within investor. But of course, in the estimation, when we thinking about doing the estimation demand system, maybe there are better ways to normalize a benchmark and to compare all this.
Because in the example you just made, I could go from 10% to 5%, but the benchmark is 1.
Yes, absolutely.
Right? And so you have normalized to the 10%, so it's still something,
still
but the benchmark is 1%. Yeah. So you have not really moved away from the large bet you made on that stock. That to me would be the external, right? Like moving away from the bets that the benchmark is forcing you to do.
Absolutely, absolutely. That's something we
should try to look more into the mutual fund data, for example, and have a detailed understanding of what is fund, what's the benchmark that they're tracking, and try to arrive at that. Yeah, but thank you.
Now let's move to our next paper. So our presenter will be Winston Dou from Wharton.
Thank you. All right. Thank you, Mal, for inviting our paper, including this into this fantastic program. And thank you everyone for being here. So this is a joint work with Itai Goldstein at Wharton and Zigang, who had 2 papers on the program. So you just saw him. He is a PhD student and a young scholar at Toronto. He will be on market this year. Please pay attention to him. You will be surprised positively, I promise. So, and also with Li Yan. So in this paper, we're going to try to, provide some insight into the question, when does AI trading outperform humans? And what limits AI trading's performance? So this is a fundamental but a challenging question in AI trading because it requires a clear distinction between how AI trade and how human trade, right? So also it requires how humans anticipate and respond to AI's equilibrium behavior. So to kind of meet these 2 requirements and deliver some insights, our approach is to focus on studying a clean yet economically meaningful and empirically relevant benchmark. So this approach is very much similar to one of the recent papers of Snehal. I strongly recommend you guys to read. And but differently in this paper, what do we mean by benchmark? So in this benchmark, we'll kind of isolate the reinforcement learning-based trading performance by eliminating the AI's information advantage and also eliminating market power. Later we'll see the details of what do we mean. So more precisely, in this framework, we assume humans can observe some like private signals and reason strategically but boundedly. And AI can learn from market data, such as market prices, via this kind of very advanced reinforcement learning algorithms. And but they have weaker private information or no private information. And so this is how we think about humans and AI in terms of trading. So this paper, to adopt this paper, we kind of use a theoretical analysis rather than a simulation approach we used before in our previous papers and in Jean Devoire's paper. The key reason is here we really want to model how humans anticipate strategically AI's behavior. So in our previous simulation-based framework, it's really hard to incorporate this because this requires the human in the framework be able to anticipate the equilibrium behavior of AI. So later we'll see what I mean. Okay, so let me give you a overview of the main findings of the paper. There are several interesting insights we can derive from this, theoretical laboratory. So one is we show the most sophisticated AI, human traders can always outperform AI in this case. So why? Because AI learns from market data, but market data is shaped by average, not frontier human sophistication. So the most sophisticated guys, they can always do better. They can always do better. So humans retain direct access to some soft and private information, hard to access by AI. So that's why. So second main result is even the least sophisticated humans in this environment, they can outperform AI. But under some conditions, specifically when the private information of human is either very strong or very, very weak. So we have this very interesting non-monotonic result. So it's quite intuitive. In other words, we can reframe the result as AI outperforms only when prices are when prices are informative enough, right? So AI can learn enough information from the data, market data. But at the same time, the price cannot be too informative. Because when price is too informative, that's humans trading too aggressively, who has the private information, and then they will eliminate this kind of like trading rats for AI. So you can see it's only at a narrow window about the information structure, and the AI, the pure algorithm, very advanced algorithm, can outperform the least sophisticated human. Why that's the case? So in this paper, we identify three factors or three forces that limit AI profitability relative to even the least sophisticated humans. One, as I mentioned, humans benefit from private information. AI traders do not have this kind of certain soft private information like a dining table conversation, right? And in-person communication. And sophisticated humans, they can anticipate AI's price inference. And given this, because they are strategic, they will shape their trades, right? Try to prevent less information to the AI. And most importantly, I highlight here, this is one of the main results we show in this paper. We show there's an endogenous algorithm herding. That means in this kind of environment, we have many atomistic AI. Even they start with very different trading strategy, very different tuning parameters. Based on the mean field game convergence result we show, under certain generic conditions, they will converge to the same trading strategy, and it will hurt themselves. Okay, so that's the three major forces we show will limit AI's trading performance. In the end, we show AI sophistication is shaped by the sophistication of humans who are competing with them, but at the same time training them. So if the AI is competing more sophisticated humans, the AI will be better. So this is the one insight we show. Okay, so let me go to details. First, the theoretical setup, what will be the trading environment. We try to make as simple, clean as possible, as I promised in one of the previous slides. So basically, we have one single risky asset, will be traded repeatedly over time. You can think it's like, like close to end derivatives or close to maturity derivatives being traded repeatedly. Or actually, we have extension. It can be long-lived, risky asset. It doesn't change anything. And there's like per capita supply, which is S. So for simplicity, we normalize the average, the mean of the payoff is 0, and the net supply per capita is also 0. And also the payoff is RID over time. So because of that, for notational simplicity, we kind of remove the subscript T. Okay. So there are two types of traders at the highest level. One is noise trader. In this room, everyone I think is familiar with noise trader. And we have the other group of traders. They are objective maximizing traders. So particularly, they're maximizing their trading profits, like here. And we have this V minus P is the trading profit per unit of trade. XI is the quantity of trade. And the last term, the quadratic term, is a trading cost. Okay. Very simple setup. But there are two types of objective maximizing traders. Type 1 is human traders. So there are total measure of psi of them. And they kind of like each human traders, they observe a private signal, which is eta I. Eta I is like a noisy signal around the true value of the payoff V. And the signal volatility or signal noise is the sigma m squared. And we have AI traders. The total measure of AI traders is a phi. It's an important parameter. Later we'll play with it. So they observe no private signal. Of course, it's a simplification assumption. In the paper, in the online appendix, we have the extension AI can also receive private signal, but less precise than human. I think that's a fair, relevant assumption. So in this case, they only use market data in this very simple framework. The informed market data will be market price. And then they learn through this reinforcement learning algorithm. Later we'll go to details what do we mean by reinforcement learning algorithms. So as I emphasized very importantly, for all those AIs, there are many atomistic AIs. Importantly, they start with different initial trading strategies, and also they start with different fixed tuning parameters. The tuning parameters will be different forever. But even given this, they will converge to the same trading strategy in the equilibrium. Okay, so among the humans, we model again two types of humans because we want to have different levels of sophistications. It's very simple. So there's one group of human traders. They are cursed human traders. You can think they are level 0 human traders. Why? Because they basically they receive private signals. They only trade use these private signals. They don't try to infer for most information from the market data. So what they behave. And the other group of human investors, they are bounded rational investors. We kind of like model them using K-level because later we can cleanly do this kind of conceptual experiment to change the K, the sophistication level. And we can see, how the AI, the trained AI will change according to different level of K. Okay, so the K-level investors, different from the cursed investors, they use the information in the market date price to a certain level. So what they do, so this is like coherent, bounded rationality framework. Basically, it's iterative. The key idea is for K-level human, suppose we are all K-level human in this room. The idea is we all perceive others K-1 level. I'm the only one who's K-level. I'm smarter, more sophisticated. That's the idea of K-level. So in this way, so each one's belief, perception about the trading environment and how others thinking and how others behave will build up from level 0 iteratively. And this psi C is the mass of this cursed investors. Psi S is a mass of the sophisticated investors. They sum up to psi, which is the total mass or measure of the human investors. Okay, so let me go to details, like what I just explained. So for the cursed investors, they only use the private information. So they're not noise traders because they are rational. in the sense they're making decisions rational based on information they have, the belief they have, okay? And also their belief is correctly specified given the information they use. They do Bayesian inference. So the limitation is they just don't, they make mistake. The only mistake they make is they don't use the information in the price. They only use their own signal. Okay, that's the cursed investor. So given this, in this framework, we can have very clean, demand curve for the cursed investors. And then let's talk about AI. So how AI trade? For simplicity, we assume AI receives no private signals. They learn from the price. Specifically in the model, and in this talk, for AI, we mean this kind of stateless Q-learning algorithms using Boltzmann exploration. It sounds very specific, but actually the mean theoretical result will go through for more general class of reinforcement learning algorithms. And more specifically what they do, so basically the AI, they're trying to learn this linear demand curve trading strategy based on price. You give me a market price, they will trade accordingly, okay? But they are learning this intercept term and the slope term. And how they learn, so basically for Q-learning or reinforcement learning, they kind of like trying to estimate some value function. In this Q-learning literature, they call Q value function. It's a value function. It's a value function attached to each specific trading strategy, XJT, for AIJ in iteration T. So how do they update, right? So at time in iteration T plus 1, the value function is a weighted average of the value function from previous iteration, which is QJT, XJT, and with a weight 1 minus alpha JT. And also the machine will assign the weight alpha JT to the data they collect from new experiment. So that's the second term. New experiment is they play this trading strategy XJT, they receive this payoff, pi JT, and also they kind of anticipate what will be the maximum value function for the next period, right? So they have the second term. They keep accumulating this way, and we show, quote unquote, magically, this will convert to some optimal trading strategy, even for this very simple algorithm. But you may ask me, so how do they, okay, I need to speed up. How do they really choose trading strategy XJT? So here we use this standard Boltzmann exploration strategy. It's like they keep playing some mixing strategy. So, and so for the environment with K-level investors, so we denote this QK as the limit Q function. And for this one, because this kind of like, what does that mean is capture this optimal trading strategy in this environment in the limit. So later we'll show, in this case, actually the AI traders will convert to this optimal strategy of uninformed rational exploitation investors in this environment with level K thinking investors. And they will learn, the machine will learn the information from the equilibrium price. And in this environment, in the equilibrium, the price will depend on the fundamental information and the knowledge trading. That's why the machines can learn this V from the market price. And how much they can learn depends on this price informativeness. It's basically signal to noise ratio in the equilibrium market price. Okay, so for the K-level thinkers, how they trade. So they start from the level 0 investors, and basically they only use this kind of prime information to form this kind of like optimal trading strategy. And start from there, they kind of say what would be the K will go recursively from 1 to infinity potentially. And here, so basically they kind of perceive all others like level K minus 1. And in this environment, they will form some anticipation about this limit Q, AI's behavior captured by this Q value function, Q K minus 1. And given this, they will choose the best response in their trading strategy. So everything will be built into this expectation they have based on the market price, based on the the private signal, and then they have this kind of linear trading strategy. So everything I described can be nicely summarized into this diagram. So basically what we want to focus on in the end is this part, right? This is the perception of the level K thinkers anticipation about how the AI will trade, but to form that expectation, they need to start from 0. They say, okay, suppose we are level 0, and AI will converge to here, and then take this, we move to level 1, level 2 to level K. So this is how they will form this belief. All right, so now let me describe the equilibrium. So basically the first result in the equilibrium is, as I emphasized, is the algorithm herding result. So basically, AI traders who using Q-learning with Boltzmann exploration, they will converge to this behavior of uninformed rational expectation investors. Okay, even when they can start with a different trading strategies and a different fixed algorithm parameters. So at each time t, that's their trading strategy, but as t goes to infinity, they will all converge to the same trading strategy, and we show actually this trading strategy in the limit corresponds to uninformed rational expectation investors trading strategy. And so I will not go to the details of the proof. We have like long proofs for this, but I can give you some intuitions. Why does that work? So the key idea why does that work is this. This kind of aggregate feedback is weak. So that's the K condition. That means when the AIs, they choose a certain strategy together, and that will create, price impact. And that price impact cannot be big enough so that change their reward function too dramatically. Okay? So if we have that condition, we will guarantee the convergence. And the second major theorem here is we show as AI traders deploy the same learned price contingent strategy, more of them doing this, which means when phi goes to infinity, we show per AI investors profit decline and decline to 0. And in the end, I will present, talk about this kind of relative performance result between AI and a human. So first result is the most sophisticated human, in this simplified case, the K equals to infinity, so it corresponds to the rational expectation agent. So their trading performance is always better than the AI. In this case, why that's the case? So because level infinity investors, they combine private information signals and the price information. Well, AI only use information in the price. So they have information advantage. At the same time, they kind of anticipate AI's trading strategy, and then they can trade correspondingly, optimize. And you can see here, we have a 2D graph. One is this non-tradable volatility sigma z. The other one is private signal noise, sigma m. Across the board is blue. What does that mean? It means, the AI underperformed human, rational expectation human. And the second one we want to show, when this kind of noise trading is large enough, in this case, actually AI will be dominated by the least sophisticated human. Why that's the case? Because when the noise trading is large enough, the prices are not too noisy for AI traders to learn anything useful in this market data. So they will be even dominated by the least sophisticated human. And also the AI will converge, do the herding, and they themselves will have huge price impact, will further go against them. And interestingly, we show, so when the noise trading risk sigma z is small enough, there's a interval for this kind of precision of private information. So within this window, the cursed human, the least sophisticated human, their performance will be dominated by the AI in this case. So we can visualize this result. It's a very interesting non-monotonic result. So again, we have this 2D plot which capture general trading environments. And you can see, when the sigma z is small enough, and there's for each sigma z corresponds to one interval in between a window within which the AI can outperform least sophisticated human. All right. So let me recap all the result and provide some intuition. So the AI performance relative to the cursed investors is non-monotonic in the private signal precision. That's a very interesting result to us. When the private information is very precise, the cursed investors, their direct information, the information voltage will dominate. And when this private information is not precise, not very precise, in this case, too little fundamental information will enter the price for AI to learn. So AI, even they have the best algorithm, but not much they can get out of the data. So only, when this private information is in a narrow window, and when this noise trading risk is not so high, this pure AI traders, they can have a hope to even, beat the least sophisticated human. And the last piece of result is about the sophistication level of AI. So here we show actually the sophistication level of AI heavily depends on the sophistication level of human. So what the thought experiment we did here is, so for each level K, so we train one AI, the best AI in that environment, and then we take that AI trader, the trained one, to an environment. We have cursed investors and the rational expectation investors. We see how these different AIs, they will perform in this common environment. Okay, so how we measure the performance is one is relative to the cursed investors in the lab. So you can see when K increase, the relative performance of the AI increase. The AI actually perform better and better. When they are trained environment, the sophistication of human in the trained environment increase. So this is another measure relative to the rational expectation agent in the laboratory, although it's always negative, but also increasing monotonically. Okay. All right, so it's right on time, so let me conclude. So in this paper, we show, we derive several interesting insights from one benchmark environment. So first, we show the most sophisticated human traders can always outperform AI when AI doesn't have information advantage, when AI doesn't have market power, so they can manipulate, like in our previous papers. So why that's the case? Because AI learns from prices or market data in general, shifted by average, not frontier human sophistication. So second, we show, more interestingly, so even the least sophisticated human traders can outperform AI, but only when the private information is either too weak or too strong. And there are three forces generically limits AI's power. And in the end, we show that AI sophistication is shaped by that of humans who really compete with AI in the financial market and trade at the same time train AI in the financial market. Thank you so much.
Our discussion with Guillaume Couillard from HEC Paris.
All right. Thank you very much for inviting me here. It's always a great pleasure to be at the NBR and to be in Boston. So it's a great paper. The motivation, is very clear. There's a growing use of AI for trading. I will actually show you some numbers on that. And we have more and more papers that study competition between Q-learning algorithms and as a way, to understand AI-powered trading. Okay. And in this literature, very early there was natural questions about the interaction between humans and algorithms, like, can humans survive the competition with algorithms? Or conversely, can the algorithms survive the competition by humans? So, in the paper we have with Thierry and Stefano, we tried to look a little bit at that, but indeed, as Winston explained very well in a setup with just, simulations, it's very, very difficult to think about this, okay? So having, analytical models like this one or the one that Snehal has is very important. And I think it's a fascinating question because there is a very deep question here, which is, what's actually the difference between humans and algorithms, okay? And so I think this is a very fascinating question. So this is just to illustrate. So this is, taken from a non-existing paper with some co-authors where we have, the paper does not exist, but the data does exist. And so here you see, the share of algorithmic trading on the Dutch market, and it's just to illustrate, how prevalent this is. Okay. So what I will do is first I will give you, a toy model. So as you have seen, the paper is very rich. Okay, there's many things. So I'll try to unpack things a little bit, and then I will give you my comments. Okay. All right. So here is a slightly simplified version of the model. So imagine you have, a rational expectations equilibrium type of model. So you have this asset with a value V. Where tau v is the precision, so it's 1 over the standard deviation, and we have different traders, and they can have a Gaussian signal on v with some precision tau m. Okay, and so what's a bit new in this setup is the definition of the different types of traders that we have. Okay, so we have an exogenous supply, we have noise traders, then we have sophisticated traders. Okay, so those guys they rationally infer the value from the price that they see and the signal that they receive. We have the cursed traders, so those guys, they receive a signal, they infer from the signal, but they don't think about the price, okay? So we think of them as behavioral agents. And then we have the algorithmic traders, okay? So I denote them by psi8, in the paper it's phi. And those guys, they infer from the price, but they don't receive a signal, okay? So we have these three possibilities, okay. Right, so we have very standard preferences, and so we have a demand that gives us that the type I is going to have a demand xi, which is simply the expected, the trader's expectation of V conditionally on their information set II minus the price and everything divided by gamma. Okay, and so it's actually a very easy model to solve. Okay, you can just say, let's guess, that the price gives us a linear, an unbiased signal. Okay, so it's the signal SP. So let's assume that somehow you can infer, linear signal from the price about the asset value, and then we have a continuum of traders of each type. So that's great because we can aggregate, all the noisy signals, and it will be centered on, the actual value. Okay, and so then what you see here is that, for instance, for the sophisticated traders, we know that what their demand is going to be. Okay, it's just the mass of sophisticated traders psi s multiplied by 1 over gamma, and then multiplied by their expected value for the asset, which is just a weighted average of the 3 pieces of information that they have, which is V bar, their prior, V, the aggregation of all their signals, which are centered on V. So because it's a continuum, we just get V. And finally, the signal coming from the price, okay? And then minus the price, and that's it. And so we know the demand of these guys. Then we can do the same with the cursed traders. The cursed traders, they do exactly the same thing, okay? Except that they don't condition on the price. So instead of having an average of these 3 pieces of information, they will have only 2 of them. And then we have the algorithmic traders. So here what I assume is that the algorithmic traders, they are also rational. They don't receive any signal, but they can infer from the price, okay? So they will also have only 2 pieces of information, and they will average across these 2 pieces, okay? Once you have this, you can compute what's the total demand for the asset, and in particular, you see that this total demand will just be a linear function of V and P. Okay, so I can write it as in the paper as mu plus zeta V minus psi P plus Z. Okay, when you read the paper, you have to remember your Greek letters. It's quite important. It's like a lot of them. Okay, then market clearing, the demand has to be equal to S, and now we can solve for this famous signal coming from the price, and we get everything, and we can solve for mu, zeta, psi, AP, BP, And we can also solve for the precision of the price signal. It's this expression that you have there, okay? And in particular, we get that the precision of the signal increases in the precision of the noise, which means that when you have more noise trading, the price signal is less informative, okay, which is very intuitive. Okay, and so that's a fairly standard RE model, but with like a nice diversity of information sets, if you want. Okay. In particular, we can compute in that model the price difference between the sophisticated and the algorithms. Okay, it's actually in the paper, and here we can see, for instance, that if you look at that, you will see that the sophisticated traders, they always make more profit than the algorithms. Okay. However, the algorithms, they make a positive profit. Why? Because they are free riding on the informed investors. Okay, so these guys, they don't know anything about this asset. The only thing they can do is look at the price, and they realize that there is information in the price, and so they get a profit out of that, which corresponds probably to a loss for the cursed traders who don't condition on the price. Okay, when there is more noise trading, conditioning on the price is less profitable because the price is less informative. Okay. And here, because the algorithms, they have only one source of profit, which is looking at the price. When there is more noise trading, it hurts them more than the sophisticated traders. Okay, and so that corresponds a bit to the intuition behind this graph that Winston showed, in which everything was in blue. Okay, and so in which the algorithms always make less profit than the sophisticated traders, and when you increase the noise, it actually benefits the sophisticated traders more because the algos are suffering much more. Okay, because they rely only on the price. Okay. All right, so that's a very simple model that I showed you. It's simpler than what they do in the paper, because in the paper, on top of this, they do two tour de force, to use a beautiful English expression. So first, they replace the sophisticated traders with level K traders. Okay. So I think this is beautiful. I think it's a beautiful idea in the paper, because now we have a human weakness, which is that they don't infer perfectly from prices. They are not very good at statistics, if you want. And we also have machine weakness, which is that the machine, they are good at looking at, what happens in the limit order book, but they know relatively little about the fundamentals of the assets they are trading. Okay, at least that's the assumption in the paper. And so when we do that, now it's interesting because we have a model in which the algorithms infer information from the price in a more efficient way, and this advantage is more valuable when there is more noise trading. Okay, so in particular, that's going to give this non-monotonic effect of noise, which is that it may be good or bad for the algorithms, depending on the parameters. And this gives what I think is the main result of the paper, which is that the algorithms, cannot do better than humans if there is too much noise, because then, the price is a very poor signal. But they cannot do better than humans if there is too little noise, because then even imperfect humans will infer very well from the price. Okay, so I think this is very nice. The second tour de force is to replace the rational algorithms with Q-learners. Okay, and so here I just told you, well, these algorithms, they are just rational and that's it. Okay, in the paper it's not an assumption, actually it's a result. Okay, so they extend the model to many periods, and they show that the particular brand of Q-learning that they assume ends up converging to the behavior of the rational algorithms. Okay, it's really a tour de force. I mean, it's quite impressive actually. Okay, it's a very it's difficult to do, and it's quite beautiful. Okay, right. Okay. So what I've done so far is try to show you, like a stripped down version of the model, but what's the minimum model that does the job. Usually this is the time when the discussant wants to add a lot of stuff, okay? So I'll refrain from doing that. I'm grateful to the artist actually for giving me the permission to share with you. I'll refrain from doing that. Instead, I will spend a lot of time on, well, a bit of time, like 10 minutes, on, on the interpretation of the results, and more generally, what, in my view, we try to do in this like emerging literature on Q-learning. And I think this is a great opportunity actually for, I just want to open a discussion basically, okay? And I think this paper is very, very thought-provoking and is a beautiful opportunity to start a discussion about many interesting things about Q-learning in finance. Okay, so the first one is, who are we modeling exactly? So in previous presentations of this paper that I've seen, like 3 of them, and in the paper itself, it's not completely clear. So there is this idea that more and more humans are using algorithms, and maybe retail investors use more algorithms and so on. I'm not sure this is the most natural interpretation. So still in that paper, if you look at, we do a very, very simple exercise where we compute the intensity, the AI intensity of job ads posted by prop trading firms, okay? And we see that, well, unsurprisingly, this has increased a lot over time, and we know these guys use a lot of AI, okay? This is also, from a nice FT AlphaVille article where, it's based on, guesses, but their point is that more and more, prop trading firms, hedge funds, and so on are using ML, AI, and so on, and everybody is going towards AI. Okay, so to me it would be natural to say that in this literature we try to model exactly these guys actually. Okay, so that makes sense to me, and in fact, in this paper, the algorithms, they end up playing rationally, and the way they play reminds me a lot of backrunning basically. Okay, and this has been shown that HFTs do this kind of thing. They extract a lot of information from the limit order book. They realize that some orders are actually very informed, and they start trading in the same direction. Okay, and so in this paper, it's pretty much what happens. Okay, so I think that's actually pretty nice. It could be a good model of that. Under this interpretation, I would model the entry a little bit differently. So you could think about what's the optimal level of, what's the equilibrium level of entry of algorithms. The way I would think about it is that there is a bunch of humans who are trading, but because some of them are cursed, this implies mistakes in the price, and then you have algorithms that are going to enter in this market until some equilibrium level is reached. Okay, and I think here maybe there is an opportunity to have a very nice empirical implication that we could perhaps derive how much entry of algorithmic traders we should see across different assets, maybe asset classes or maybe different stocks, depending on how much noise there is. Okay, and I think the paper could have very rich implications about that because, well, the paper shows it's potentially non-monotonic, it depends on many parameters and so on. So that would be interesting to dig deeper into that. Another comment I had was, previous papers by Winston and his co-authors, they positioned that into, algorithmic behavioral finance. Okay, so there's this beautiful paper, defining this term, and I think, it makes a lot of sense. So we are a bit like the psychoanalysts of these algorithms, and we try to understand what they do, a little bit in the same way that in behavioral finance, we try to understand these crazy humans and why they are trading in this way. Okay, I also like to combine this with this very nice paper by Maureen, who called on new research to think about in the machine age we need new learning models because now we have machines and they process information differently and so on. So maybe Maureen will agree or not agree, but I think in my view what we try to do in this literature is kind of trying to answer this call in a sense, or at least a possible answer. Okay. And so there is a deeper question behind this, and so when I read the paper, it really reminded me of a very, very nice paper by Simon and Schaeffer. So Simon is Herbert Simon, okay, so he's the very famous guy. And that's the first chapter of the Handbook of Game Theory. So if you know the Handbook of Game Theory, it's like this very gigantic black book, okay? The very first chapter is about the game of chess and what's the difference between algorithms and humans. And in this paper, it's exactly in this tradition, okay? So I found this very striking. In that paper, they oppose, humans have knowledge, so they have some strategic understanding of what's going on in the world, but algorithms, they do search, they try many things, and they focus on what's working better, okay? And I think in this paper, it's the first paper I see in this literature that really operationalizes this distinction and tries to see what are the consequences, okay? And so I think that at a bigger picture level, I think this is super nice. Okay, so from that perspective, I like the approach of the paper a lot. And there is this result that Q-learning, leads to rational behavior. And so technically, this is very, very impressive, okay? And it's very difficult to show, and it's very, very well done. I think it's also very useful, it tells us that, well, maybe we can dispense altogether with these Q-learning simulations and so on, and we can just do as we do usually. To some extent, it's a bit disappointing. Okay, because if at the end of the day, actually the Q-learners, they just play rationally, well, it's good to know, but then it means we can just give up on that literature and we can go back to our usual models where everybody is rational. Okay. And so this recalls a bit an earlier literature showing that behavioral approaches, they lead to rational outcomes, and the literature on learning in games and so on. So it would be nice to think a bit more about this. Maybe if we take this result at face value, what this means is that the literature that we had before, in which HFTs, for instance, were just the rational market participants, but they had a different information set or maybe a different speed, but they were not learning in a particularly exotic way, maybe that was fine. Okay, maybe this paper is kind of micro-founding that this was the right thing to do. Where I think that things might be a bit more complicated in the model, it's clear that what's behind this result is the fact that there is perfect competition. Okay, there is this very nice quote by David Shaw where he said that the reason what they were doing on the markets was to actually experiment a lot of things, precisely because they realized that regularities learned on past data, when you try to operationalize them, they don't work anymore, precisely because they have price impact, because they are actually big, and that at the microstructure level, nothing is competitive. Okay, there are just a few guys, and if in a few microseconds or milliseconds, you are kind of alone in the market, if you want. Okay, so it's not really a competitive environment. And so I believe that actually the literature on Q-learning and reinforcement learning, it's useful precisely in setups which are very strategic and in which you cannot train on past data. Okay, if you are if you are at a lower frequency, maybe you do macro structure and you are competitive, then I think you can train on past data and you don't really need to do reinforcement learning. This also reminded me of this result. There is this beautiful paper by Margaret Bray showing that in a rational expectation equilibrium, people could just do OLS and learn over time, what are the parameters of demand and so on, and it works. Okay, and so here it's a bit the same with Q-learning. It's more sophisticated than OLS, and it should work even better, and it does. So I think it's just a question of clarifying the positioning of this assumption of perfect competition. To me, and Winston did that super well today, I think the argument is to say, okay, it's not really that we think that these algorithms in the real world are competitive. It's more a methodological thing. It's let's try to isolate, what is due to imperfect competition from what is due to the Q-learning itself, and then we can identify the interaction. Okay, I think to me that's a better way of positioning this assumption. It also suggests that it would be interesting, maybe in this experiment. So sorry, that's me suggesting windows with weird shapes and so on. But it would be interesting to try experiments with a small number of Q-learners to see if that complicates things a little bit. Probably does. Okay. Okay. There is, let me forget about this. There is one detail maybe. So there is this notion of herding, which plays an important role in the current writing. I'm not completely convinced about this in a sense, or it's just a matter of interpretation. So currently there are policy concerns that algorithms may lead to too many agents taking the same position, and it could be bad for financial stability and so on and so on. And it's true that the paper generates that, okay? So it's kind of striking to see that the algorithms, they all learn differently, they have different starting positions, but eventually they will all do the same thing. But this is just what rational traders would do in this model anyway, okay? And there is nothing particularly wrong with that. And so it's nothing against the paper itself, it's just that in this policy debate, I think people are a little bit lazy, okay, when they think about herding. In the CAPM, everybody is doing the exact same thing, and there's no problem, okay? So there is no herding or anything. There's a nice paper by Wagner that discusses those things. So just, I think the risk by using herding is to push policymakers to rely even more on this slightly lazy form of reasoning. Okay, so this is really a detail. Just to conclude, it's a very thought-provoking paper, in this still small but growing literature. It's definitely one of my favorites, so I encourage everybody to have a look at it. The interpretation, I think, can be, there are many things that I would like to see clarified because they are really interesting, and I would love to see, the author's views on them. And that's it. Best of luck with this paper. Thank you very much.
Mark's point, so my understanding is that a lot of the firms are actually using AI to read news real time. And then the question is if the AIs are using this sort of fundamental information, would the humans still be better at that? I guess your model would say no, not the case.
It's a great question. So basically, yes. Here, actually, in one of the extended versions, we allow the AI to have learn information, fundamental news. But here, the key point is, what if they're relatively weaker than human? First,
in terms of reading or interpreting.
In terms of precision of the private signal, yeah. So that's crucial. So we assume, in the model, they don't have, in the baseline model, they don't have any, private information, it's just for simplicity. Yeah. And I think it's relevant, we believe that's relevant, because a lot first, a lot soft information is not online, it's in person. Sometimes we call it the dining table or dinner table information, right? So those information is really hard to grab by the machines, in time. So this is one example. Second example is it's more like an equilibrium response. So people been talking about this. If people realize, there are a bunch of advanced AI reading online to grab any useful information and take advantage of that, that will, in equilibrium, will push people who are holding or producing this kind of private information more careful not to release to online to potential machines out there. So that's the second. Third is purely conceptual because I have previous papers with Itai and Yanji, three of us. So in that paper, in those two papers, we kind of literally give AI information advantage. We say to which level AI can take advantage of this type of information, they can manipulate. So here we want to set another benchmark, conceptually.
Well, it's kind of a version of what you asked, except more provocative. And I like the paper a lot, but given the advancement we've seen in generative AI for the past 9 months, right? Think about the Claude 9 months ago to today.
Yeah.
What do you think is the shelf life of this assumption? And the idea is that, yes, we do think that humans have advantage in soft information, and the interpersonal stuff hopefully is outlawed by RegFD. So we're talking about soft information, and that's exactly what the new generative AI model are getting better and better and better than. So I know it's provocative, but what do you think is the shelf life of that differentiation?
I think still there's a advantage for this, no matter how advanced this large language models they are, right? If I'm a fund manager, and I'm deploying this kind of algorithm, I still, the major source of my information is online, on the internet. Of course, I can have personal interaction, but that's limited. Maybe you and other, business people in this kind of financial market, you can have much more soft information like talking with insiders, and you got that information earlier or better.
Sorry, can I add one point? Yeah, so I think exactly why setting this benchmark is interesting because people are discussing about different types of AI, like generative AI, they can process information, and also these type of reinforcement learning AI, they use for trading automatically. So we're showing that at least the information part is really important in comparing their, so it's kind of an important limit of their behavior if you think they can only trade use this automatic very automatic. Yeah.
Exactly. So that's my earlier response. So in this paper, I want to show the information matters for the AI to all performance.
So the classic market microstructure literature, it's a beautiful literature, but we had one very strong weak point, the assumption of rational expectation. And listening to you and to the discussion, you gave the impression that the AI and Q-learning can actually become the rational agent. But this is misleading. Q-learning converges only if the environment is stationary. You created a stationary environment and then you ran the Q-learning and indeed you converge to a solution of the Bellman equation. By the way, Q is not the value function. It's almost. predict to max after you do the
There's
max
no
operator.
optimal data count, there's no data count for pair.
The point is that the stock market is not stationary. Nobody is giving you an infinite run. It's not stationary. So you can play out the Q-learning algorithm, but you most likely get things that are very inaccurate out of it. In practice, Q-learning is mind-blowing. It drives my Tesla, but because the environment is, even though it's so complex, it's nevertheless stationary, and definitely not adversarial as the stock market is.
That's a fair point. So let me first. So basically, here, that's why the title of the paper is the limits of AI trading. So that will make the AI even weaker, right? The one where you make this environment less stationary and iterative. So, but in the real life, they're more adaptive, more powerful. Of course, for illustrative purpose, here we really use the simplest reinforcement learning. But in practice, there's a frontier of the reinforcement learning, application literature research. They have more adaptive reinforcement learning. Try to mitigate this, non-stationarity in this environment to a certain level. Yes.
Yeah, and another interpretation is that maybe in a short period of time, where the market is relatively stationary, and because Q-learning or other type of algorithms that have this computing power and they can train on a lot of data, so it can somehow learn the stationary condition very fast. But I fully agree that it's very interesting to see if there's a regime change in the market and how stationary what will be the performance of the algorithm.
So I like what you're doing, but I think it's a little narrow when you call market data. You're only talking about price, right? But volume is astonishingly important, right? I mean, we worked on volume in the 90s. We wrote a really nice paper, but we never wrote another one. Because volume isn't normally distributed. It is very difficult for humans to figure it out, right? And so we wrote this paper. It was very informative, did all kinds of fun stuff, but it was too hard to work with, right? And so nobody works with it. But AI can work with it. And so when you begin to think about market data, I think you're overestimating us and underestimating them, right? Because I think AI models could work with the distributions of volume. And when you do that and you combine it with what you're doing for price, I'm not so sure the fight is as fair as you point out to be.
Yes. So of course, this is a theoretical piece of, that's why it's a benchmark theory. So in that sense, we abstract way, we try to make it, help us to think. Right? Based on here, next step, we can think, okay, what if in the quantities, the market all comes in quantities? If we allow machine to learn how much better they can do, they can achieve. So in this framework, actually, we can definitely have an extension. We can see not only learn from price, also from the flows. So what?
Yeah, we have a paper. It's in the mid-90s. It's easily looked up. It's Bloom.
Bloom is the one.
Yeah, and we solved the model for in kind of business. So you might look at it and see, but it's a mess. To be honest. It was so painful.
I like mess. You kind of.
I don't.
So I need to fight against it. Okay. Yes, thank you.
Somewhat related to Maureen's question, if you consider the quoting behavior, if there are some results showing that reinforcement learning algorithms can actually, left unchecked, they would engage into manipulation, spoofing. So then from that perspective, I just wonder, wouldn't that actually be creating noise through the algorithms, which is currently missing in the framework?
Yes, good point. Actually, this is like a theme of our previous papers. So for those who will take a role, so the AI need to know we have market powers, we can influence price. Otherwise, there's no point to do any manipulation. You cannot manipulate market. So that's the point of this paper set up. Each AI is agnostic, and they cannot, no matter what they do, they cannot move the market. So there's no manipulation. So that's what you said is very interesting. exactly focus of previous papers.
So I have two questions. It sounds as if the approach you're using here is like a stateless bandit, like you don't have each stage sort of IID. But if you make fundamentals persistent, you allow the agents to very well, it changes the nature of the game. And so that's what matters as well. If these agents can learn both offline and online, you still get to the same one if you add that. And then the other question is, it seems, again, the humans have the advantage of there's no attention constraints, right? So in a world where you have a little bit of attention constraints, if we go from like one asset to suddenly 4,000 assets in reality, and you have a fixed attention budget, does then the learning become a handicap instead of actually being an advantage when the other parties, which are the AIs, are just getting the chances?
Okay, so for the first question, the answer is no. So basically, we have a theoretical framework. So in this kind of, you can have persistence in the payoff. So we can reinterpret this V here as additional use, right? Additional use. It doesn't change anything. Actually, we have the extension. It doesn't change. Second question, my take is you're asking whether if we kind of extend to multi-asset or many assets.
With attention constraint.
Yeah. So yeah, that will give AI more advantage for sure. Yeah, that's a question.
Yeah, no, I did.
Okay, let me give a final comment for the paper. It's like it helps you understand what does this paper. So kind of this paper is at Chinko and Adam Clark-Jr. Basically, it's just using price data to predict returns. Here's message which is consistent with propagating curves of all of your observation. Basically, what happened is we use entry-level machine learning. We're very familiar with it because this is paper many years ago. Is you use stock return to predict your return and other stock return. Basically, you only have price information. But what happened is like if some stocks become predictor of other stocks, some news will come out in 5 minutes later. So that means you probably learn from the price some information. But sometimes it's too late to trade your own stocks. So what does AI do? They trade other stocks. Because humans have capacity constraint. So this is also related to the first paper actually. It's like because our field is mostly studying about single asset. It's like the information, like also it's like I think in market macro structure. Valentine data. It's like one of the biggest issues in the problem is spillover. It's like if you trade stock A, it might spill over to other stocks. I think lots of machine learning problem mysteriously learn the way intuition we get from the theory or the theory and extend that to across other stocks. I think that's probably one of the takeaway from today's session.
No, it's interesting you said yes. So basically, I mean, it definitely will help AI in this sector. But yeah,
it's cross.
Yeah, cross asset. So here we again here it's very simple framework. Okay, so you can think the AI here can do that. You can get some signal from other ways, and here we just say as long as in total private signal we can extract, not as good as what we're training against. So this is the limit we're looking at. But if we can get better ones, yes, we can outperform in more general cases for sure. Yeah. Thank you.
great pleasure to be back here after the first time I was to any conference, I discussed the paper at the NBR in 2003. And I remember I thought nobody would notice me. And then Maureen knew my name and Yakov, would pronounce my name correctly. I was a bit scared. So I still feel a bit intimidated after all these years. But we are like a large, big family that we all know each other. So it's all good. So this paper is joined with Andriy, who is there, who is in Atlanta, University of Georgia, and Elvira and Wingwa from Sydney. They came all the way from there to make sure that I present the empirical side correctly. So this is very preliminary. We have discussed a lot until we found this version. The theory was for a longer time it was ready. Now the empirical side is ready. So, but we will benefit a lot from your comments. So, and if we haven't cited someone, please let us know because we haven't yet done that full positioning job. Okay, so we know that so this paper is about what do market makers do, especially when they trade in multiple assets, because we kind of have models of market making in one asset, but what do they do in multiple assets? And we see that this is important. For example, Virtue in their IPO SEC filing, they said that a market maker's success depends on responding to market data, trading in similar and correlated instrument. So as you know, each trade has two sides: the liquidity demand, the market order, which people who are not in microstructure are more familiar with, if you want. But there's also the liquidity supply, the other side, who provides liquidity. And while those who take the markets, they pay the spread. Those who make the market, they gain the spread, but then they lose from inventory. And standard inventory models work one asset at a time. There are several papers that discuss multiple assets, but we haven't quite fully, as I said, positioned this paper. But the dealer typically holds many correlated assets at once. Yeah, so this paper, how does a dealer manage inventory across correlated assets? So we know we have a good theory of liquidity demand all the way back to Markowitz in the 50s. And risky assets, it's just one period. It's fairly simple. You trade the expected returns and covariance. And as a result, you have the efficient frontier, tangency portfolio, optimal portfolios. And if all investors agree on the inputs, then you get the CAPM model. So we kind of know the liquidity demand side. So what is the liquidity supply side? How do market makers behave in general? So that may sound like forgive the sort of the ambitious positioning of this paper, but it's about what do the market makers do on the other side when you have n correlated assets. And that problem is going to be more complicated because inventory management is a dynamic problem. It's not a static problem. So we already are at a disadvantage compared to Harry Markowitz. So we have n risky assets, infinitely many periods, and the inputs are standard deviations, correlations, and then what do market makers do in this kind of situations? What are the results? In particular, the market makers will set their quotes because here it's not just how much I want to, in the Markowitz setup is how much you want to trade. Here is what prices you set, and then the quantities depend on the quotes you set. And then how do you manage inventory multiple assets? In particular, how much cross hedging? If I get an inventory shock in one asset, how do I set my quotes in different assets? This is a crucial point in this paper. Is there any cross hedging? Do inventory shocks in one asset affect quotes in correlated assets? And what do these quotes depend on? And we also gonna address the problem: what assets do they choose to make markets in? This problem is underdeveloped. We're gonna do a simple version of it. There's yet much more to be done. Do market makers affect prices? Are they big enough? Well, we have Terry. Is Terry here? Terry's there. You usually stand at talks, so it's easier to see. So they have their price pressures paper. They show that in general, in one asset, if you have an inventory shock, you get some price pressure. Yeah, because when someone buys, then you as a market maker are short. You would like to, therefore, to buy. So then you have to encourage sellers. So you have to raise prices to encourage sellers, discourage buyers, basically. By the way, that looks also like an information trade because someone buys and both quotes go up. It looks like a price impact, informationally driven, but it is inventory driven. So that's an interesting result that they have. And they do it in one asset, looking at trades. We are doing it kind of in multiple assets and intraday as well. Yeah. So, and we look at how do we look at correlations, like return correlations, how does it vary with frequency? You have all kinds of questions. In any case, this paper is a dynamic model with n correlated assets. And then we do some tests on 45 trading days on the Toronto Stock Exchange. So I'm happy to put the model on one page, but there are some details that I have to go through more carefully. So there's a discrete time, infinite horizon. In the end, the model doesn't depend on what happens at the beginning. You can start with any inventory. The way they work out is that kind of in steady state, it doesn't matter. The important thing is that if you have two correlated assets, let's say IBM and Microsoft, this fundamental value in IBM and Microsoft, the changes of that have a fundamental correlation, let's say 40%. Yeah, and then you have other correlations. I'm gonna show the results for two assets. And there's a covariance matrix, this sigma V, that shows how all these n assets, their increments in the fundamental value are correlated. And this is the Hostall and Hendershot and Menville paper. If you know it, you will know that you post the quotes A and B. So just think of one asset for the time being. Now, this is for n assets, these are n-dimensional vectors, both the asks and the fundamental value, they are n-dimensional. This K is going to be a matrix, a positive definite symmetric. It's kind of, you can think of it as an inverse covariance. We're going to take it diagonal in this paper so that we don't have to worry about other issues. And so what does this is if you set the quotes, the ask price is set at A, what are the buy orders that are coming? Well, the buy orders depend on an elasticity K, the elasticity matrix K. Then it's how high the fundamental value is minus the ask price. Okay, so minus the ask price. Then there's an inelastic component, L, which is also an n-dimensional vector. And then there's a epsilon, which is a random, normally distributed shock. And don't ask when that shock is negative, okay? This is a standard question. Okay, I hope I'm not going to get that. Well, you know, you make L large enough so the probability is going to be negative. It's very tight. Anyway, this is just to be able to solve linear quadratic optimization, basically. And the same thing for the cell amount. Notice that there's a covariance matrix here also in the liquidity shocks epsilon. So that says that if I look at the liquidity demand in IBM and Microsoft, they may be positively correlated. And in practice, we're going to assume that they are. So this is kind of commonality in liquidity, if you want, a la Chordia and others. So the inventory then, how does it evolve? Well, the inventory next period is the inventory this period plus the quantity sold minus the quantity, sold minus the quantity bought. And the dealer is going to maximize the expected profit, calculated the fundamental value, with a time discount. Now, the time discount, you can think of it as y minus the probability that the world ends at that time. I think it's a standard microstructure assumption. And you are penalized by a quadratic inventory cost. So the market maker is essentially risk averse. It's not, as Terry shows in his paper, it's almost equivalent, but then in one limit when risk aversion is low, actually. But anyway, we're going to assume it's a quadratic penalty on inventory, where the matrix is the fundamental covariance matrix. If you liquidate all that at one point, it makes sense that that's what it should be. Okay, so, all right, so this is the model. And the solution is standard. Normally, you're going to set the ask and the bid around the price P. So P is the midpoint price. And you set the ask price at H. H is the half spread. By the way, the half spread is boring in these papers. It's just Terry notes says not that boring, but okay. It's the inverse elasticity parameter multiplied by the inelastic parameter. So the higher L, the higher you can afford to have a beta spread. The interesting part is the midpoint, the prices, which are basically shaded by this VT, by the inventory multiplied by this lambda matrix. So lambda is the matrix that says how inventory affect prices. So if someone buys, you get negative inventory, and that raises the prices, as I said before, in one asset. If you have multiple assets, what becomes interesting is what are the off-diagonal elements of this lambda? Is there any cross-hedging? If I raise the inventory in IBM, it's going to affect the quotes that, as a dealer, I'm going to pose in Microsoft. By the way, this is a monopolist dealer. If not, you can think of as being a monopolist against the residual demand, things like that. And the solution is you get the Riccati equation essentially, except that this time is in matrices. You show that if some things commute, and even if they don't commute, actually it works. There's a unique solution. And it has this kind of 1 minus beta that is not very pretty. And then, so that shows already that the dynamic component, remember, beta is the discount factor, is close to 1, but not exactly 1. So that, and later I'm gonna make beta almost exactly equal to 1 so that you get nicer formulas. Okay, but you can solve it like this. And then the price pressure says that if I get an inventory shock in IBM, I will change the quotes in IBM, but I also change the quotes in Microsoft. So lambda I is the diagonal element in IBM, but then in Microsoft is lambda ij. How much do I change prices, the quotes in Microsoft? And these off-diagonal elements are called cross-hedging. I'm actually curious if I can, I can do it with the, all right, so this is the cross-hedging. So to simplify the solution, we take a limit when beta goes close to 1. So then we get rid of this beta, 1 minus beta factor. It actually works very nicely. We don't have to worry about the time discount. And we get simpler formula. Lambda has this form. The nice thing, corollary 1 already shows 2 limit cases, which are quite intuitive. When you have low risk aversion, there is cross-hedging. So if you are not that risk averse, if you get a shock in IBM, you have enough time to say, look, because I'm long in Microsoft, long in IBM, and short in Microsoft, because IBM and Microsoft are correlated, I don't have to change the quotes that much because I'm already naturally hedged by the fact that IBM and Microsoft are correlated. And you can think of what happens if IBM and Microsoft are even more correlated. The more correlated they become, the happier I am, because if I'm long short, then I'm already perfectly hedged. It's as if I didn't have any inventory whatsoever. Yeah, so having this other correlated stock can help you. If gamma is large, though, what does very large risk aversion means? Means I'm gonna revert to 0 quite often. I get a shock. I don't like inventory at all because I get a large penalty. I want to go to 0 without having time to cross hedge. And the results show that when gamma is large with some asymptotics, sigma v, the fundamental volatility drops out, the covariance matrix drops out, and then lambda is just this k minus 1 is the inverse, which let's assume diagonal, so then lambda is diagonal. Okay, so an intuition is that the dealer mean reverts each inventory to 0 so quickly that hedging across assets has no time to be valuable. And so that's kind of it depends on, so if you're like a very high frequency trader, there's less cross hedging because you go to 0 quite often and you don't have time to think about cross hedging. If instead you have more of a horizon, you're less risk averse, then cross hedging should be there. Okay, this is just to show, let's focus on this part when correlation between IBM and Microsoft is positive. So this is solving with 2 assets. I'm just showing you a figure. It says that the cross hedging increases with correlation. If IBM and Microsoft are more correlated, then as correlation increases, I do less of what Terry, the price pressure saying I don't use IBM as much, and I use Microsoft more and more. In the limit, the stocks are identical because the correlation equals to 1, so then I treat the inventories as being just an inventory in just one stock. And in corollary 2, we show that we need risk. So as gamma goes from 1 to 10 to 1,000, we see that there's an inverse U shape that, you need risk aversion to cross hedge, but very high gamma eliminates cross hedging altogether. So the optimal, so like the highest amount of cross hedging is somewhere in the middle for intermediately risk averse market maker. Okay, so these are some sort of non-trivial perhaps results that you get all this kind of cross hedging, optimal cross hedging. So already, if you have the intuition that what happens when you have n assets, if they are almost perfectly correlated, let's say segmented markets, like perfect correlation fundamentally, then what happens to, so if you have n assets with the same correlation A, then the inventory half-life is approximately some number divided by 2. It's that thing. The intuition is that the more correlated assets you have, and the more correlated they are, then you don't need to go to 0 with your inventory in any particular asset. Yeah, so if in the limit when the correlation is almost 1, if I'm long in one stock and short in another, I don't have to hedge at all because I'm naturally hedged. So by not accounting for, if you only look at one stock, you would think that the market makers are less risk averse because you'll see they don't go to 0 that often. You say, oh, look, they're not that risk averse. They don't have to revert to 0 inventory. But the reason is because they have lots of assets in which they all correlated, and then they don't, in those multiple assets, they do cross hedging, so they don't have to go to 0 that often. In other words, the portfolio will go to 0 more often than the individual stocks, as we will see. That's a combination. So we denote the bias. The bias for n almost perfectly correlated assets goes almost to 100%. You can think that the market maker has very low risk aversion when in fact they're very risk averse. It depends on the correlation. The bias in the risk aversion actually is almost converges to A for a large number of assets. Converges to the correlation itself. So the single asset model underestimates the risk aversion, and the bias grows for both the number of assets and the correlation between these two. And then, of course, the question is, but is there any way to select assets? Like, suppose it's a bit like the Markowitz. Like, if you taught asset management or just basic finance, you have that picture with how does the efficient frontier depend on correlation? And you see that the lower the correlation, the better. The Markowitz investor likes it when assets are less correlated. And so what happens here, if you can choose those assets, would you choose high correlation, low correlation, middle correlation? What would be? I remember when I asked some people at the beginning, what do you think? Should be high correlation or low correlation? What is the answer? I think this is kind of, some people, it's not completely obvious if you haven't thought about this problem, if you should have low correlation or high correlation. In fact, it depends on risk aversion here. So if we think of a simplified problem, let's suppose that we can just control one parameter, the correlation. This is the simplest problem I could solve. I guess in the future we can tackle more difficult problems, but let's just choose this one. Suppose you could magically choose the correlation, tell IBM and Microsoft, be 40% correlated, be 60% correlation. Which one would you like? So it's a simplified problem. Well, there are two opposing forces. Higher correlation improves cross-hedging because they are correlated. So you like correlation because you can do a lot of cross-hedging. In the limit, I prefer 100% correlation because they naturally hedge against each other. But lower correlation improves diversification by reducing portfolio risk because you still have a portfolio of those stocks. So the general result is an optimal A star that balances this two. A star increases with liquidity correlation B. Remember, the IBM and Microsoft also have shocks that are correlated. The order flow is correlated there's commonality in this demand shocks. And the optimal correlation decreases with risk aversion. Yeah, because the more risk averse you are, the less you want this correlation. You become a Markowitz investor. In the limit, when gamma goes to infinity, you become a Markowitz investor, essentially. So let's look at low risk aversion. So if gamma, this risk aversion of the market maker, is close to 0, then, I mean, it's small. The dealer carries inventory longer and cross-hedging dominates diversification. And there's a threshold for this commonality in liquidity, this order flow correlation. Below that, below that, so above, if B is above that, so when things are very stressed, then you, so when B is low, yeah, so hold on a second. So I changed the slides just a few minutes ago, so it's suffer from this. And I realized I may have gotten the wrong slides. All right, this is a threshold. The interesting thing, yes, I'll have to think about, I thought I wrote after this, but I didn't. Okay. Yeah, it's interesting. Unfortunately, during the empirical part, we don't have, when B jumps, when this commonality in liquidity, if the order flow becomes more correlated, it jumps above the threshold, then you suddenly prefer very high diversification, very high correlation. If it goes below, then it's low. So it kind of, it switches between two. It's a bang-bang solution depending on this B star. So that's a nice empirical implication. Anyway, I didn't write those bullet points there. While if you have high risk aversion, inventory costs dominate spread revenues and dealer becomes like a Markowitz investor and diversification dominates cross-hedging. And yeah, optimal return correlation, so it falls as the risk aversion increases. Okay, so I'm not gonna say much. So this also has implication on returns. There's what's called an EPS effect that at the lower, at the one period, so high frequency, what market makers do is just basically noise kind of. But as you increase the fundamental news, so what is the change in prices? The fundamental news minus the inventory pressure. Inventory pressure is mean reverting. So over the longer, at the lower frequency, it disappears and you only have fundamental news, which is a random walk. So the nice thing is that you start suddenly, initially you have low correlation at high frequency, but as you increase, the correlation becomes, goes to the fundamental level, say 40% between Microsoft and IBM. That's called the EPS effect. It has been, I mean, it can be explained by many things, but this is kind of an inventory explanation that we have. So this is the EPS effect in Chrysler and Ford, all the way back to 1970 something. EPS is a statistician. All right, so I'm not going to talk much about it because I don't have much time. This is the empirical design. I only have 5 minutes. That's what Gideon tells me. So I only 3 he tells me. So this is, as a theorist, I cannot be too upset about that. But the idea is that we're going to look at quotes. The nice thing is that we look intraday at quotes, and we basically the off-diagonal prediction is that if stocks I and J are positively correlated, then they're off-diagonal elements. Yeah. So a dealer that's long IBM should quote Microsoft to sell, should increase the quote. So we should observe this correlation. And basically, we look in the data. It's a bit trickier because dealers are risk averse. There are lots of assets that they hold. So then you are not going to observe much cross-hedging. You have to know how to look. And that's what we have spent a lot of time in the empirical section to observe this, what we call episodes of. So I could say very quickly that, so we use the Toronto Stock Exchange. We have 45 trading days. I'm going to move very quickly. We want to observe this off-diagonal effects. We have about 550 market makers. Some of them are designated only. Some of them are endogenous. We classify because they post on both sides, and some of them do both. Theory should apply to both. Anyway, we see that, and this is something interesting, is that at the portfolio level, they mean revert much more quickly than they do at the stock level. So there is cross-hedging. Okay, I'm just gonna, so there is evidence of cross-hedging, and there's lots of episodes. We showed that they increase with correlations and other good stuff. So basically we test the portfolio, but I think our discussion will hopefully save me from having 1 minute to talk. So all I'm gonna say is that the cross-hedging episodes are widespread, concentrated in just 3 stocks, and modest. Okay, they're not very strong. So, but the cross-hedging exists. Okay, and I'm done. A tractable portfolio of liquidity supply, cross-hedging exists in theory. And we hope it exists in practice as well. We have proved some evidence. What I like to say is that, Harry Markowitz was never asked to prove that modern portfolio theory works in practice. So hopefully we should not have too much pressure on ourselves. Sorry for being a bit immodest, but we do try to analyze theoretically this aspect, and the empirics is still in progress. Thank you.
Going now discussing the power.
So I have to say, one advantage of being in the profession for a long time is that you kind of can forecast what's going to happen. I knew Yannick was not going to talk about the empirical part, so I'm going to talk about the empirical part. Also because it's our comparative advantage, shall I say. Thank you very much to the organizers for putting together such a nice program and for asking me to discuss this paper. I have to say that when I received the paper, I was like, oh my God, this is the dream team of market microstructure. I had really high expectations and the authors met my expectations. So overall, I would say that I had a good week reading this paper, and also the fact that Spain is in the final on some. I would not say which I derive more utility from, but I think you can all guess, no? Okay. So what is this paper about? In my view, this paper is going to ask three very important questions. The first question the authors are going to ask is, how do market makers manage their exposure or their inventory risk when they have multiple assets in their inventory? And the answer the authors are going to give is going to depend. So if the assets in the inventory of the market maker are very highly correlated, then it's going to end up that this market maker is going to treat them as perfect substitutes, and there's going to be a lot of cross-hedging. And in my view, this is very important because it has implications for the price volatility. So basically, if the market maker is able to cross-hedge more these risks, then the prices will be less volatile. And also it has implications for how quickly the inventory of a single asset goes to zero. Like Yanni explained, basically, if you're able to cross-hedge, then you'll see that the single stock inventory is not going to go to zero so quickly. Basically, the market maker is going to look like it tolerates a higher inventory risk in a single asset. And then the opposing force is if the market maker turns out to be very risk averse, or in my mind, if you think that risk aversion changes over time, if there is a crisis where everybody's very risk averse, then you're going to forget about cross-hedging and everybody's going to try to have the single stock inventory go to zero very quickly. You're going to see unwinding. The second question the authors ask is, does the market maker's inventory in one asset, asset A, is going to affect the liquidity in asset B? And the answer is going to be yes, as long as there is cross-hedging. And that's sort of for obvious reasons, because you're using the buying orders or the selling orders in one asset, and then you're going to change the liquidity in another asset in order to cross-hedge. And then the last question is, does ignoring that the market maker has multiple assets is going to make the researchers underestimate the risk aversion of the market maker? And the answer again is going to be yes, because we usually measure risk aversion by looking at how quickly the inventory in one single asset is going to zero. And if there are cross-hedging, I just said that it's going to take longer for the single asset inventory to go to zero. So in my view, those are the three important questions. And the way they're going to answer those questions, like Yanni just explained, is going to be using a theoretical model. And the key ingredients of the theoretical model are basically, this is going to be a dealer model with multiple assets. The big assumption here is that there is no asymmetric information, and I'll tell you a little bit later why I think that's important. And then the main drivers of the quotes are going to be the dealer risk aversion and the dealer's inventory holdings. So let me, explain to you how the model works with an example that I think Yanni already talked about Microsoft and IBM, but I'll talk about Exxon and Chevron. So I think in this slide is very concrete example will help you sort of understand how this model is working. Basically, at time zero, let's say I am the market maker. I have one share of ExxonMobil. And then at time 1, I have Yanni coming selling a share of Exxon. And this means that I will have now 2 shares of ExxonMobil at time t. And then what I'm going to do is lower the price of ExxonMobil and also Chevron to attract buyers of the shares. And so I'll have Elvira and Paolo come buy Exxon and Chevron separately. And this means that even though I still have 1 ExxonMobil share and 1 -1 Chevron, I'm going to have a 0 inventory because I'm going to treat the portfolio of stocks. And the single asset model basically will predict that the price drop in Exxon when I receive the original sell order is going to be higher because I would have to entice 2 buyers of ExxonMobil as opposed to only 1 buyer of Exxon and another one of Chevron. So that's it for the theory for me. And now I'll talk about the empirical part of the paper. They have very nice data set from Toronto Stock Exchange, 45 days in 2006. On average, 1,200 stocks are traded. And like Yanni said, actually, they have data on the market makers. And what I think is the nicest part of the data set is that they can identify these different types of market makers. The designated market makers are those that have almost no choice in the portfolio that they have. They are assigned these stocks. Then the endogenous market makers who have full choice, and then the ones that are both. Some of them are assigned to them, and some of them they can choose. Okay, and then the empirical the first empirical evidence that the authors present is that basically they're going to look at the separate market makers and they're going to look at the single asset inventory and see how quickly that goes to 0. And then they're going to take the portfolio of stocks in the market maker and then see how quickly that goes to 0. And if there is cross-hedging, then you should observe that the single asset inventory goes to 0 more slowly than the portfolio inventory. And that's exactly what you observe. I have the numbers there for the endogenous market maker and the designated market maker. You see that on average, the portfolio of stocks goes to 0 once per day for the endogenous market makers, and it goes 0.3 times a day when you look at the single stock. And for the designated market makers, you observe the same thing. It goes 3.6 times a day for the portfolio versus only 1 time a day. Okay, so here's where my first comment comes in. And I think what the paper needs to do a little bit better is sort of ruling out alternative explanations for that univariate statistic that you show me. I think the most difficult part of the paper is providing convincing empirical evidence that supports this model versus other explanations that we have for observing that the single asset inventory goes to 0 more slowly than the portfolio inventory. I do believe that market makers should be managing their exposures with cross-hedging, but I think it's difficult for the authors to test those implications. And it's difficult for 2 reasons, and Yanni already said that, is that cross-hedging doesn't happen all the time. And the other one is that this cross-hedging behavior is consistent with other theories. And in my next slide, I'll just give you the same example that the authors sort of use, which is, take again the example where Yanni comes to sell ExxonMobil to the market maker, and the explanation in this paper for lowering both the ExxonMobil and the Chevron prices is that the market maker is cross-hedging. But I can come up with another explanation, which is there is public information or there's a shock to ExxonMobil, and then the market maker will also want to lower the prices of Chevron because they know, I'm assuming the market maker knows that Yanni has information, and that's why I should be lowering the prices of both. There's also a paper that Paolo and I have written that talks about the fact that the informed traders know what the market maker is going to do, and it can also use that strategically to its own advantage. So basically, my first ask to the authors is to try to rule out better alternative theories. And to be fair to the authors, they know this and they talk about alternative explanations. This is what they call the correlated order flow could also explain this behavior. And so one way the authors can solve my complaint is by just exposition. Just talking early on, this is a model that explains this behavior, but there are other theories that explain that behavior. And also Warner sort of, this is just univariate evidence. I'm going to show you better or more unique evidence of my model later on. I think it's not only exposition. I would say that the authors can actually do more empirically. Some things that the authors can do is control for other variables, public information, private information, are the prices adjusting temporarily or more permanently. And then I think some of the results, I was a little bit puzzled that you were using all of the stocks as opposed to just focusing on those that are highly correlated, because that's where we expect the cross-hedging to take place. I would also try to perhaps compare the behavior of a risk-averse market maker, if you can identify those, versus the non-risk-averse market makers. And I think it would be really interesting to see how these market makers behave when there is a shock. Basically, I don't know if in the 40 days in 2006, maybe it's not the best year for having shocks, but it would be interesting to see how the market makers behave when there is a shock. Okay. A key distinction that the authors do highlight that is unique, I think, or is different from the other stories that I presented, is that in the information story, you would see that the inventory of ExxonMobil and Chevron are moving together. They're positively correlated. In the model of cross-hedging, the inventory of ExxonMobil and Chevron should be negatively correlated. And this is a table in the paper where they show that actually cross-hedging happens both when the inventory is negatively correlated and when it's positively correlated. So then this is telling me that both the stories are true, that the cross-hedging behavior happens because there is a public information event, and the cross-hedging also happens because the market makers are actually cross-hedging. But I'll just point out that there are other theories. So the theory of Paolo, the paper I have with Paolo, would also have this prediction that the inventory, when the informed trader is behaving strategically, would also be negatively correlated. So this is just a matter of maybe controlling for some factors, or basically just trying to have more unique predictions of the model. Okay, so that was my comment number one. Comment number two is that I really find interesting the fact that you can identify the different market makers. The authors talk about the fact that they should be behaving very similarly, but my intuition is that I see endogenous market makers as having full choice. So because they're not constrained, I would think that they cross-hedge more than the designated market makers. I guess some interesting questions you could ask is whether, if I have one type of market maker more than the other, which one is better in terms of financial stability. So is the market maker that is cross-hedging, for example, making the market more resilient? And I would think yes, because it's reducing volatility, but perhaps not, because there is contagion of information going from one stock to the other more quickly. I have to say, though, that some of the results in the paper are going against my intuition. So one result that I wanted to point out is that, as I said, I thought the endogenous market maker would be the one that cross-hedges more, but it looks in their paper that if I look at the portfolio of the stocks of the endogenous market maker, those goes to zero more slowly than those for the designated market maker. And then I thought, but wait a second, risk aversion also matters. But it turns out that actually risk aversion goes in the opposite direction, because what they show is that the designated market makers are the ones that are more risk averse. So I guess one ask I have for the authors is whether they can explain a little bit better what these results are, which I find counterintuitive. And then my last comment is that the prevalence of cross-hatching is actually sort of limited. The authors mentioned that on average, only 26 minutes a day, they observe cross-hatching. And cross-hatching is actually also very highly correlated. So they have that the top 3 stocks account for 86 or 100% of the cross-hatching activity. And so my comment to the authors is whether they can empirically show that this phenomenon is perhaps very important. And I go again with periods of stress where I think this cross-hatching would be more important. It's also sort of a puzzle to me that we don't observe more cross-hatching. I guess there's a whole literature about firms not cross-hatching, not hedging their risks. So maybe this is all related. In any case, my conclusion is that the authors are the dream team of market microstructure. So I have high expectations for the paper, and I think the paper is very good. I just have 3 suggestions for the authors, and I hope Spain wins tomorrow. Thank you very much.
Thank you, Clara. Comments, questions? Right.
Okay. Very nice. On the empirical front, maybe one suggestion would be to, and that also could address actually Clara's comment, is to focus on ETFs and their market makers, because there you have, first of all, a lot of retail flow, very little institutional flow, and you have probably more public information, less private information. So the idea of correlated trading from informed traders is much less of a role. And I think there, because there's very strongly correlated portfolios of ETFs, having to say index of useful.
Yeah, so I want to go back to the point that Clara made about the half-life of the inventories not being exactly what she expected with regards to the endogenous market makers. So when you have endogenous market makers, my prior is that at least a subset of them are probably institutional investors who are providing liquidity of certain funds. And then my other prior is that if that's the case, there's probably some form of financial constraints that, for example, comes from the fact that they have to track their performance against an index or something like that, and that sort of forces them to move positions more quickly.
By the way, we defined market makers as posting liquidity on both sides. We didn't restrict like NASDAQ to say that they go to zero inventory at the end of the day. So it could be there are many other that do prop trading. So we have too many people who are not perhaps necessarily.
I think this motivates actually your approach. It's not against it.
Yeah.
I was just like thinking about how you could use this.
Yes, no, point taken. I was just saying that we define market makers solely by two-sided liquidity provision.
I was also going to mention the ETF comment, but I think just to push on it, you can imagine that in theory, adding a basket security is probably highly intimating that the other assets could help you quite a bit in terms of matching the empirical facts. And you can imagine also in terms of the empirics, if you saw any market maker in SPY, say, and you missed all of their inventory in the futures, it would look, I imagine, pretty crazy, pretty different from that exposure. I think just adding that piece alone could help rationalize something.
You're right. No, great suggestion. Thanks, Andreas. That's it also gives the disinformation story that it's.
Yes. Well, I was going to address one of the comments, but maybe we get I didn't see the other camp question.
Very cool. So there are some multi-asset related that are actually just correlation. For example, when you think of the VAR model, and I think, I think if you take that into account, the dynamics of the assets, you can have zero correlation but still have configuration. I think your model may actually underestimate how very good assets are.
I'm not sure, I didn't understand, so you have the VAR of what returns and,
Yeah.
so like I don't understand, zero correlation with co-integration, oh, prices.
Yeah, yeah.
Okay, I'll have to think about that, so I haven't
You're-
thought.
Think of a multivariate formal process, and I think I mean, if you do that, the recast will be much harder to solve. I remember doing that with my group, but I think
And by the way, I tried to make the model look as simple as I could, but you realize it's infinite demand, it's infinite horizon, so anything that's not linear quadratic, it's bound to.
it stays enough.
Okay. Oh, okay.
Yeah, I wanted to make a comment, a boring comment about literature papers and what you're doing. The people are more experienced than me. I remember these papers, Corwin, 1999, Huguenot and Deng in 2002. These are papers that looked at something that was called the specialist Boston panel. You might remember, like the way the NYSE was structured is that the specialist was assigned a post. The post was literally a physical location, and then a panel. And at the panel, there were quasi-randomly assigned stocks to the specialists. And I remember that these two papers looked at whether the specialists managed their inventory differently depending on which stocks were assigned. And you might want to look at those because those were really a quasi-random experiment because the stocks that were assigned to the specialists came from a queue. You remember, Pavel, we worked on this data too. And the queue is basically whoever comes first gets assigned. So it's not that if you're a specialist and you're managing oil stocks, you get assigned an additional stock from the oil industry so that you can manage your inventory better. And perhaps you can look at this data, which I remember were relatively easily available, and see whether you could play with this quasi-random values to see whether the behavior of the specialist, or if you cannot get specialist data, the behavior of the stock prices change in correspondence with this assignment.
Let me one up you. So, you know, thinking about literature, right? You start by reading Stoll 17. It was always a portfolio decision, right? And then in the 90s, there were people trying to test that. So Dietrich Werner and Peter Rees did a paper about that. There was another paper about Gimli, and both of them used London Stock Exchange. And they didn't find it. Okay? And so for a while it went away. And my kind of hunch is that what brought it back is technology. Right? It was much more difficult to do it when it had to be done manually than when technology allowed to be very, very efficient. Currently, the paperwork can't really address that, in fact, because you're limited by sample. But if your model can produce predictions, not necessarily about the market maker's inventory, but rather about commonality of liquidity among stocks, then now you have a huge time series in which you can do all kinds of experiments with, you know, technology events and so on and so forth to see if you get.
The commonality of liquidity is a parameter. It's the correlation of the oil flow. But if we put other things,
You generate some of that acknowledgement then to allow for much richer testing.
From a practical standpoint, I believe the benefits from cross-hedging may depend also on the presence or absence of cross-margining. So portfolio marginings, that's an additional cost. So I believe maybe the theory model benefit from adding some costs.
cross-margin, like if you can use one as collateral for the other.
Yeah, whether your margin is takes into account the correlations, like whether it's assigned on the portfolio level or it's the sum of individual ones. And this could perhaps help explain some of the results that you have, why this cross-hedging doesn't persist too long.
Any additional?
Well, the temperature is what it's for.
All right.
Sorry.
No, I just wanted to say if we have a second, thank you so much for the comments, Clara. So one of Clara's comment was, why is it that we see more cross-hedging like evidence for DMMs compared to EMMs? And then Yash also had an idea on that. So we are able to identify DMMs a lot more sharply than we are able to identify EMMs, and we could probably work a little bit more on that identification. So I would say when it comes to looking for real evidence for cross-hedging right now, it is in the DMM accounts, and we'll do more work to sharpen the EMF part.
Right.
Right, thank you very much. Coffee break.
I hope that friend sweets, by the way, also.
Now that Franz is not there.
But-
Yes, this is, yeah, I'm not.
This is great, like, we are on time, I think.
I think it's, I'm not sure the clicker will work on this website. Just
I
because
clicked on
it's
this.
not
I don't know.
a presentation technically. So it might.
I think it's just because I clicked on
You
this.
clicked on it.
I just have to be careful. Okay, welcome to the last session, and Faisal, take it away.
Thank you. I'm just gonna time myself because I don't want to have the 5-minute thing just at the end. Okay, thank you so much to the program committee for accepting this paper. It's an honor to be presenting in front of this audience at this great conference. It's my first time, and I will be talking about the viability of blockchain technology for running markets. And this is joint work with Agostino from Columbia and Alvaro from Oxford. Both are not here, so go easy on me. Okay, first, why are we studying blockchains? Well, blockchains promise to coordinate economic activity at scale without requiring a central authority, and this is exciting. So in that sense, it's interesting, and we think that financial markets, blockchain technology for financial markets is a fundamental test of that promise. What's more important is that we believe that the role of blockchains and blockchain trading is likely to grow with tokenization of real-world assets that will, it's projected to attain trillions in a few years. Stablecoins are very much traded on blockchains today, and blockchain technology is projected to be used for FX trading between international banks. So it is important to study blockchains as an infrastructure for markets. So what is a blockchain? Usually I don't define it, but I think here it's important. A blockchain is a distributed digital permissionless ledger. The job of the blockchain is to store and execute transactions. And the important feature is that it doesn't require a central authority. It just does it through what's called consensus. So what is this consensus? It is a bunch of algorithms that govern how the blockchain evolves and executes transactions. And that's really important because how the blockchain executes transactions is how the microstructure of blockchains actually operate, right? So it is important to know how that happens. And the consensus makes the blockchain evolve in rounds. And at the end of each round, a block is created. And this is how the round goes. Okay, it's supposed to be a picture there. Okay, but anyway, just imagine a block. Not lucky there. Sorry. Okay, so a blockchain round starts with anyone who is connected to the blockchain, so it's permissionless, send in their transactions. A very important feature here is that when you send your transaction, it doesn't get executed immediately. And as the round is evolving, the blockchain picks some blockchain participants. And these guys, what do? They do what's called consensus work, and that requires some network communications, a little bit of cryptographic work. And it's only when they do that a block is created. And when the new block is created, that's when these transactions that have been sent throughout the round are actually executed. Okay, so what I want you to remember from this slide is that this consensus, it requires time, and the most popular blockchains usually, that takes around 12 seconds. And when a block is created, the transactions that have been sent throughout the round, they're not executed completely randomly. They're executed in a very specific order, and that's called priority fees. And these priority fees are revenue for all these people that do this consensus work. And this is how priority fees work. In the start of the blockchain round, if I arrive, I'm a dumb trader. I arrive at the beginning of the blockchain round, and I send a transaction, and I attach to it a priority fee of $2. And at the end of the blockchain round, say 12 seconds later, Maureen, very smart trader, and I'm not just saying this so she doesn't ask me very difficult questions, but she arrives at the end of the blockchain round, and she sends a transaction with a $5 priority fee. When the block is created, the block will clear transactions in an order of priority fees, Maureen's transaction first and mine at the end. Even though she sends her transaction after mine, her transaction is executed first. Okay, so how are blockchain different from traditional markets? In very meaningful ways, we think that deserve a paper, at least. 3 things. Price impact is mechanical. I will explain this. Price impact is mechanical, liquidity provision is passive,
and there is paid priority. And this is what I mean. Before the blockchain round even starts and traders are sending their transactions, liquidity is already sitting in the blockchain. Liquidity is in what's called a smart contract. And a smart contract, for people that don't know, has two features. One, it's a piece of memory where basically liquidity is just resting there. You can think of liquidity as dollars and some shares of Microsoft. And also it is code. And that code defines, as a function of how liquid this smart contract is, how prices update. And this is how it works. So let's say the blockchain round is over. There are a bunch of transactions, and now the block will be created. And as I told you, the block executes transaction after transaction. When the first transaction is executed against that smart contract, the price updates. It's important here to remember that it's not a market maker who observed that transaction, learned something, and then updates in a Bayesian way what they think the price is, and then offers a new spread. That's code that determines how this price innovation happens, the code of that smart contract there. Second transaction is executed, price updates again, third one, fourth one, until the block is completely cleared. Okay, mechanical price update rule, liquidity provision is passive, and these transactions here are ordered by the priority fee that they had to pay. Okay? So let's recap how blockchain markets are different. Electronic markets continues trading, blockchain trading is discrete, so price discovery is delayed, price impact is mechanical and it's not Bayesian. There is time and paid priority in blockchain. Time because one block after the other, it's ordered by time, but within each block, it's paid priority, or priority fees. And which means that here we need a model with discriminatory pricing. Are these differences good or bad for markets? I think it's a very interesting question to ask. And there are some, at least in the data, indications that it's not very good for markets. When you look at assets who are traded significantly on both blockchains and electronic markets, you realize that price moves tend to amplify on the blockchain. And you can see here that prices are much more volatile on blockchains than on electronic markets. Sorry, if it's small, you can just listen to my voice. Okay, so blockchains tend to overshoot. Why is that? Can we make sense of this? And our paper does. And in fact, it asks the deeper question as to whether blockchain can host viable markets. Does this technology able to host viable markets? We show that the features of decentralization, namely paid priority, this ex-ante price update schedule, and of course, one important ingredient that I will show later is that traders have to be heterogeneous. That leads to what we call endogenous selection. And we show that in equilibrium, because of these features, only high valuation traders, only aggressive traders end up participating in blockchain trading. And that, as a result, pushes prices to extremes. It also truncates the amount of information that ends up impounded in prices. And it leads to prices that are more volatile and also to less liquidity in the market. And yeah, to summarize, we show that features of blockchain technology distorts price formation. How do we do that? With a theoretical model of a blockchain trading round. Okay, of course, our paper sits in a very rich literature. I want to especially point to papers by Andreas Park, Katja Malinova, Joel Hasbrook, Fahad Saleh, Alfred Lahar, and Christine Parlour. Very beautiful papers that basically describe the microstructure of these smart contracts that I just described, right? Like, remember that I said, oh, there's a code that updates prices and whatever. All of this has been very well studied in these papers. And in contrast to this literature, the difference here is we will define a blockchain market as not only the smart contract, but also the infrastructure on which that smart contract is running. Okay, and of course our paper is related to, as you'll see, to classical models of microstructure. Because of this paid priority feature, we had to come up and design some new type of auction. In that sense, our results are related to political contest and also periodic auctions and opening and closing auctions. In the interest of time, I won't go into details as to why we're related to all this stuff, but happy to come back on this if you want. Okay, so let's jump to the model. I said that smart contracts has liquidity, which I will call this capital L, and it's a bunch of code. So let's define what that code does. The input of the code is how liquid the smart contract is, and the trade that is received by the smart contract. And if the smart contract receives a trade of size capital Q, it updates the price by 2Q over L. If you trade more, you impact the price more. If the market is more liquid, you impact the price less. Okay, so that's a mechanical rule there. Okay. The smart contract also offers a convex price schedule. In fact, here we're going to say it's quadratic. The more you trade, the higher execution cost. The more liquid the smart contract, the lower your execution cost. And finally, there's going to be a very small portion, pi, of the quantity that you're trading that will be given back to the liquidity providers who are putting their money in that smart contract. Okay, why would informed traders even compete? Well, consider this very simple example. Let's say a block only has 2 trades, and we are at the end of the blockchain round, and now that this block is going to be created, which means that the buy of trader 1 will be executed and then buy of trader 2. Trader 1 is executed first, so they have to pay their execution costs. Trader 2 will have to pay their own execution cost, but also the impact of the trader just before them. Okay, so trader 2 has an incentive to pay maybe higher priority fees to obtain a better price. And that's the object of the competition, is this adverse price impact of traders that are executed before you're in the block. What is the competition structure? So remember that the blockchain round is long, so you can think it's a dynamic competition with signaling or anything. We just decided to go to the data, and what we see here is the distribution of the priority fees that traders submit as a function of the timing in the blockchain round. And what you can see here is that traders who submit the highest priority fees submit their transaction at the end of the blockchain round. Why is that? Simply because first thing is, if you read the paper by Agostino and Wija in the RFS, you know that traders who submit high priority fees mean informed traders. And what basically this picture says is that informed traders wait until the end of the blockchain round to submit their transactions. Why is that? Because if they do it at the beginning, they're basically giving out their information. Everything that happens on the blockchain is public. And if they wait until the end, well, they can incorporate more information to make more informed decisions, right? It makes complete sense. So what I'm trying to say here is that even though the blockchain round is 12 seconds, we will model the competition among informed traders as a single round auction. It will be a blind auction. We cannot see each other priority fees, and it will be a multi-prize auction. Everybody wins, but at different prices, right? The multi-prize part is, the discriminatory pricing part. Okay, the model is going to be a three-stage game. In stage 1, there's going to be entry. A bunch of traders will decide whether or not to become informed, and they have to pay a fixed cost for that. In stage 2, a liquidity provider will choose how much to put in that smart contract. And in stage 3, they will be trading. There's 2 types of trading. One, informed traders who will compete for position in the next block. And we endogenize their priority fees and their trading volumes. And there's going to be a second type of trading, which is noise traders. And we just assume that they post transactions with 0 priority fees. Of course, we solve this backward. We endogenize first the priority fees and the volumes, the liquidity, and then entry to blockchain trading. Okay, so let's start with stage 3. Stage 3 is about competition among informed traders. In our setup, we are in stage 3 already, so we know the number of traders that are competing, and we will assume that they're trading in the same direction. Why? Because remember that they only wait for the end of the blockchain round to send their transaction, and if there's information in the market, it just makes sense to assume that they're trading in the same direction. Okay, and we are interested in these cases. So they have some valuation of the asset, and each trader will choose their priority fees and volume. So we need to know what is the expected wealth of each trader. For each trader to have an estimate of their wealth, they have to have an estimate of the volume that is executed before them in the block. What it means is that it's the volume of traders who are submitting a higher priority fee than themselves, right? If I choose this priority fee and all these traders have a higher priority fee, then it means that they will be executed before in the block. So by the time my transactions comes, a bunch of price impacts have already happened, right? And remember that the price impact is mechanical. And if I have an estimate of this volume, then I have an estimate, because of the algorithmic rule of the smart contract, I have an estimate of the price by the time my transactions come, okay? And let's look at the expected wealth of each trader. They have an inventory, so which they value at their private information. They have to pay a priority fee. They have to pay some execution costs in the smart contract, and they have to suffer this adverse price impact and also pay some information costs. Okay, so these 5 components are important. And because this objective is well behaved, I will first solve for priority fees for a fixed distribution of volumes and then endogenize the volumes. For the priority fee, I can simplify the optimization problem to these 2 components. One is the priority fee. It's a negative component. It's a cost. And the second is the surplus, right? And the surplus is the impact that the trader I will avoid by paying this priority capital phi I. And this is an illustration of this. If trader I is here, if he pays a higher priority fee, then he will be having a better position in the block and will increase this surplus. Okay, so standard auction there. We show that in equilibrium, the priority fees will be increasing in the volume. Why? Because if you want to trade a larger volume, then it means that you will need to suffer more from the price impacts of traders with better positions. And that means that you have more to gain from competing. And as a result, you increase your priority fee. And because you're increasing your priority fee, it means that you will have an earlier position in the block. So what this story tells us is that people that have good positions in block usually trade larger volumes. And this is exactly what we see in the data. So these are assets that are only traded on the blockchain. So price formation actually happens on the blockchain. And we see that the distribution of the absolute trading volume as a function of positioning the block, right? Traders who have the best positions trade higher quantities. Okay, so that's a prediction that is confirmed by data. We also show that the equilibrium priority fee, it's important, is increasing in the number of traders that I'm competing with, simply because if I'm competing with more traders, then it means that in expectation, there will be more traders before me in the block, and that means that it will be larger volume ahead. There's more to gain from priority, then that's an incentive for me to increase my priority fee. That's for fixed distribution of volumes. Now I will endogenize the trading volumes, and each trader will anticipate that they will be needing to pay a priority fee when they trade aggressively. The more they want to trade, the more they need to pay priority fees, and that's anticipated by every trader. In equilibrium, we see that the equilibrium volume has 3 components. One that is driven by how liquid the market is, one by how much I value the assets, that's like expected profits, and the third component is the impact of traders with better positions. In equilibrium, the volume is increasing in the valuation because a higher valuation means higher trading profits, and higher trading profits is an incentive to trade more. But perhaps the most important result is this endogenous selection. And we find that in equilibrium, only high valuation traders end up sending non-zero trading volumes. And the intuition goes as follows, and it's really important. If I have a low valuation of the asset, then my incentive to trade is low, so I don't want to trade a high volume. And because I don't want to trade a high volume, I won't be paying a high priority fee. And because I won't be paying a high priority fee, I anticipate that higher valuation traders will be executed before me. It means that there's a large volume of trades before me. And if I anticipate that, it means that the price will be pushed, right? And if I have a low enough valuation, it might just be that the price is pushed beyond my valuation and I don't want to trade anymore, okay? And in fact, more importantly, this cutoff, which is the required valuation for me to even participate, is increasing in the number of traders that enter the market. Why? Because if I compete with more traders, then for each individual trader, it becomes more and more expensive for us to trade. It means that the required valuation to even participate gets larger and larger. So what is the consequence of this result? First, it means that if I have a distribution of valuation, only a fraction of that distribution ends up being in the market. Priority fees and volumes are fully revealing, but only when they are in a block, right? So information is truncated. A second result that we have is that as a result of increasingly aggressive traders trading because of competition, the price at the very end of the block is also biased toward extremes. Okay, so information is truncated and prices are biased. And this is exactly the table that I showed you before, where I told you that prices are more volatile. So our model provides basically an explanation as to why is that. It's just because of this endogenous selection effect, only aggressive traders end up trading and they push the prices too much. Okay, so let's recap this stage 3 results. I think I have 6 minutes. So what we saw in stage 3 is basically a prediction of what is the equilibrium structure of a block. So just follow me on this. First, we said that there are two types of traders, informed and uninformed. Traders that are informed find it optimal to pay non-zero priority fees, so we would expect them to be at the beginning of that block. Noise traders, it's an assumption, it's not a prediction, but we assume that they pay zero fees, so they will be later in the block. And front of the block, informed traders that trade in the same direction with decreasing volumes, and back of the block, noise traders with net volume around zero. And this is exactly what we see in the data. This is the average block in Ethereum, which is a famous blockchain, since blockchain trading ever started, and we only select the assets that are traded only on blockchains and not on electronic markets. And we see that the average block, so this is normalized, meaning normalized by the sign of the first transaction. This is why it's all positive, right? So the average block looks like this. 30-something% of the block are traders that trade high volumes in the same direction with decreasing volumes. And the rest, 70%, are two-sided zero mean type of volume, okay? So again, a prediction of the model that we see in the data. Okay, so we endogenize priority fees and volumes, and in stage 2, there's a liquidity provider that has rational expectations as to what's going to happen in terms of trading later on, and we derive the equilibrium liquidity here because there's nothing new compared to what in fact, better than me. We just assume that liquidity provision is competitive, so whatever is gained from providing liquidity to some price-sensitive noise demand, we assume that they're price-sensitive, is going to be equal to whatever liquidity provider loses to informed traders. And in equilibrium, we find that liquidity decreases with the number of traders, which is, again, standard result here in our case, because more competitors means a higher cutoff. Remember that required valuation to even participate gets larger and larger. It means that prices are pushed to more extremes, and that means that prices overshoot, and there's more adverse selection, and the liquidity provider anticipates this and decreases the liquidity, right? And we also derive a market viability condition that depends on the number of traders and how precise their information is. We endogenize entry to blockchain trading as well, and that means endogenizing the number of traders that pay some information cost. Before observing their private information, every trader has an estimation of their ex-ante profit, and if that covers some information cost, they enter and pay that information cost. In equilibrium, we define the equilibrium number of traders at the highest M such that this still holds, right? And we find a very, very interesting effect, which is this information paradox, because of the features of blockchains. If information is cheaper, by this equation, more traders decide to pay that information cost. It means that more traders enter the blockchain. And if you remember, if you follow this talk, then you know that if there are more traders that enter the market, it means that the required valuation to participate gets larger and larger. Gets larger and larger. And if you remember my picture, right, you know that a higher valuation required to participate means that information gets more truncated, right? Only extreme valuations end up in the market. And also that prices get more pushed more towards extreme values. Okay, so this is a very interesting paradox, and it's mainly driven by this, algorithmic pricing and paid priority. Okay, and finally, we also study this feature that is very specific to blockchains, which is block time. And if you remember, I said that a blockchain round is 12 seconds. That 12 seconds is called block time. Okay, it's the time that is required for all this cryptographic work to happen and to validate transactions. And block time is very important for security and decentralization. For security, because the more you give time to a blockchain participant, the more they have time to properly do their consensus job and to validate transactions. So this is very important because this is how you shift the trust from a central authority to algorithms, right? By giving time to people to secure things. And it's also important for decentralization because you could still have a very short block time, but then you would need to do consensus work very quickly. It's my last slide. You would need to do consensus work very quickly, and that means that you need very good hardware, and that would basically centralize the blockchain in the hands of very well-capitalized agents. But they also have, bad effects in terms of the primitives of the model. First, you give more time for fundamentals to move. That means that you would expect more extreme more extreme valuations. And you also would imagine that noise trading would decrease. Remember that noise traders are not completely dumb. They're price sensitive. If block time is very large, then they have high uncertainty as to which prices they would get. Okay, and we basically prove in the paper that a longer block time amplifies every single negative thing that I said about blockchain trading. So a trade-off between security and market efficiency here. And to conclude, the features of decentralization that basically define blockchain undermine blockchain market. The three ingredients that are very important to obtain our result is paid priority, this mechanical price updating, and heterogeneous valuations. And the slides are online, and thank you very much.
Thank you, Faisal. Mariam is going to discuss.
Thanks so much to the organizers for inviting me to discuss this paper. When I was first invited, I was like, what do I know about this? But then I learned that like the organizers understood my own paper better than me. So after I read the paper, I understood, what I know about this. And you're gonna see what I mean. So in general, this is this is an applied theory paper to me, okay, because I do applied theory. I hate it when the discussant comes and complains about my assumptions. Okay, I'm like, okay, it is what it is. So it's not that I don't have my complaints. My complaints are at the end for the authors. Okay, so I'm sure that I'm not gonna get there in time. So what I'll do is that I'm gonna kind of only give my understanding, how I understood what the authors have done, which is different from their art. I mean, my intuition is different from the facts are the fact. And I'm just gonna share my own intuition, my own reading of their paper with you. And then I'm gonna put it in a broader context, which is gonna be in relation to my own. Okay. So to me, the question is about the big question is whether permissionless blockchain, which is permissionless, is a big thing, improve price formation in financial markets. And this paper is a theory of why not. Okay. Of course, this is an applied theory paper. This does not mean that necessarily not or whatever, but this is the mechanism why not. So what is a blockchain? Blockchain is a batch of transactions that are batched in blocks, and then they are executed block by block. Okay, that's kind of the definition. So it sounds, for people who have been in have seen the HFT high frequency trading literature by Eric Budish, this kind of sounds like the proposed batch auctions for HFTs, which was supposed to improve the efficiency. But there is a big difference. Actually, there are two big differences, and they come from the fact thing, which is like, blocking transactions, unlike batching transactions, does not kill the importance of being first. Okay, the whole point of batch auctions was that the auction is done at what single price, okay, at the uniform price. The point of blockchain is that that is not happening, okay? So the only thing that the block does is that, think about an OLG model. Okay, so like if you have a continuous time trading, you as a trader always buy, or let's say you're a buyer, you buy, and you have always the prospect of selling to somebody, okay? But when you are in blocks, that there is an end. For the last person, you were screwed. There's nobody that you can sell, okay? And then, so that has the bad of that word, and also it is it is sequential, okay? So there is a price impact on everything, okay? So that's why the argument of batch auctions does not work. So because of the same reason that I'm gonna be more precise about, basically what they show, which is the no to that answer to that question, is that blockchain kills incentives for information production, And it's even worse when there is more competition, okay? And because of that, it removes the price discovery deteriorates. And then they bring like a bunch of supporting anecdotal empirical evidence. Okay, so of course, I'm not an empiricist, although when I discuss the paper in the bigger context, I'm gonna focus a lot on the empirics, but my work on this is empirical. But I'm not gonna talk at all about the empirics of the paper. So let me do 3 things. I'm gonna give an overview of the paper. Then I'm gonna do that, put it in context. Context would be what I will call DeFi intermediation chain. And then there's a thought on the comments that I'm 100% sure I'm not gonna even get close to. Okay. So let me give you he did a great job giving the detail of the model. So I'm just gonna give an overview. It's incomplete, but I think it's gonna cover the main things. So it's a blockchain environment. So transactions within each are basically there is slots for Ethereum, which I'm going to use for the most part. Each slot is 12 seconds. Okay, and then the transactions between each slot are in one block. They're executed in one batch, but they're executed sequentially at different prices. Then there's going to be M-informed traders. There's going to be a liquidity provider, and there's going to be noise traders. And the game is a 3-stage Stackelberg game. So in the first stage, the traders first pay some fee C to both observe private info and participate. Okay. So if they want to participate, they have to pay the C before the liquidity is decided. In stage 2, there's going to be a competitive and uninformed liquidity supplier that sets the liquidity supply L. Then the stage 3 is most of the meat of the paper, and I'm gonna only basically focus on the results that are about stage 3, where there's gonna be these informed traders, whoever entered, they're gonna have their information structure is the following way. They have a common information about the sign of the fundamental, but they have IID information about the magnitude of the asset payoff. Okay. So then they choose 2 things. They choose a priority fee that they're willing to pay to be to pick their order in the queue of the orders that are going to be executed. Remember, the orders are within each block. The transactions are sequential. That's the whole thing. So it matters who's first. Okay, this is like a normal auction. Then they also choose how much they want to trade. Okay, which is the queue. Then there's gonna be these noise traders who are at the end, and they're just a noise trader. They transaction with 0 priority fee. Okay. Now let me tell you, only as I said, it's like the selected main results because the author being extremely technical. First, everything is a lot of closed form results, which I'm not gonna show. I'm not gonna show any math on the slides. Let me tell you what I see as the 4 main results of stage 3. Okay, so I'm taking the liquidity and supply. Everybody is taking the liquidity supply and number of informed traders as given at this point. So first, let's think about the functional form of the priority fee. Okay, so it's going to be increasing in the individual trading volume. If you want to trade a lot, you want to be high up. Okay, otherwise you're going to be already very low and you're going to make huge losses. Okay, if you make a loss, then it's going to be increasing in the number of informed traders. Okay, and why? Because I think this is the key thing. So if you have, this is an auction. Whoever has the highest information or valuation is at the top. You increase the top, the higher order should increase. This is just a mathematical thing. Okay, so you increase the number, the maximum increases. And I think that is what underlies all the economics of the paper. Then it's also decreasing in the supply. The more supply there is you are willing to submit to give less Q because there's more that can absorb you. Then what is interesting is that, and it also has to do with the fact that the orders increases, is that there is going to be a participation payoff meaning if the valuation of each agent I is below the cutoff, then the I does, although he has paid the cost C, he does not participate. Then let's think about higher comp. They have this notion of higher competition, which is not, which means more traders. Okay, more informed traders are there. So if the competition is higher, then the participation cutoff goes up and the range of participants come down. Why? Because the higher order statistics who are above you, who have a price impact on you, are going to be higher. So the price impact on you is going to be higher. So fewer people, fewer range of people are going to participate. Then for the same reason, but the aggregate demand is going to go up. Why? Because it's the higher order statistics who are higher, who are submitting their demand. Okay. So everything that is about the top of the market goes up. Okay. But the bottom of the market expands. Then the minimum price is submitted by a higher person. Okay. So again, the minimum price is going to go up. And now, the first one was like the priority fee function. Now, what about the equilibrium level of priority fees? The equilibrium level is increasing in supply, okay, because of the feedback loop. And then when the number of bidders goes within, this is just a nice thing to wrap up the intuition, but the number of the first order statistic of infinitely many things is always the max, okay? It's always the max, so nobody else participates. That's the end of it, okay? And that is kind of that is the extreme of this kind of very nice idea of you increase the number of people, the top order statistics go up, bottom order statistics come. So the intuition, so let me talk about like two parts of intuition. The first type is like the information loss due to this blockchain market. As I said, traders take supply as exogenous. Okay, so let's take it as exogenous. And the trades don't happen at a uniform price. Okay, so now if you think about it, what is relevant for trader I at in a block? Okay, the only thing that matters are the trades that are above him. Okay, the total trades that are above him and the traders who are above him. Okay, so that means that the total trades, unlike a batch auction, the total trades don't matter. All traders in the block don't matter. Only the top half matters. Okay. And when we have more informed traders, what happens? Of course, more informed traders is about a statement about the top. Okay. That means the top there's going to be more traders above trader I. So M goes up. That's the increase that I said. Maximum goes up, minimum comes down. Minimum does not matter for each trader. So it's more likely because the maximum and everybody at the top, other higher order statistics has gone up. It's more likely that I is overbid and the prices move against him before the time for his trade execution comes. So it's more likely that he makes losses. And so it's more likely that he drops off because all the information is IID, more information is lost. Okay. So that's basically the size of the people, the number of people who say out goes up. Okay, so because the information is IID, it's lost. Then, so now another way to think about it, which kind of makes the competition very clear, is if you want to think about it in two folds. One is through the trading mechanism, which is trade is executed sequentially. So prices prices move within each block execution. But as I said, compare this to like think about an OLG and a finitely many like generations. The trades in block are limited. So the last trader has no one after him to benefit from. Okay, so this is kind of the worst of the both worlds. Why? Because it's sequential, but it's limited trade. So let's compare to the two extremes. One extreme is like the other normal financial markets. They are sequential, so there's price impact, but at least there's continuous trade forever and ever and ever. Okay. On the other hand, you think about the batch auctions of Eric Bodish. So there's uniform price, okay, which is good, but there is limited trade. Okay. Here, this blockchain has both worst of both worlds. In terms of the competition, again, it has worth of both words. Why? Because more bids just mean more random variables. So the higher order statistics are going to be higher, and I think a little bit more problematic in this context is that the traders don't consider the winner's curse. Okay, so because they don't correct for the winner's curse, that means when the number in general for many reasonable distributions like normal, beta, anything that is not uniform, basically anything that has a tail, if you have more bidders, the winner's curse gets larger. So you shade your bid more, okay? So this problem does not happen. This adverse effect does not happen. But here, because there's no bid shading, and also because the higher order statistics go up, then there is again going to be the worst of both worlds. Because cost of having more people above I goes up, and those below do not matter, okay? And so this is basically, I think this is the intuition which lies behind the results in different shape or forms. So let me use my last 4 minutes to talk about the context, which is what I want to call DeFi intermediation chain. And only because I only have 4 hours, 4 minutes. Yes, sorry, 4 hours until the final. So let me just show you what DeFi intermediation chain means. Okay, this is about Ethereum. Okay, Ethereum, although it's permissionless, okay, it is not actually central. It's if you want, I call it a production chain. Okay, to create each Ethereum, which is this block in Ethereum, there's gonna be traders who he talks about. They're gonna find trades which can be public or private transactions, and they submit them to block builders, okay, who build the blocks. Then, so this is 2 agents. Then there's going to be depositors who are like us, from Ethereum. We deposit our Ethereum with proposers like Coinbase or Lido, okay. Then at the end of each 12 second slot, these 2 guys are gonna play a game, okay. One block is gonna be chosen by the proposer. And who is the proposer is going to be chosen by the consensus, okay, if it's Ethereum's proof of stake, which is why us putting our stakes at Leos of the world matter. So, and then that's I, okay. So, to me, if you ask the economics of that, there's going to be delegation, okay, from us to Leo, okay. There's going to be delegation from traders to block builder, okay, and then the block builder and proposer, of course, somehow an auction between them is run, okay, and one block is chosen. So related to my own work, okay, so before that, so let me give you a schematic view of this is forget about the depositors, because we don't have any information data about them. Okay, look at the traders, block builders, proposers. So this picture is from the end of 2024. These are all the traders. The middle is all the block builders. The right is all the proposers. Okay, you can see that it's not the case that traders randomly go for different block builders. In fact, traders feed into block builders. And that's why I said this is a lot of delegation, okay? So there is only one of the big block builders, I mean, which is basically a ultrasound, which takes a bet equally from many different, okay? While you can see that the block builders basically feed into whoever is the proposal, okay? Whoever they bid in. So now, in the context of the production chain that I told you, the paper that I have that I'm guessing the organizer chose me because of that. And this is my amazing co-authors, Pablo Azar, who knows everything. I mean, whatever I know about blockchain, I know from him. And my great student Avian was at NYU and me. So we focus. Our paper is empirical, okay? We focus on the game between the block builders and proposers. So this is a game that are very few agents involved. So 50% of the block building market is by 3 agents, 50% of proposers by 4 agents. Okay, so this is kind of a bargaining game. Okay, we take this delegation and that delegation as given. Okay, our empirical results are all about this. Our little baby model is all about this. The current paper, which is called CCP, okay, beginning of the last name, is all about the traders and block builders. Okay, so there is a lot of complementarity. Okay, I think at the end of the day, we have to model this whole intermediation chain. It's an intermediation chain that we don't understand. So I think it's very, very important and interesting for me. It was very, very important and interesting to think about the way that this other interaction that I did not know about, how it's done is modeled. Okay. And that is the sense that I really appreciated a paper that like kind of thought about this question and thought about them and tried understanding the mechanism. So let me just finish and say it's an interesting model. And I think there is a lot of potential in differentiating between public and private transactions with informed and maybe uninformed traders. Sorry, I didn't get time to talk about them. And then to incorporate this model in the broader DeFi intermediation chain.
Thank you. Okay, let's take questions. Go ahead, Joel. Shmuel? Okay, Shmuel first.
Clarification, what are they trading in your model?
Sorry?
What are they trading? Those informed and uninformed?
So liquidity is just one number, capital L, but it's a statistic of what is in the pool. And you can imagine that in the smart contract, there is a bunch of dollars, and let's say shares of Microsoft.
Oh,
and if I'm a buyer, I take out a little bit of Microsoft and put in a little bit of dollars. And that's mechanically as a
and you have a
function of-
credible way to surrender your Microsoft shares.
So, sorry?
You have a credible way to surrender your Microsoft shares.
Yes, yeah.
All right.
If you want to buy and sell, you just take out one. And
So your paper is very specific to Ethereum, right?
Yes.
All right. I just want to say for general information that there is another breed of platforms. They call layer 2.
Yes. So layer 2 are
on
not
layer
really
2 you can do whatever you want, whatever clever things you want.
Yes.
And all you do is once a day or once in a while, you run the entire log of your centralized system through a hash function, get like I don't know how many bits, 64 bits, and you record them in a Bitcoin chain. That is to say, you sell a Bitcoin to yourself for the sole purpose of putting that stamp. And in this way, you create the credibility of your markets. You load it on the Bitcoin credibility. And so you have the complete freedom. You don't need to go on this Ethereum with all its...
So just to
and you don't have to pay every minute fees, because only once a day they are trading with themselves a Bitcoin to record the times, to record the...
Thank you. It's an important question between layer 1 and layer 2. So here it's trading on the layer 1. So it's 12 seconds, not a day, and it's the most liquid, I would say, blockchains, including the layer 2. And layer 2 blockchains are not really decentralized. They're run by a company, and that pays in a way, I'm not going to go into details, for the security of the Ethereum blockchain to be able to sell themselves as decentralized. But at the end of the day, you have the risk that is specific to layer 2s, which is called smart contract risk or layer 2 risk. And of course, that adds fragmentation, but it doesn't mean that this trading doesn't happen. In fact, in practice, it's the most used type of blockchain. But I'm working on fragmentation between layer 1. It's an important question.
I just think that layer 2 is so exciting. If we are dreaming about a perfect market that we want to imagine and use a decentralized Bitcoin as a credible way for settlement and for the layer 2 is fascinating. It's super clever.
And what happens once a day?
I don't know how often they do it, but they don't need to do it every instant. Basically, they ask you to trust them for several hours, and then they record the entire log on the Bitcoin chain.
Joel.
This Alan, just clarification. First, you did not mention it specifically, but given your answer to Shmuel, it seems like you envisioned the matching mechanism behind this as being an automated market maker. Okay, yes. Now, with an automated market maker, you have a random selection of buyers and sellers. It's not necessarily the case that I want to be first in line. If I'm the seller, I want all the buyers to trade ahead of me.
Yes.
And then I want, so.
Yes.
The ordering here is not quite clear to me.
So that's an important question in the sense that what you're saying is, let's say all of us are buyers. If I know that small aggressive traders will be trading at the beginning, then perhaps what I want to do is sell out of them, right? But think of the equilibrium, right? You're a buyer, and if I extend this strategy set of everyone to be able to sell after others, then you also anticipate this, right? So you as a buyer, let's say you're aggressive, you also find it more optimal to wait for me to sell and then buy after me, right? And if you think about it, it takes a few more minutes than what I have here. There's no equilibrium in which buyers will accept to be aggressive at the beginning and then sellers afterwards come and correct them, because there's a profitable deviation, right, for each one of right?
What
So I imagine there is some more pure
equilibrium. That does not surprise me,
Yes.
given the variability.
Yes, I very much agree. But in the data, you see that the average block since 2021, so since blockchain actually became, liquid, that the average block is trading in the same direction at the beginning of the block, and then average out. We don't see that correction.
Okay, go ahead.
So, just trying to understand the model, so, clarification question, and it goes, my thinking along the lines of the welfare, which came up in your, presentation in my discussion. So it seems like these fees, so I'm just asking, I don't think it can be done, but just in terms of the model, what if we start everybody saying fee and rank is treated for the quarters?
Yeah, that's called, yes, yeah, no problem. There is already this, it's called, so there's a base fee and a priority fee. Here, base fee, I normalize it to 0. Everybody pays it, right? But there's still people that want to have immediacy. In fact, it's not only about being traded before, but it's even when the network is blocked, because the block is limited in space. Some people just want to be in the next block, not even in terms of ordering, they just want to be in the next block instead of being like 5 or 6 other blocks, right? So the base fee is important. It's what you're saying, everybody's paying it. So they introduced this priority fee as extra revenue for these builders. Well, it does, yes, this is why that's very, yeah, exactly. I completely agree.
What do you model everybody disclosed, so I know that, the green is paying $5, not paying $2.
Yes.
How would that change your stuff?
So if, I mean, it depends which strategy you're looking at, right? But so if you disclose your priority fee, then you're disclosing your private information. Would that be optimal for you? Yes. Yeah, but I mean, there's many different ways you can see this, because I mean, the blockchain runs this website. So if you want to give out your information, you would do it a little bit before the end of the blockchain round, right? And then many possible different, you can imagine entry deterrence, you can imagine collusion, you can imagine signaling between traders through these priority fees, right? But if I think in terms, it's an interesting question, because what you're saying is the design question. In terms of how can I design this, how can I design the system to maximize welfare? In fact, I sent an email to Thomas, who was just there a week ago with exactly what you just said. Like, can we think of this as a mechanism design? How can I set up this design to maximize welfare? And probably one of the things is to make things public, right?
I'm thinking of the comparison with welfare still.
Yes.
So what do you think is this in terms of total cost of this whole blockchain process versus regular trading? Thinking along Eric Woodish's paper, what is more? I don't.
So Eric says that his design improves markets, and what I'm trying to say here is that I take as a reference continuous trading, and I say it's worse. So, probably Eric's thing is better.
Okay, let's get Asif.
So in the paper, we don't have a measure.
Yeah.
Well, yes, but I think here it deteriorates, at least in terms of price formation, but whether this literally, yeah, I don't know actually. It's not, I mean, my intuition says it's worse than traditional markets, but I would have to wait.
Okay, two more questions, Asif and Jean.
So I thought the answer interesting and provocative. Provocative, so I won't try and destroy it. Yeah? Go ahead. So let me shoot two arrows. So one is how you think about the noise traders in this model, because noise traders, the way I think about them is they will trade whatever price. Yeah. The huge margin. The fact that there are these people that just will trade randomly makes markets work in a way.
Yes.
Now in your setting, I think there are not willing to trade at any price. In fact, they're the opposite of that. They're like, there was not any, this is what I understand. And because they end up being priced out, market stops functioning. So that's sort of aligned with how I think, right? There's no traders, we don't have trade. Yeah. So one thing, how would it work if you model them differently? And the other, I don't think you have short selling here. No. You do allow for short selling? So
I mean,
if you did allow for short,
yeah, so let's come back to the question. So for the first question, that wouldn't change anything. So we have price sensitive noise trading in the sense that there's some maximum amount of possible noise trading, and then decreases with how liquid that smart contract is, right? So if you imagine that if they're not sensitive, they're just like the maximum available noise traders would just trade anyway, it doesn't change with it. It's just going to be a bit different. We just went with the price sensitive because that's the standard. And for the second question, as I was explaining just before, you can imagine that short selling is part of the strategy, but we couldn't find any equilibrium that would sustain this, right? Because everybody has, so the way you would solve it is that you could say, okay, let's assume that this structure of a block is the equilibrium, but you will always find a profitable deviation, because if you short sell, then I want to buy after. But if I buy, you want to short sell after me. And so we just never agree. So I can prove mathematically that it's not pure, whereas, I mean, it can be a mixed one, but just not mixed. And plus the data. There's clearly no correction after the rest of traders all trading the same fraction. I don't know if you remember my picture with the average block. You have something like 30% of the first of the block, which traders trade in aggressively in the same direction with decreasing volumes, and then you have zero mean trading in the rest of the block. That's average to 3.5 years of trading.
Okay, let's take.
Thank you for trying this.
Yeah, so I want to come back to the comparison with spatial change, which I think is interesting. So here, so these guys, they all trade in the same block. So we could run an auction, we could run a batch auction, with the unique price for everybody. We don't do that. So instead, we have like a formula that gives a price completely exogenous. It's not the equilibrium price, so people are unhappy, and so they are happy to instead, pay for fees. And so there is a new auction for the fees. And so I would expect that in the end, the allocation is going to be exactly the same, so that we are just undoing this exogenous price function that we pick for God knows why. So is that, and if that's not the case, I'd like to know what. The second sub question is if I understand correctly, the problem is that then, basically the surplus is extracted by the people who provide liquidity. And so I guess, this is due to the auction in a sense. And so the same would happen in the batch auction.
So let me start with the second one. When you say the surplus, you mean the private fees? Or
the private information of the guys who pay for it.
So the priority fees are revenue for builders. So you can imagine they go out of that system, that economists could have of informed knowledge traders and market makers. Priority fees, they're out, and they pay for the security of the blockchain.
Oh, okay. Yeah, but in any case, so the gate from private information are they completely spaced?
No, they're not specific. No, it's just that the function traders that are the, say, the most aggressive traders are the ones that keep non-zero positive income from informed trading. And that's due to pay priority. So come back to, that's related to your first question, right? Because of this extra cost, this pay priority, yes, if you would imagine that, I can create for pay priority, but it's not really a cost, and I can just, give my demand schedule, then the equilibrium would be very likely, I wouldn't do the math, but it would be very likely the same thing, right? But because of this extra cost, right, it happens that it's not the case, right?
Okay. Why is it individually rational? That's essentially what we're asking, right?
What
Why is it individually rational for the informed trader to bid up the price above, right? To actually pay above the value that they are informed about value. They should take that into account.
Yeah, so take here's an interpretation of this, right? So the blockchain around is 12 seconds, right? So let's say there's some information that comes to the market, and we are at the very end of the 12 seconds, and traders are deciding the priorities. And so our private value part is that the common value part is say completely resolved, right? We all know it, but we have some private need due to hedging, due to some model, due to capital constraints, and that's what's gonna create heterogeneity. And that's what's gonna drive the price up, right?
Do you see reversals?
Sorry.
Do you see reversals from block to block?
Uh,
Price reversals?
Yes, because so if each block overshoots prices, so there's a new block with, let's say, some new information that will overshoot the price in the other direction. And that's why significantly you see this, higher volatility in blockchain markets, because every time it overshoots in one direction. So yes, there is an interversion.
So let's carry this discussion outside. So Vincent, you're going to talk about price of information, exchange data.
I get confused about that. Because I was like, I thought there was one more page.
All right, so first, I would like to thank the organizers for putting the paper on the program. This is joint work with Thierry Foucault, and I promise I'm the last person from HSE Paris that you will see today. So we're looking forward to the comments from the audience and from Thierry, of course. So the starting point for the paper is the debate about the fees that securities exchange charge for their data. So as you might know, exchanges sell proprietary data feeds to market participants. These data feeds contain real-time information either about their limit order book or about realized transactions. And the question is whether these data fees are too high. So exchange will say these data fees are high, but they reflect the market value of our data, and they also cover the cost to innovate and distribute good data products. Regulators, on the other hand, will say these data fees are inefficiently high as a result of exchanges' market power. This creates a differential access to information, and ultimately this harms market quality. Based on this view, regulators have promoted what we would call low-cost data feeds. So for example, in the US, as you know, there is SIP data for many stocks, which is top-of-the-book data consolidated across trading revenues. So why do I say that it's low cost? Not only because it's cheap, but also because it's not as fast and not as comprehensive as the proprietary data feeds from the exchange. In Europe, since MiFIR, exchanges have to disclose their data for free, but with a delay of 15 minutes. Right? And so, of course, the question is that in today's fast market, is that putting enough competitive pressure on the exchange? So the question we ask in this paper is how and should we regulate the market for exchange data? So we're going to have a theoretical model in which we analyze jointly the optimal data policy and the optimal trading fees of an exchange. So why do we look at both? Well, because trading services and data services are two businesses that are intimately linked. They are linked on the data production side. The trading fees that you set will impact the order flow that the exchange gets, and ultimately the informativeness or the quality of the data that the exchange can sell. They are also linked on the data consumption side. The use value of data for market participants will depend on the trading fees that the exchange charges. So the contribution of this paper is to embed these insights in a model of trading where all agents are fully rational. So why is that useful? Because we can do a welfare analysis of exchange data policy and of regulation. So what do we find? In the first result, we compare the sale of exchange data to a benchmark in which there is no dissemination of exchange data. And then we find that volume and welfare increases. What's important in our model is that the data will be purchased by market makers, and that will level the playing field with informed speculators. So market makers are going to exert a positive externality on other traders. Why is that interesting? Because, well, it relates to a paper by our discussant, Terry. What they show is that after what we would call an increase in the data quality provided by the NICE, the volume of trading increased also for people who do not subscribe to the data feeds, right? And so in our model, the market makers are the purchaser of data, and they exert this positive externality also on traders who do not buy the data, okay? So volume and welfare increase because as market makers purchase the data, this reduces adverse selection, this increases volume and welfare. What we show is that exchanges, when they can sell data, they also have incentives to decrease their trading fees, and that further increases volume and welfare, okay? But to be fair, regulators, are not worried about the existence of a market for exchange data. What they care about is the pricing of this data. So the second exercise that we look at is a cap on the data fees. And here, surprisingly, we find that as a result of the cap, the data quality provided by the exchange can actually increase. Okay, so what's the intuition for that? We're going to find that even if you cannot monetize the data as an exchange, you have an incentive to maximize the quality of the data because it increases trading volume and ultimately your revenues from trading fees. What we're going to show is that on the other end, it's the ability to monetize the data that will give you incentives to limit the quality of the data that you provide. Okay? And so how do we relate to empirical evidence here? Well, there's a paper by Borgart and co-authors. They look at different episodes of data monetization, so from a data fee of 0 to a positive data fee. And looking at various metrics, they find that this is actually harmful. Okay? And so we can explain that to the extent that in our model, monetization of data will actually lead to a decrease in data quality. So is that the end of the story? Should you impose a cap on data fees? We're going to say not necessarily, because if you impose a cap on the data fees, we're going to show that the exchange will react by increasing its trading fees. So overall, the impact on welfare can actually be ambiguous, and welfare can go down as a result of the cap. Okay? So these are our main results. So there are papers that look at information sales in financial market. We contribute by looking at endogenous data production and also by looking at the interaction between data fees and trading fees, which are critical for exchanges. There are other papers that look at exchanges as multi-service platform, right? But typically they focus on the sale of speed or colocation service, and we want to argue that the economics of data are a bit different, okay? So let me jump right to the model. In the model, the key player will be one exchange that runs two markets, an upstream market at date 1 and a downstream market at date 2. I will come back later to the fact that there is just one exchange. This exchange will set trading fees in each market, F1 and F2. And as I will explain in details on the next slide, they will also sell data about the upstream order flow to downstream market participants. Each market in the model will be made of short-lived risk-neutral traders. So think about each trader being assigned to one market, either upstream or downstream. What do they trade? Well, here for simplicity, they will trade the same asset in each market. So an asset that has a payoff either plus sigma or minus sigma with equal probability. What do we have in mind? Well, one interpretation is that these are two markets for very correlated assets. So in the upstream market, you have an index ETF, and in the downstream market, you have a futures contract on the same ETF. Okay? Alternatively, you could say, well, this is the market for the same asset, just considered at different points in time. Okay? Each market will work in the same way. We're going to have one market maker that first posts a bid and an ask price. And then you have a continuum of traders that submit unit orders. These traders come with two types. First, you have a continuum of mass mutuity of informed speculators. This mass of speculators will be endogenous because speculators will be able to decide whether to pay a cost C, to acquire a perfect private signal about the asset. Okay. You also have liquidity traders that can either be liquidity buyers or liquidity sellers. The mass of these liquidity buyers will be uniformly distributed. Okay, so they will play the role of noise traders if you want, but they are going to be rational. Okay, so they're going to trade only if their financial loss does not exceed epsilon, which is their private benefit or their willingness to trade. Okay, if you take epsilon to infinity, you're back to noise trading, but if you have noise trader, it's harder to do a welfare analysis. So now let me tell you about the data that the exchange will sell. The exchange will sell a noisy version of the upstream order flow to downstream market participants. Why is that useful? Because downstream market participants are basically trading the same asset, okay? And so to the extent that there's informed trading in the upstream market, the upstream order flow will tell you something about the value of the asset. So suppose you observe the order flow from the upstream market and you try to predict the value of the asset, right? So you will form a posterior that the value of the asset is high, equal to sigma, given this order flow. In our model, you have either of three outcomes. This posterior is 0, you know for sure that the asset value is low. This posterior is 1, you know for sure that the asset value is high. Or the posterior is equal to the prior of 1/2, you have not learned anything, okay? The fact that you get full revelation of the asset value or no revelation at all is a classic result when you have uniformly distributed masses of liquidity traders, okay? Here what you see is that Q bar will be the probability that the upstream order flow tells you what the asset value is. We're going to call that the informativeness of the upstream order flow, and that's going to be endogenous, of course. So we're going to let the exchange monetize this data. On top of that, we're going to allow the exchange to sell data of a quality Q lower than this Q bar, okay? What we want to capture here is a choice of granularity or transparency by the exchange. So how is it going to work in the end? Data is going to be a noisy version of the upstream order flow. From this data, buyers can try to infer the asset value, and they will either learn nothing with probability 1 minus Q, or they will learn the asset value perfectly with probability Q. Q is what we call the quality of the data. And again, there's a technological constraint. It cannot exceed the informativeness of the upstream order flow Q bar, okay? So that's it for the data. Now let me tell you about the timeline and the actions. So first, the exchange will choose its trading fees in each market, F1 and F2, the quality of the data Q, and the fee that they will charge for the data, which is big phi. Of course, you can imagine that an important question here is who buys the data from the exchange? Well, our model has an answer about this. We show that it's the downstream market maker that will buy the data, and only that market maker. So what's the intuition? Well, we're going to show that when the market maker in the downstream market buys the data from the exchange, its quotes will reveal the data in equilibrium, which means that other traders do not have any incentive to buy the data. You need a bit more to get to the result, but that's basically the key intuition. So in terms of information acquisition, what do we get? Well, the market maker in the downstream market will buy the exchange data, that they will see at day 2. Speculators on the other end, they can decide to acquire this perfect product signal about the asset value. Then you have the upstream market that opens. The market maker there sets its quotes. The traders submit their unit orders. You have the order flow that is realized, and it's packaged by the exchange as transaction data. These are the data that the market maker in the downstream market will observe before setting its quotes, right? And the downstream market otherwise works in the same way as the upstream market. Okay. So before I tell you about the analysis, I just want to discuss quickly the assumptions related to market power in our model. So first, we have one market maker per market. So market makers are local monopolists. So in practice, we know that market making is profitable. So it seems that market makers are getting some rents. So why do you have this assumption? Well, in the theory, we need the market makers to earn some rents for them to be willing to pay for the data ex ante. And so the easiest way to get that in the model is to assume that the market maker is a local monopolist, right? Now, the biggest elephant in the room is maybe the fact that the exchange is a monopolist. They're just a single exchange. So arguably, that maybe doesn't work too well for US equity markets, where we know that we have a lot of competition between different trading venues. It works a bit more for EU equity markets, where we have less competition between trading venues, But even in the US, if you think about some proprietary derivative contracts, you don't really have a choice on where to trade it. So here the model will apply. If you really insist on there being competition for order flow, we have an extension in the paper where we capture that in reduced form by imposing 0 trading fees for the exchange. So in that case, the exchange can only benefit from the sale of data. I won't talk about it in the presentation, but I'm happy to take questions on this. Okay. So now let me move on to the analysis. So initially, the exchange will choose its design. Then you're going to have an equilibrium. And so we're going to work backward by first solving for the equilibrium. And so the first thing I need to tell you is what are going to be the quotes of the market maker in each market. The trading game in each market is the same. You have a market maker that sets one bid and one ask price. Then traders submit their unit orders. In the upstream market, this is very classic. This is actually a game that is close to what Mighty Fighter 1989. Okay. The downstream market is a bit more tricky. Why? Because before setting the quotes, the market maker who has purchased the exchange data will privately observe this data. And remember that the exchange data will either tell you nothing with probability 1 minus Q, but with probability Q, the market maker will learn the asset value, which is something that liquidity traders don't know. Okay? Since the market maker is moving first by setting its quotes, we have a signaling game. Okay? Signaling games are usually tricky because we have multiple equilibria, but we have a very nice property in our setup. First, we have a unique perfect Bayesian equilibrium. Okay? And on top of that, this equilibrium is the same equilibrium you would obtain if the exchange data were publicly observed instead of just being observed by the market maker. Okay? So let me try to give you some intuition. Suppose first that traders are only buying. If traders are only buying, what the market maker will do is to try to quote a very high ask price to try to fool the liquidity traders into thinking that the asset value is high. Right? But now the market maker is making the market, is setting both a bid and an ask price. Right? So in this case, this incentive to fool the liquidity traders are gone because you're both buying and selling the asset at the same time. Okay? There are many more details in the paper, but essentially this result makes our life much easier. Why? Because although in equilibrium only the market maker buys the exchange data, the outcome is as if this data were publicly observed by everyone. So we can solve that simpler game. So now I'm going to tell you about the optimal bid and ask from the market maker. And as you can imagine, they will be characterized by an R spread, ST, here, with respect to the expected value of the asset conditional on the information. What is pi t here? Pi t is the posterior value that the asset value is high, given the data. In the upstream market, there is no information yet, so the posterior is equal to the prior of 0.5. Okay. But in the downstream market, the market maker may have acquired data, and then the posterior might also be 0, asset value is low, or 1, asset value is high. So what do you obtain when you look at this optimal spread? First, there's going to be a monopoly markup component in this spread because there's only one market maker. On top of that, when the market maker is uninformed, which is always the case at date 1, and can also be the case in the downstream market when the data didn't reveal the asset value. On top of that, there's an adverse selection component because then the market maker is facing informed speculators. And what you can see is that this adverse selection component in red is increasing in the mass multi of speculators, which is intuitive. So at this stage, we can ask, okay, why is the exchange data valuable to the market maker if the quotes of the market maker disclose this information to everyone in equilibrium? The reason is as follows. As a market maker, if I acquire the exchange data, I'm more likely to know the asset value. I'm less likely to face adverse selection from speculators, and thus I can increase my profit from liquidity traders. So really the value of the data for the market maker is to protect itself against adverse selection by speculators. Okay. Now the last thing I need to tell you about is the mass of speculators in the market. Okay. So in each market, you have speculators, and speculators will enter as long as the cost of private information C is lower than the expected profit from this information. So here I broke down this expected profit into two components, the probability that the market maker is uninformed times the conditional expected profit. Why did I do this? Because as a speculator, you can only profit from your private information if the market maker is uninformed. Okay. So if you were to plot the conditional expected profit as a function of the mass of speculators mu, you will find a decreasing function. That's very classic. If more speculators enter, the market maker charges a higher spread. This lowers the profit for any individual speculator. So the way you find the equilibrium mass of speculators is by equating the red line with C over 1 minus Q. In the upstream market, the market maker is uninformed. Q is equal to 0, so you just equate the red line with C. In the downstream market, the market maker can be informed with some probability Q. And so what does it mean for the speculator? It is as if you increase the cost of the effective information advantage from C to C over 1 minus Q. And so the mass of speculators in the downstream market will be lower. The other thing that you see is that if the exchange increases the data quality, speculation in the downstream market will decrease. Why? Because data quality goes up, the market maker is more likely to be informed. It's harder for speculators to profit from their own private information. Okay, so that's going to be quite important. Now we have the equilibrium, so I can move on to the exchange design stage. So the exchange will choose its policies, so the trading fees in each market, the quality of the data, and the fee they charge for the data, big phi, to maximize their profit. So the profit is the sum of two components, what you get from trading fees and what you charge for the data. Trading fee revenue in each market will be expected volume, EV, times the trading fee F. Okay. You maximize your profit under two constraints. First, there's a technological data constraint. The quality of the data that you sell Q cannot exceed the informativeness of the upstream order flow. This informativeness will be endogenous in our model, and if you want some kind of empirical counterpart, it's related to the PIN measure. Second thing, the fee that you charge for the data at BigFi cannot exceed what the buyer is willing to pay for it. Okay, so the market maker's willingness to pay for the data, we're going to call it VD for value of data. Okay, and so before I tell you about the solution to this problem, I want to analyze the complementarities between the data business of the exchange and the trading business of the exchange. I'm going to do that with this graph, and that's the most important slide of the paper. So on the left-hand side, you have the policies of the exchange, the trading fees in each market, and the quality of the data. On the right-hand side, you have the object we need for the profit of the exchange, volume in each market, and the value of the data to the market maker. Okay. So the first question is, what is the effect of trading fees on data quality and the value of data? First, we're going to show that if you increase your trading fee in the upstream market, your order flow becomes less informative. And that affects the maximum quality of the data that you can sell. This is not intuitive ex ante, because you could say, well, if I increase my trading fee, I'm going to reduce both liquidity volume and speculative volume. It turns out that the effect on speculative volume is stronger because of the extensive margin of the entry of speculators. Right? Now, what is the effect of the trading fee on the value of data? If you increase your trading fee in the downstream market, the market maker is less willing to pay for data, so VD goes down. There's also an indirect effect via the mass of speculators. If I increase my trading fee in the downstream market, there are less speculators and the value of data goes down. Why? Because the market maker is buying the data to protect itself against adverse selection. So less speculators, less adverse selection, lower value of data. Okay. So the second question that we can ask is, what is the effect of data quality on the revenues from trading fees? Okay. Again, there are two effects, direct and indirect, and they work in the same direction. If you increase data quality, there are less speculators in the downstream market, less adverse selection, and hence volume increases. Okay. The final thing is, what is the effect of data quality on the value of data itself? The direct effect is very intuitive. You increase the quality of the data, the value of the data goes up. The indirect effect is more interesting. If you increase the quality of data, again, the mass of speculators goes down in the downstream market, and that reduces the value of data, again, because the market maker is buying data to protect itself against adverse selection. So what you find is that the value of data is in fact unshaped in the quality of the data, and that's going to be important. So now I can tell you about the optimal policy of the exchange, and I'm going to do that with the comparison of the laissez-faire equilibrium with two benchmarks. So the first benchmark is a benchmark in which there is no data, and we can do that in our model by setting the quality of the data to 0. If the exchange can choose its policies, they will choose to sell data, so they will choose quality Q star positive. They will lower their trading fees, volume will increase, and welfare will increase in the utilitarian sense. So why do trading fees go down? Well, just because of what I explained. Lowering your trading fees is a way to increase the quality of the data and to increase the value of the data. So that's why you want to do it when you can sell data. Volume and welfare will increase because if data quality goes up from 0 to Q star, it means that there is less adverse selection in the downstream market. That increases volume and that increases welfare as well. What we find, however, is that the bulk of the increase of volume and welfare comes from the decrease in the trading fees. Okay, so if you don't consider this aspect, you will miss a lot of the gains from having this market for data. Now, as I said in the introduction, regulators are not worried about the existence of a market for data per se. What they are worried about is the pricing of this data. Okay. So this motivates the second exercise that we do. We're going to look at the effect of a cap on the fee that the exchange can charge for the data. In fact, we're going to look at an extreme cap. We're going to compare again laissez-faire, in which the exchange chooses the optimal data fee, fee star, to the case of no monetization, so a cap of 0. You cannot charge for data. And so the result that we find is that with monetization, it's surprising, monetization typically lowers the quality of the data, typically in the sense of for most parameter values. However, welfare can increase. So let me give you an intuition for why monetization can decrease the quality of the data. First, even if you cannot monetize data, you have an incentive to maximize the quality of that data. Why? Because higher data quality, lower adverse selection, higher volume, higher revenues from trading fees. Okay? And it's in fact the ability to monetize the data that will give the exchange incentives to limit the quality of the data that they sell. Why? Because the value of the data is unshaped in the data quality. Okay? At the extreme, if I sell data of very high quality, there's no speculation, and hence there's no value of data for the market maker. What about welfare? So when you monetize the data, On the one hand, you have lower data quality, that's bad, okay? But at the same time, when the exchange can monetize the data, they have an incentive to lower their trading fees to increase the value of that data. And that's the positive effect of monetization on welfare. Okay. Now, to conclude, should we regulate the market for exchange data? Now, the cheap shot is to say, well, the market for exchange data is difficult to regulate in isolation because of these complementarities between the different businesses of the exchange. The sale of data incentivizes exchange to lower their trading fees. That's one thing. The surprising result that we have is that if you impose a cap on data fees, data quality will increase. You might think this is good, but welfare can actually decrease because the exchange will react to the cap on data fees by increasing their trading fees. Okay. And so an interesting extension to work on will be a fully fledged model of competition where exchanges compete for order flow and for data provision at the same time. Okay. Thank you very much for your attention.
Thank you. Discussion is steady. Last 20 minutes. Last 20 minutes.
Well, thank you very much for having me. Thank you for putting me last. Tarun tried to sell me on the best for last bit, but I said, I remember Joel and Maureen going this morning, so I'm not quite sure that's true. Okay, so what? This is not my, these are not my slides. I mean, I'd be happy to talk about them, but I would not be as entertaining as Ionid was. There it is, Hendershaw.
What's that? Did you upload them on the NPR?
You displayed them earlier.
Yeah,
I'm not sure what happened. All right. So I've got too many slides and not enough, and so Tarun's gonna start ringing his bell well before I'm done. So let me just start without the slides. So the first one, the first point is this is a paper about platform economics. And so you've got two sides to the, there are two products that are being sold in some sense to different people. And the importance in platform economics is what's the externality between these two sides. That drives sort of everything that happens. They are taking a very, this paper takes a very specific view on what the externality is. Now, John and Eric Gooch have a very different view on what the externality between data and trading might be. And so I think this is novel in the sense that it is certainly, you know, the sort of externality they have in mind, whereas market data makes the market better. It's plausible to me. It's somewhat motivated by some work I've done, so I like it a lot. And I think it's really exploring what the implications of it are. So now my first slide is supposed to be about the transformation of market data, right? So it used to be, so going way back, market data was distributed by messenger boys who walked around New York. It took 10 to 15 minutes for them to make their circle. Then the ticker tape came out with the telegraph. That lasted for about 100 years until the 60s. Then there started to be some private computer networks. And then in 75, the Congress passed the national market system that basically created the sort of structure for market data that we have today in the US. And it started with basically what we're used to, which is core data, which is what gets published on the SIP, right? This is what's been packed. And so it's trades, the best quote and last sale. And they did that, and that's all regulated on a cost-based basis. That looks like it.
Yeah, this one.
No, it's not that one. Try the one on the left. That one. Hey.
That's it.
Okay. So now we're so then we're allowed to. Well, I'll move back over here. So, but then there's this non-core data, which then at the time in 75 was there essentially wasn't any non-core data, but the exchanges could sell that as long as it was fair and reasonable. Okay, so then what happened is trading changed over time. So in particular, we got decimalization in 2001, and then we got a lot of automation. And then the exchanges started putting together some core data, non-core data products. Gideon has a nice paper on OpenBook, which was, I think, well, it was the first NYSE product, but some of the ECNs, Island and Arca, had been selling it for a while. Then basically depth at the top of the book went down a lot. Their trading became fully automated. So it made depth of book data more important for the algorithms managing large orders. So you could also think about this as the evolution. You went from the physical trading floor. It was basically impossible to get timely market data. Everything became automated. And then, in essence, you could think about buying market today as like, what was the cost of buying a seat on the floor before? If you wanted to know what's really happening, you buy market data. Now, how did I get more involved in this? And I guess my disclosures will come out. So I wrote a paper that starts with Island Goes Dark and then colon. Maureen was the editor on this. And I got I wish I could write the way that Maureen does. So there were two lovely quotes in her, the first letter we got.
How long ago was this? When did you write this paper?
About 25 years.
Oh, okay, well then, yeah, that's, there was, you know, a statute of limitations.
One was, you know, the colons in paper titles were not so common then, so it's Island Goes Dark colon, and there were like 5 things. And Maureen said, you know, this paper has the longest title of anything under submission at the RFS. That's not necessarily a good thing. So the paper finally got titled. And so the first part was this interesting experiment. So Island was a very successful electronic communication network. They were eventually acquired by NASDAQ, and their technology is sort of the core of NASDAQ. And so they were trading ECNs. This was in QQQ. They had 40% of the market share, so they were really dominating. They thought ARCA's technology was lame. They didn't want to have to route their orders to ARCA. And Larry Harris, who was the chief economist of the SEC at the time, said, well, that's against the law. And he may well be right. And so Ireland's response was, and this is due to the particularities of the rule, they're like, we don't have to route if we don't actually display any quotes. So they're like, UK was the first dark pool. You can send your order here. They were running the same limit order book, but you just have no idea what the price is. And so their market share in QQQ dropped from 40% to 20%, but people still traded there. And then we wrote about this, and this graph was just that it mattered. And then we had lots of stuff on price discovery, but in all kinds of different ways. And then we submitted the paper here, and then, you know, by the time we eventually got it back, we submitted it the second time somewhere in here. It was all about the first event. And then they decided to eventually start redoing it later. We were too slow. And this was Maureen's next letter. And it was, events have conspired against the paper.
I actually remember writing that.
And indeed, now we have the redisplay. So we had to redo everything with the redisplay. There still is this, I don't know what happened in here, so their market share went down a lot, remained relatively stable. Obviously, we're literally a flat line, but it went down again. I could never figure out with them what exactly happened. ARCA actually got better, I think, with most of what happened, but then it recovered again. And so this is basically, so what happened with this? So I think, Jonathan, you were. No, Jonathan. Right here. Yeah. He's right there. Standing up. So, it couldn't see me without sitting down. I couldn't see you because you were standing up. Right, you were at the SEC at the time, and the SEC, in part, because of this evidence, basically said, look, there are constraints on market data pricing, and you will lose order flow if you charge too much. This was effectively priced went to infinity. Therefore, we think that it will, this platform, the one side of the platform, which is competition for order flow, will discipline exchange data pricing. Okay. This led to litigation, which I had some involvement in. It started with Yahoo and Google, who basically just wanted free market data to put on their website. They eventually, the exchanges found a way to satisfy them. They dropped out. But then SIFMA, which is basically everybody in the financial world and was against the exchanges, So SIFMA took up the lawsuit, they sued, that's why it's Net Coalition is the name, it originally was Chuco and Yano. And the circuit, the DC circuit ruled that fine, the SEC's justification was plausible, but they needed more evidence for it. So what did they do? The SEC took the very unusual step where, and I'm not aware of any other one, they held an administrative proceeding. So they have administrative proceedings typically for punishing, for disciplining members, people who have committed financial misconduct. But this was basically just to decide what the evidence was in terms of market data pricing and was it fair and reasonable. So I was hired by the NYSE to act as an expert witness. There was been a week in a courtroom at the SEC, and you know, usually you get used to like food being brought in and all this stuff. And at the SEC, they have very strict rules. So it was a long week. Okay. So the exchanges prevailed. So basically, Judge Murray, you can read her decision. It's still online. She basically said there was a lot of evidence that the market data was disciplining, the competition for order flow was disciplining market data. The SEC somehow ended up deciding they held this proceeding to have it be done once and for all. They somehow became unhappy about it. I had no further involvement at this point. But then what happened was there were additional things that were filed, and they hired Charles Jones, and they also provided some data to Mark Reisman, who's an IO economist. So they had Charles write a paper, which is the late great Charles Jones, who also did the Ivy League Star paper with me. In terms of writing about market data, and Charles is a very empirical guy and writes so well. You can maybe not as well as Marine, but close second. And so he wrote this up, and he made a lot of the arguments that you would expect the exchanges to make. There's lots of competition. It's a complement, not a monopoly. He had two more interesting points that not everybody buys market data, the most expensive market data. There are basically 100 firms that buy this. And then they offer all these tiered products. So if you're just a retail investor, you're buying. The other point he tried to make, which was a purely empirical one, was, look, data is just, there was a lot of whinging by SIFMA about how expensive the data was. And his point was, it was small. I wasn't quite sure that comparing it to broker-dealer commissions or market capitalization was all that compelling. What I did find more compelling was, over the 7 years leading up to that, the fraction of exchange revenues that were due to market data were actually declining. So Charles wrote that. Then we had a couple of people. So I think Larry was paid by SIFMA and disclosed and everything. Chester wrote something about, they're both nice pieces. You can find them online. They're both very theoretical arguments about what could go wrong and with why you might not get this disciplining effect. And it's really about the elasticity of demand. You know, is it going to be the case that it's and Larry made some statements which I think are empirically incorrect, but about that basically it's perfectly inelastic. And my Island paper they showed that wasn't true. So then the SEC basically reversed itself unanimously. I was pretty surprised by that because they held this whole proceedings and they made a decision and then by political appointees, but unanimously. It was under the first Trump administration, so I'll just leave that out there. You know, all kinds of things could happen under the Trump administration. So what they did was they rejected the platform theory, which is just wrong. They're clearly platforms. You can really argue about whether or not they're inelastic, how elastic demand is. In essence, my view is it raised the burden of proof that the exchanges had a lot higher than Judge Murray had applied, and they basically said we're disallowing all these rules. I was really surprised by this. They said something nasty about some of my work in there, which makes me unhappy. I'm like, really? But you know, perhaps I shouldn't have been surprised because Brett Redfern, who I did not have such a low opinion of, but I do now. So he became the director of trading markets. He had been at JP Morgan, and he had been intimately involved with the litigation on SIFMA side. And the first day he showed up at the SEC, he started trying to get them to overturn what Judge Murray had done. And you can read all about this. The NYSE and NASDAQ were just apoplectic because they FOIA'd the SEC, they have evidence of everything he did, you can read about it. So in any event, so they eventually, so the SEC had overturned it and the DC Circuit said, look, this is just capricious, you can't change your mind from decades old decisions, and they set it aside. The SEC eventually passed something in 2020, that's the market data infrastructure rule, which I actually don't fully understand the impact of. Okay, so that was a long digression on where market data stands in the US. It's a lot more developed than in Europe. Okay, so then I would say that Terry Foucault wrote something between that and this paper, and it was with Daryl and Laura, and it sounded a lot like SIFMA, basically saying, look, they've got a lot of market power, they're going to set fees too high, and it's going to harm market quality. And this part, the part of calling for cost data for producing the data should be based on cost. This is crazy. Like the exchange is one solid, IT system of figuring out what cost is data and what cost is matching is crazy. But I will say that the paper today seems to represent some evolution in Terry's thinking. In a very positive way, and it's a very nice paper. So they have data quality is endogenous, which is not something that I thought about. They have this feedback loop between data, and it's not the only way that the externality needs to go. That basically more market data makes the market better. You can have a view that would have a negative externality. So there is, so there's a trade-off here. Okay, so they model it as these upstream and downstream markets. That may not be that's not really how I necessarily directly think about the value of market data, but you could think of this as the first trading round and the second trading round. So it's not, it's a perfectly fine metaphor, and they're just trying to capture in a straightforward way, in a parsimonious way. Platform economics papers are often hard. So they've managed to do this. Then their findings, which were already covered well, that basically one of Chester's points is market data fees will subsidize trading fees. And indeed, that's what the paper finds. So the paper thinks that's a good thing. And that basically, reducing market data leads to lower trading fees, which leads to higher welfare. It's always great to see a microstructure paper that actually does welfare. And then once you have that, then once you start capping fees, bad things can happen. So that may not be a good idea. They do this, so they run the national thing as well. A lot of this argument was about whether or not competition or order flow disciplines, data pricing. And so they don't have competition, but they do have this nice thought experiment where, well, let's just imagine it's perfectly competitive. And not surprisingly, if it's perfectly competitive, so as long as you have competition here, you're actually going to get good outcomes with the positive outcome, with the positive externality they have. Okay, so I probably got about 2 minutes left. Yes. And so the two, I'll just briefly talk about, this one's already published. And so this was, the NYSE made data available. So this is basically, I think Terry described this as one of the motivations for the externality that is assumed in the paper. So the NYSE introduced this integrated data feed, which was a much better order by order depth of book product. And they provided data on trading volume by all their member firms and by whether or not they actually subscribe to the feed or not. Okay, so the first thing is that it increased the people who subscribed increased their trading on the NYSE. Perhaps not surprising. They bought data, they could trade more. What was particularly interesting is usually we've been worried about what's the data subscribers would be better off, but the non-subscribers would be Warsaw and me actually do not find that at all. So we find that when people started buying the data, then the actual non-subscribers started trading more on the NYSE. And this is sort of motivation for that, why you might get to a positive externality here. Then there's basically the other paper that was referred to by 3 of my co-authors. I've never worked on a paper with more than one of them at a time. And it was about basically 3 times this trading systems, these were, I think, may have been before they were exchanges, started charging for their data, and it looks at what happened around this. My experiment is basically the price going from infinity to a lower price, and this experiment is prices go from 0 to non-zero here. The exchanges, they lose market share. So there does appear to be, this supports the platform part, that if you start charging for data, you're going to lose order flow. And then they have some results on the market-wide detriments, and I need to understand this better. With only 3 events, it's a little tricky to say market-wide things, but they can certainly reliably say things about market share there. Okay, so I'm at a minute and I'm about done. So I like the paper a lot because it's got some novel theory. It produces some number of interesting results. Market data has been very understudied, and I think there's a lot more that could be done. On the theory side, right, understanding how exchange competition works, then actually understanding the value of that data. Is it that it's really short-run data, in which case I think some of the things that John's written about are more concerning? Or is it somehow allowing the market makers to function better, which is really what this paper is about? Then you could imagine doing more about on the optimal regulation side, not just the paper's already got plenty there, but I think there are more questions we can ask. Then on the empirical frontier, there are a whole variety of things that could be done. How big is the cross-subsidization? I still don't know what the effect of this market data infrastructure rule is. I don't know how to measure it, but that would be very interesting. My AI put cost of production here, as I've already said, I'm not a fan of that. I would say that another interesting development that you may not be aware of is that there's another way to discipline the exchange's pricing, because their data pricing, because that data is all coming from SIFMA members. So what did the SIFMA members do? They started a new exchange, MEMX, and it has much lower market data prices. So there are a whole variety of ways there could be pressure on the exchanges. Thank you very much.
Thanks, Terry. Okay, let's take questions, guys. John?
I'm gonna, can you better explain the link between data quality and Brandon Moracker selection? That link seems critical in your model, but it's not obvious to me how you vary data quality that generates any variation in adversary outside of things that are low latency. It seems like you're thinking not about low latency, like lightning, stuff like that. What, do you have something specific in mind that we can kind of anchor our ideas in this data quality?
So it's true that we don't have anything to say about latency per se, so the paper is not one of those speed. So in the model, the way it works, that an increase in data quality means basically that the market maker who sets the quotes has better information about the fundamental. And so we show that in equilibrium, its quotes will reveal information about that fundamental. So essentially, the quotes, when the data quality increase, will be closer to the fundamental value, and that reduces adverse selection because the speculators have less opportunities to profit. So that's in this way that in our model, that actually the increase in data quality simply means that the quote setters get better information, speculators are priced out, this reduces adverse selection, and so volume and welfare increases.
But the data quality has to come, say, if you get better information about the fundamental, it's almost like feedback.
No, that's a good point. So I didn't have time to talk about it really, but you have a small negative welfare effect in the upstream market because they're to stimulate speculation. You want to stimulate speculation to make your order flow more informative, that you can sell better data quality. And so that in the upstream market, you will increase the speculation, so that has a negative impact on welfare. But the bulk of the welfare effect, which is positive, comes from what happens in the downstream market. And so here you're calling out speculation in the downstream market. So of course, if you don't have this downstream upstream market kind of artificial separation, everything will happen at the same time, but I think the same result will.
Okay, we have a question here.
Very interesting model. I just wanted to suggest one additional channel that would be worth considering, which there was this from a practical standpoint. There is a really explosive use of execution algorithms by end users, corporate entities, and those are infrequent traders, but potentially in large amounts. So when they have to pay a fee for better, sort of more reactive execution algorithms, they actually end up deciding not to use them and use dumber execution algorithms like TWAP or WBAP, and that could actually lead to some non-zero pricing and have potential financial stability given implications, you know, if they end up executing large amounts of a dumb way.
Yeah, so that's a good point. So we don't talk specifically about that. So the thing I can say about your point about trading frequency is that it's kind of obvious, but what we realize working on the model is that they have these kind of fixed costs. So the more you trade on the market, the more likely you're willing to pay for this data. So right, because you're going to be able to benefit from this data over more trades. So if you have traders that have like infrequent trading strategy, maybe they might suffer from that. But I guess what our model points to is that in a sense you don't need to be buying that data to benefit from it if you believe in its positive externality channels. So I think that's what we have. But yeah, thanks for the comment. Sure.
It's not clear to me what is the value in the data. In your model, it was kind of outrageous. You said that with some probability, the data tell you the value of the asset. The data does not tell you the value of the asset. So you have in mind technical analysis, people who are trying to get, what do you get from the data?
Okay, so the only thing we need is that, you know, in our model, it's the order flow, but it could be of course in a different model. So we need that the order flow is somewhat informative about the asset value. The fact that it, you know, tells you with some variety exactly the asset value, yeah, it's more of a modeling, you know, artifact that makes our life a bit easier. But if you're willing to accept that, you know, in the order flow, there's some information about the asset value.
Beyond the current quote.
So, you know, you could do it in a different way. So
because that's what you assume, that the historical prices contain information beyond the current quote.
No, it's not exactly. So
well, not historical, then what?
This is due to like the way.
Or historical order flow contain information beyond the current quote.
So
no, this is very confusing because they said that Yahoo and Google 20 minutes ago, this was a substitute. So there are two types of information that we want to look at. When I hear data, I think historical prices, like what was a minute ago, or I get a current snapshot of liquidity in the market, the entire look of the book.
Yeah.
What do you mean we are seeing? It looks like in your paper, the data means that I'm getting to see the true value of the asset.
Well, okay, so two things. So first, the way we do it is that the quotes in our model are set exactly by the market maker. So that's not where the information lies. The information will lie in the order flow. We could have a model in which the quotes are set contingent on the realized order flow, in which case the information will be in the quotes. So that's the first point. That model would be a bit more tricky, but I don't think it will change the economics. And so I think the point of, you know, in our model, sometimes the data probabilistically tells you the real asset value. I agree, this is not what happens in reality, but I think the economic content that we have here is simply that the order flow contains some information about the asset value. And so the only thing we need is that if you observe the net order flow going in one direction, you will update your estimate of the asset value in one direction. Okay? The way we model it is, you know, it's a bit more extreme.
So you mean that the order flow contains information, the historical order flow, beyond what is the current state of the book, current state of the...
So in our model, the last information we can ever have is the last order flow that has been realized. As I said, you could write a slightly different model in which it's the very last quotes that contains information. I think that would be equivalent, right? So I'm not talking about the past order flow. I'm saying for the most recent information that you can get, either from the quotes or in our model from the realized order flow at the quotes that are not contingent on the flow.
Okay. Please correct me if I'm wrong, but I think you said that if the exchange raises the trading fee, it will get less informative flow. Yes, is that right? So I was hoping to ask for clarification of the mechanism, because in my mind, if you raise your trading fee, you're going to lose some of your uninformed flow because it's becoming too expensive. So you're concentrating information, and your data should become more informative rather than less.
So you have two effects when you change your fee. So the liquid traders here are price elastic. So if you increase your fee, you're going to lose liquidity volume, and you're going to lose speculative volume at the same time. So that's why indeed, I didn't have much time to explain. The net effect on informativeness is not obviously exerted. So the reason we get that when you increase your trading fee, order flow informativeness goes down, is because you have this additional effect of speculative volume through this extensive margin of entry of speculators. Right? So if you think about it as I increase my trading fee, I lose a bit of liquidity volume, but I lose even more in terms of speculative volume. And that's simply because we have endogenous speculation.
Oh, yeah, yeah.
Sorry. So this is just me trying to see if there is something out there that can be thought about in this using your way of thinking. So I believe the SEC is putting an access fee cap for exchanges, right? So I think it's going down by almost a third, 2/3, right? So this is following Andre's point. So now this is going the other direction. If the access fee cap is now much lower than it was before, right? How should we think about the impact of that on the data quality and possibly the quality of market making and market efficiency coming out? I mean, I know exchanges hate this idea; they're fighting it, or at least they were fighting it for some time. But I think, to me, it sounds very relevant to the discussion.
So just to clarify, I'm talking about the cap on the access fee or the cap on the data fee?
The access fee cap, so that's the trading fee cap, not the data. So now you have a problem on the other side, right? Where the volume could possibly go down, right? And then that might interfere with the incentives of exchanges, how to qualify their data.
Yeah. So in terms of the trading fee cap or access fee cap, what I can say is that we have this exercise that Terry nicely mentioned that where we basically set the trading fee to 0. So think about it as the most extreme cap on trading fee that you could think of. And then here, because of the result that Andrew was discussing, that your order flow becomes much more informative because actually when the trading fee goes down, speculators enter more than liquidity traders, so your order flow becomes much more informative. What's interesting is that you think, oh, then data quality will increase, but it doesn't mean that the exchange will necessarily provide the best quality of data that they can sell. In fact, what we show is that in this extension where the cap on trading fee is basically set at 0, so you cannot charge any trading fee at all, the exchange will choose to be opaque and say that they could sell better data, but they choose to limit the quality, of the data. Right? So in terms of answering your question, I think the cap on trading fee might have an unintended consequence on the quality of the data that is provided by it.
Very interesting thing, but I'm just curious, if you have two exchanges completely with zero, are we doing for chain? And if so, are the fees are 0? If that's true.
Yeah, so I mean, actually, if you have natural competition between exchange, you could have sub-zero trading fees, right? Because exchange could recoup what they lose on trading fees from the revenues from data, right? So I think competition between exchange, as Terry said, that is super interesting. I think one view is simply to say that data and trading is a bundle. And so when you look at where to trade, you just look at the sum of the fee for trading and data. To the extent that there is competition for order flow, that will discipline both the trading fee and the data fee, right? That's the selection. But I think what would be very interesting is to write a model where you have option for order flow, because the extent to which your data as an exchange is unique depends on who comes to trade on the market, and that's another use outcome of this competition. So I think that would be very interesting model to write, but I cannot say more of this.
Okay, well, thank you so much. So I want to thank the presenters, the discussants, and everybody else who came. This has been a great day.
The organizers.